It's Thursday morning for the markets. Welcome to Yahoo Finance Live. I'm Brian Sozzi, joined by Emily McCormick. Julie Hyman will be back in the hot seat tomorrow. Lots to hit over the next 2 hours, though, but let's get a quick look at the stock futures here right now and seeing some mixed action to get this trading day started here. Dow futures cut earlier losses, now in the green. The S&P 500 and Nasdaq are still in the red, though. Now, here are a few things we are watching for you right now in the markets. August retail sales data is out, and it's a rare bright spot. And to see a subpar economic data lately, headline and core retail sales both increased month over month and came in ahead of economists' forecasts. Emily has the analysis you need to know coming right up. We're staying focused on the trading action in several of Wednesday's big IPOs, which all saw major gains on their first day of trading. Coffee retailer Dutch Brothers saw its stock surge 59% on its first day of trading. The stock is the third hottest ticker on the Yahoo Finance platform currently. Meanwhile, shares of high-end sneaker seller On Holding rose an impressive 45%. We continue to watch that stock as well. And later on in the show, we'll chat with Cisco's chairman and CEO Chuck Robbins following the company's closely watched investor day yesterday afternoon. Cisco's outlook disappointed analysts, so we'll dive right in there with Chuck Robbins. But first, let's start on these retail sales data. Emily, I know you've been going through the report since they hit the wires at 8:30. One number that stood out to me are sales from non-store retailers or online retailers up 5.3%, really a standout number in this report.
That's right, Brian. And that was the biggest percentage increase that we saw across these categories for retail sales. And I think what this really points to is, yes, we had this surprise increase in retail sales for August. But the caveat here is that the categories that we saw with some of the biggest increases were the ones that point to stay in place behavior among consumers. So that does, again, point to some of this impact from the Delta variant we had in late summer. But taking a look at some of the headline numbers from this report, overall, we saw retail sales up 0.7% in August over July. That was much better than a drop of the same margin that had been expected. And it also came after a drop of 1.8% in July. And now that was downwardly revised from the 1.1% decrease previously reported. So some good news and some bad news as we take a look at this report on the whole. Now, Brian, as you were mentioning, we did see that 5.3% increase in those non-store retailers, those online e-commerce outlets. We also saw furniture and home furnishing store sales up by 3.7%. and grocery store sales up by more than 2%. So again, really pointing to more stay-in-place behavior. And then if we look on the flip side, we also saw food services and drinking place sales flat on the month, although they're still up 32% over last year. And clothing and accessory store sales were up by just 0.1%. So I think taken together, again, does point to a little bit more staying in place, not as much consumer mobility as we've had this latest surge in coronavirus cases in the U.S. And we'll see where things go from here. But at least for now, definitely seeing some of those virus impacts, Brian.
Yeah, and I'm sure a large component of this report, Emily, reflects back-to-school shopping, especially those online sales, strong in general merchandise. A lot of folks sending their kids back to school in person for the first time in more than a year. A lot of stock up there, sneakers, pencils, pens, you name it, new iPads. Certainly, but this is really a surprising report, Emily, just given how the economic data has come in over the past month. Disappointing consumer sentiment, disappointing jobs report in July. But, we did get some jobless claims out this morning as well.
That's right, Brian. And if we take a look at the jobless claims number, did come in a little bit higher than expected, not necessarily something you want to see. But again, we were at a low since March 2020 during the previous week, and we're up just slightly from that, now at about 332,000 individuals filing on a weekly basis. And of course, during the prior week, that was that pandemic era low of 312,000. But the one big thing that we have to note as we take a look at this weekly jobless claims data, one of the things that this does not capture, if we look at that total number of claimants across state and federal programs, we did see that increase actually in the latest data by nearly 180,000 to come in just over 12.1 million. But given that that total claimants figure is on a couple weeks delay, this doesn't yet capture any impact from the fact that we did see these federal enhanced unemployment benefits expiring as of September 6th on a national level. So we are going to see probably millions of individuals rolling off those programs, not reflected in these reports anymore as we continue with these weekly reports. So something to keep an eye on as we continue to get more economic data, Brian.
Also have to keep an eye on what the futures are doing here. Inez Ferre is standing by. She is looking at the markets here. Inez, Surprising retail sales report, as we just mentioned, given everything we've seen in the economy. They have slowed down because of the Delta variant, yet now you have this strong retail sales report. I would say the market's a little confused here in the early going on how to take it.
Yeah, that's right. Well, the market's pairing some of their losses in futures. We are seeing that the Dow is slightly in the green. And if we just take a look at the sector action, you can see in pre-market, we're looking at financials that are going to be leading today. You've got also healthcare that's leading and industrials as well. We're looking at communication services that's set to open slightly lower, as well as technology and materials. Looking at some of the sectors, as you guys were talking about retail sales, if we just take a look at some of the luxury names here, you can see some of the action here in pre-market on luxury, also on fast food services, restaurants as well. And then just taking a look at apparel, I thought this was an interesting retail sales report, also because you had the MasterCard spending poll earlier this week tying in where they saw some strong numbers in August, forecasting actually a strong holiday season. But I really thought that those online, the non-store, when we talk about the Amazons of the world, those were very interesting. Taking a look at the rest of the market also, I wanted to point out what's happening with autos, because of course those are also part of retail. But if we take a look at autos, when you strip away the auto sales, you can see we're looking at right now Ford that's down 0.3%. We're seeing also Tesla that's slightly lower. I do want to point out a note that came out from B of A saying that auto stocks may be volatile over the next 3 to 4 months, simply because of poor visibility when it comes to these auto stocks. They also, though, say that they still have a buy or a neutral on about 80% of the stocks that they cover regarding autos, but they did downgrade Fisker. They also did downgrade Lordstown. You can see Fisker this morning down about 2%. Brian?
Inez, I have a quick follow-up question actually for you. As we take a look at the rest of the market here, of course, we have Treasury yields moving higher, that benchmark 10-year yield up more than 3 basis points on the heels of this retail sales report. We also have the energy sector. If we take a look here at energy prices, crude oil moving lower after settling at its highest level in over a month yesterday. What do you really make of some of this market action in other asset classes as we continue to get this economic data?
Yeah, I mean, there was an interesting actual note, also an interesting Wall Street note about some pockets of the market that are seeing a little bit of, they're off their 52-week highs. So if you take a look at some of the pockets that may be off the 52-week highs, vis-a-vis those that have been really soaring over the last month or so, there, that wall of worry that you guys talk about so much on the show. I mean, I think that we just are in a wait and see for what's going to happen this month. That's supposed to be a very volatile month. So it seems to be that you've got pockets of some weakness that we're seeing, but yet pockets of strength as well.
And a quick programming note, we'll have that analyst that you mentioned, Inez, that downgraded the autos, coming out very cautious, I would say, on Fisker, citing too much competition. That analyst from Bank of America will be on in the 11 to 1 o'clock hour. Inez Ferre, thanks so much.
Thank you.
All right, coming up, Art Hogan stops by with a few thoughts on the markets and maybe even a couple stock picks after that better than expected retail sales report. Do stay tuned.
Welcome back to Yahoo Finance Live. Stocks are on track for a mixed open today after rising yesterday, and investors are still digesting that better than expected retail sales report that we got out earlier this morning, as well as weekly jobless claims. Now, the S&P 500 is still on track to post its first monthly decline in September after 7 straight monthly advances. But for more on today's market action, we're bringing into the stream Art Hogan, Chief Market Strategist of National Securities Corporation. And Art, thank you so much for joining us this morning. First, want to get your take on the economic data that we got out this morning, as well as recently from that cooler than expected CPI report to retail sales and jobless claims today. And how are you interpreting this data as a sign of where we are right now in terms of the economic recovery?
Yeah, that's such a great question. I think that we really got a head fake, and this happens a lot. When we saw the Michigan confidence number earlier a couple of weeks ago, that looked very disappointing. And we always get caught up in this, how do we navigate the survey data versus the hard data? And it's a classic example of consumers actually saying one thing when you ask them a question and doing something else. Clearly, we're going to have a record back to school season. It's the first back to school shopping season we've had in 2 years. And clearly, consumers are in a very good place, right? They've got rock solid balance sheets, historically high levels of savings, historically low levels of credit card debt. So obviously the consumer is actually going to tell us the direction of the economy, and we got a much better than expected read on that in August. And I think that's important. I think that it's important to remember that when we look at some of the consumer confidence surveys versus what the consumer is doing, it's much more important to look at what they're doing.
Art, humor me for a second. So a better than expected retail sales report this morning. I think really a surprise to the markets, most in the markets. Potentially, now I think you have to start having the debate, potentially better than expected September jobs report here. Now you're starting to form a picture. Well, does the Fed bring forward their tapering program? Do you think they do that? And what impact would that have to the markets?
Yeah, Brian, that's a great question. And obviously, we're going to parse every piece of economic data between now and the September meeting of the Fed and the 22nd, and whether they're going to announce taper then or if they push that off because of the weak jobs report we saw in August and wait until the November meeting. Consensus really sits right now that they're going to talk about it again, but announce it in November and put it into place in December. And oh, by the way, this is something, Brian, we've been talking about for 5 months. So whether it gets announced in September or November really won't affect markets much. I think we're already there. I think we're at that point where we cross the Rubicon and understand that the Fed is going to taper at some point this year. And I think that that's been baked into the markets very well. So I think that sort of reacting to good news is bad news is probably the wrong way to look at this. I think the market has had plenty of time to disseminate and digest the fact that the Fed is on a path to taper its asset purchases. It likely should, especially in the mortgage backs, and that likely starts before the end of the year. Whether that gets announced next week or whether that gets announced in November, I think it's baked into what investors are thinking about.
Why do you think it's baked in? Or where do you see that baked in? Is it the S&P 500? Is it the Russell 2000? Where is it?
Well, I would certainly tell you that it's in my mind, it's baked in because it's been discussed. It's the worst kept secret in all of monetary policy history, right? And as compared to when we actually had a tantrum about tapering back in 2013, that was sprung upon us, and it was actually not at a Fed meeting. It actually happened up in Congress where Ben Bernanke was answering a question to a senator and said, yeah, we'll likely start tapering our asset purchases. And the market went haywire for a little bit, then recovered very quickly. I think if you look at the pattern of market activity over the course of the last several months, every time it's been brought up, there's been diminishing effects on the fact that the Fed is likely going to taper. And I think the sequential improvement we've seen in economic data over the last 3 months proves out the case that they likely are at the right place to do that. So to me, I think it's much more of the activity that we've seen in the secular rotations in markets saying, well, if the Fed starts to taper, what does that do to interest rates? And I think where that will start to express itself in markets will be that as the yield on a 10-year gradually works its way higher above the 1.35, 1.4 level, we'll probably see a rotation back into the economically sensitive cyclicals. We've seen fits and starts of that action, but I think that the announcement of the taper will really bring that forward. And I think that's a healthier place to be.
Art, as we think about the market right now, what do you think is a concern or concerns that aren't being talked about enough right now? Because we've known for a while now about the Delta variant spread, about decelerating growth in terms of economic activity and corporate profits, and of course, with Fed policy changes and the announcement of tapering. So what do you think are still those additional risks not being discussed?
Well, I think the biggest concern we have is that we don't have a demand issue, right? And I think that's been pretty evident. I think the demand has been very robust. I think where we get more concerned is around the fact that aggregate supply is slower to respond than we would like. So things like semiconductors not coming back to levels that we need them at until sometime late next year, and all sorts of increased costs for containers and the holiday shopping season, and how much that's going to add, and how that kind of sticky inflation might affect profit margins. So I think the next level of concern will be more about how inflation affects margins and how much of it is going to last for longer than we anticipate. And that's probably the number one concern we have. Clearly, the Delta variant was the number one concern we had late July and all of August. I think that seems to be peaking and rolling over a bit, which is good news. And a lot of inflation indicators have actually started to calm down. The CPI was actually lighter than expected, but we just don't know how long these logistical bottlenecks persist, and that will obviously slow down satiating demand, right? So we don't have a demand issue, but demand hasn't been destroyed; it's been delayed, and we just don't know how long that gets delayed into 2022. But we think aggregate supply is gradually coming back in the fourth quarter, and that likely helps to elongate this economic recovery.
Or the retail sales report, I suspect will. We know it is surprising, and it may get those forecasters looking for these 10% corrections to happen at some point soon, over the next 6 to 8 weeks. It may cause them to revisit their analysis. What stocks do you gravitate towards? What names do you like? If the economy is moving past Delta, what do you like?
Well, I would say if the economy is moving past Delta, several things, right? I think that moving past Delta means you shift again back into some of the economically sensitive cyclicals. So certainly like the financials, and today's retail sales report is going to be good for the payment players, right? When you think about that, and they're all trading at the lower end of their range. I think that when you think about the other economically sensitive cycles away from the financials, you want to look at energy, and obviously that's had a nice return of late, a very volatile but nice return. You want to think about the industrials, the materials, et cetera. So things that are economically sensitive cycle are going to start to show improvement as we start to see the economy pick up in the wake of a waning Delta 19 case discovery. So I think that's exactly where we're at right now. You'll start to see the yield on the 10-year tick higher. You'll start to see a rotation in the economically sensitive cyclicals, and that likely comes out of what has been support for a long time, and that's the mega cap growth names.
And Art, how are you thinking about fiscal policy and the debates that are happening right now in Washington? Because we just had the House Ways and Means Committee approving a plan that would increase the top corporate tax rate to 26.5% from 21%. Is it still a little bit too early to be positioning for these potential changes, or how are you thinking about that?
Yeah, that's such an important question. When we try to navigate what's going to happen in fiscal policy, it's very difficult to preempt what eventually happens, right? I think that we're clearly going to see some increases in taxes across the board, right? But we just don't know the magnitude of that. And the numbers that have been thrown around have already come in significantly. We know that we have a very strong cohort of centrist Democrats that are not going to allow major changes in fiscal policy, right? And they're likely not going to allow major increases in infrastructure spend, right? So when we think about the headline numbers that we're hearing right now, what actually gets passed or is passable, even with a Democratic majority, is going to be something smaller than what's being discussed right now. So trying to get out in front of that and changing the way you set up your asset allocation or your investment plans is probably a big mistake. And making changes to your asset allocation model has always been a big mistake when it's driven largely by changes in tax code.
All right, Art Hogan, Chief Market Strategist of National Securities Corporation. It's always great having you on. Coming up, we've got the opening bell and a look at some of the major stocks making moves today. Keep it right here on Yahoo Finance Live.
Welcome back to Yahoo Finance Live. Let's hit some stock movers ahead of the opening bell today on Wall Street. Emily, we have to start with Cisco here. Holding an investor day yesterday afternoon, see the stock up about 1% here in the pre-market, but the shares did get hit. Cisco talking at length at its investor day about how they want to be seen more on the street as a software player. And right now, they're not commanding a software type PE multiple. I mean, shares of Cisco only trade about 17 times forward earnings. That is multiples less than the likes of Amazon, Microsoft, Apple, Google, you name it. So the street still doesn't see Cisco as a pure play software player. And then secondarily, I think the street is also a little disappointed with Cisco's outlook. Cisco looking for 5% to 7% sales growth over the next 4 fiscal years, looking for about the similar rate of growth in their earnings per share. The street was looking for close to 10% growth over the next 4 fiscal years. So some disappointment there in terms of Cisco there with its investor day.
Yeah, you're right, Brian. And I think the 2 points that you make really sort of feed into one another when we think about Cisco. Of course, the company is going to be investing in order to try and become this bigger software player. And that's something that's going to actually weigh on those margins, weigh on its profitability. And that's one of the big reasons that we are seeing Cisco delivering this forecast to have that revenue and that earnings per share, excluding some items, growth rate actually come in at about the same pace. But when we think about this company overall, this still is the biggest maker of computer networking equipment. It's long time been a proxy of business IT expenditures. So seeing that we do have that 5 to 7% at least revenue outlook forecast for the next 4 years, it still is pretty upbeat when we think about Cisco on the whole, especially given that this is such a mature player here in this networking space. And if we think about what the company is actually targeting, again, to your point on software and really building out that portion of the business, Cisco is saying that it's targeting having subscription revenue reach a total of 50% of total sales by fiscal 2025. That's going to be a target that I think analysts are really going to be focusing on as we get these next quarterly earnings calls, really seeing whether the company is able to hit that goalpost and really making progress towards that in the coming quarters. Brian?
Yeah, absolutely. And we'll put all these questions to Cisco Chairman and CEO Chuck Robbins, who's coming up later in the show. Definitely, I'm jacked up to talk to him. But I think overall, the street was looking for a little bit more in terms of margin from Cisco. If they're moving to that more profitable software model, where is that extra margin? We'll talk to Chuck Robbins all about it. We're also watching Beyond Meat. Emily, wow, quite the aggressive downgrade by the folks over at Piper Sandler.
That's right, Brian. If we take a look here at Beyond Meat, of course, the stock has been down 11% so far for the year to date, adding to those losses today. And if we take a look at what Piper Sandler really saying, the analyst there, Michael Lavery, saying that the company's all-channel retail momentum lags consensus expectations. And one of the big concerns here is on that food service estimate side when it comes to what Wall Street is expecting of Beyond Meat. Now, this is a company like a lot of these sort of dual and omni-channel food companies that, of course, has that retail side of the business, that side that goes into the grocery stores, and that has still been holding up quite well over the course of the pandemic, given the strength in grocery sales overall. But then, of course, you have that, going to restaurants, food service portion of the business that has, as Lavery is saying here, still been lagging and likely to continue doing so. And I think as we consider the ongoing Delta variant, the ongoing coronavirus concerns, and what looks like some more stay-in-place type behaviors among consumers, this is not necessarily a good sign here for Beyond Meat going forward.
Yeah, just further digging in here, Emily, really, I would say this is a savage downgrade. You don't normally see underweight ratings on Wall Street, especially with some of these hot, buzzy food companies. But the analyst noting here, which I thought was interesting, we believe current retail trends are running below levels needed to support consensus shipment expectations for the third quarter and potentially in the fourth quarter. And as you mentioned, Emily, tracking a lot of the good industry data here and really suggesting that Beyond Meat sales are just not trending where they are. And if that is the case, Emily, you also have to, I think, get a little worried about the restaurant space. It is a Burger King. It is McDonald's. They may not necessarily be super aggressive in the plant-based meat department just yet, but Beyond Meat has a lot of exposure to the sector. And if they're seeing slowing sales in this part, chances are the restaurants are also seeing slowing sales as well. And then, they also talk about this potential wild card that is Pepsi. Now, Beyond Meat inked a deal with PepsiCo several months ago to work on several undescribed or uncertain products, plant-based products, to this point. And those products may come out over the next 12 months, but the wild card is there. When you're working with a company like PepsiCo, they are a marketing and development machine. So if Beyond Meat can ride on PepsiCo's coattails, maybe it's pretty good.
Yeah, I think that's a good point here, Brian. And, again, I think really a lot to be seen here for a lot of these reopening trades. We don't often think about Beyond Meat being a reopening trade, but given its exposure to the restaurant industry, it does seem like its shares anyway have been trading in that category. Again, down for the year to date after a much stronger 2020.
And, staying on the food trade, I can't help but to giggle. I'm in a giggly mood today here, Emily, to see the ticker symbol Bros trending for the past 24 hours on the Yahoo Finance platform. I should have just broke out my Patagonia vest and went all bro here, because it's just funny to see that ticker. Perhaps a new meme stock has been born here with Dutch Brothers. Stock up almost 60% yesterday, up another 15% today. The company only operates 479 stores. It now has a market cap of about close to $2 billion, according to Yahoo Finance Plus. Really just interesting to see this market response, but not surprising. Market historically has loved these food plays, especially ones they can understand. And there we have the opening bell. I don't see any Dutch Brothers coffee in their hands. That is Forge Rock ringing the opening bell there on this Thursday on Wall Street. There we go, guys. Congratulations. Enjoy your day down at the New York Stock Exchange. But Emily, of course, the market's going to continue to watch this Dutch Brothers. And we had the CEO on yesterday talking about its business, the battle with the likes of Starbucks. Here's what he told us.
I think in most markets that we're in, we're probably a half a mile to a mile away from any trading area that's been developed by Starbucks. As we continue to grow, I think one is that our rewards app, we've had over 2.7 million people sign up for our app since February 1st. And I think that's a really good indication of, as we've gone into new markets and have people sign up and be part of the loyalty that is Dutch Bros, they get to experience the brand and some of the ways that we reward them for their continued support. Two is that we have to continue with our service model. I think that the big difference for Dutch Bros is that we're a beverage company, but we're really built on the backs of our people and the service that we provide every day in our stands.
And two little fun facts, Emily, on this. One, they are not baristas at Dutch Brothers. They are bro-istas. Yes, for real. They are called bro-istas. And then secondarily, I need one of these. There is no shame in my game here. I need a Dutch Brothers over here in Astoria, Queens. I mean, they're selling a drink called the Annihilator. 6 shots of espresso, Emily. Sign me up for that. I'm ready to go.
Oh, I don't know if my heart could take that many shots of espresso in one go. But I mean, just taking a look at Dutch Bros right now, it looks like we are on track to have another positive session for this company, up about 13% as we speak now that we have had the opening bell. Stock closed higher by nearly 60% yesterday. And to your point, Brian, this coffee chain, or this cafe and this beverage company, as they call themselves really, is so much smaller than a lot of these major competitors. I mean, Dunkin', for instance, has over 8,500 restaurants in 41 states across the U.S. Starbucks has nearly 9,000 stores in the U.S. alone, in addition to, of course, its very major international presence. And as you mentioned, again, Dutch Brothers with 470 or so cafes across 11 states. So, definitely a smaller player here, room to grow. If we take a look at the company's stats over the past year, same-store sales up about 2% in 2020 and overall revenue up 37% last year. And that's even as the pandemic did, of course, impact people's ability to go out, go in person to cafes. So the street here, at least, pretty upbeat on these prospects, at least in the first couple days of trading.
Long live the Broista. Now, the Dutch Brothers IPO, Emily, is only a small part of the 2021 IPO story, as we can see in today's Yahoo Finance stat of the day. Year to date, there have been 739 IPOs on the U.S. stock market. That marks an all-time record. The number of IPOs are up 231.4% year to date compared to the same time last year. Big year so far, potentially a big ending too, with the likes of Rivian and Allbirds potentially nearing IPOs. Big year for IPOs, no doubt about it. Coming up, the lack of clarity on the need for COVID booster shots continues. Yahoo Finance senior healthcare reporter Anjali Kemlani is back with the latest.
Welcome back to Yahoo Finance Live. President Joe Biden announced a plan last month to make COVID-19 booster shots available to U.S. adults 8 months after their second dose of a vaccine. But with 1 week until that plan is set to roll out, more debates have emerged about the need for this booster policy among public health officials, scientists, and regulators. Here to break it down for us is Yahoo Finance's health reporter, Anjali Khemlani. And Anjali, what's the latest on these developments in terms of this booster shot policy?
Well, I'm glad you asked, Emily. So we've got a lot to break down, but I'll try to condense it. Basically, in a nutshell, the scientific community is split over whether or not checking on antibody levels is the key requirement in order to determine booster doses. In addition, we're relying largely on data outside of the U.S. In the FDA documents that were released yesterday ahead of the September 17th meeting to discuss Pfizer's booster shot, the FDA scientists did note that they are relying on data from outside the U.S. that they have not independently verified and looked at. And that's really important when we're talking about understanding what the needs are for the U.S. and what the data really shows. There are concerns about whether or not this data is specifically relevant, if it's been done well, and what the underlying results really show. While largely speaking, we know that antibodies do wane, there is one part of the scientific community that argues that memory cells will play a role, and that's important as well. We did hear from Moderna President Stephen Hoge yesterday saying that really both the dichotomy, the idea that one or the other is important, is really irrelevant and a bit of a false argument. So as you can tell, this is shaping up to be a really interesting debate tomorrow, and we'll have more details on that after the vote.
And Anjali, you're also tracking some COVID-related news coming out of LA County.
That's right. LA has decided to require vaccines for anyone that's going to be really hanging out and drinking. So if you're going to a nightclub, a bar, brewery, winery, you will have to get a first dose by October and be fully vaccinated by November. And that is sort of joining what we've seen in other areas of the country where vaccines or proof of vaccination is required, or a negative test in order to enjoy sort of lounging in an area and eating or drinking. We saw that in New York with the restaurants and bars. We've seen that elsewhere across the country. And while we have seen that Delta surge sort of decrease or start to show some level of decrease, it really is the fall and winter, late fall and winter that experts are worried about because they anticipate there might be another surge. So these requirements are coming in anticipation of a new surge.
All right, Yahoo Finance's Anjali Khemlani, thank you so much for breaking that down for us. Coming up, shares of gaming stocks like Wynn and Las Vegas Sands are on track to post a third straight session of declines as regulators look to tighten their oversight of casinos in Macau. We'll have the latest on this news on the other side of this break.
Casino stocks such as Las Vegas Sands and Wynn remain under significant pressure on fears of tighter regulation by the Chinese government. Las Vegas Sands alone has lost nearly $5 billion in market value so far this week, according to Yahoo Finance Plus data. So what's next? Ben Lee is a managing partner at iGamix and is based in Macau. Ben, good to see you. Good evening to you over there in Macau. Look, I think a lot of investors were blindsided by this news this week, despite all of these casino companies warning about China government risk in their annual reports. My question to you is, what's likely to happen next?
Good evening, Brian. So basically, now that we've got the new concession tendering process underway, and I must stress that it's not a renewal, it's actually a new process. This consultation phase essentially triggers basically the process by which we will then put in place the new legislation for the new concessions. They will then award the tender, and technically it is viable and feasible that we may see the outcome of the new concession tendering process done by before the middle of next year, before the expiry of the existing concessions.
Ben, this is Emily. Thanks so much for joining us on this. And I'm wondering, assuming that this new concession tendering process actually does get approved and moves ahead next year following this public consultation period, if you're an investor in a Las Vegas Sands or a Wynn, based here in the U.S., what does this mean on just a sort of, practical basis for your investment in these companies with operations in Macau?
So for a long time, I believe most of the investors were lulled into a false sense of security in that, they were led to believe that being American stocks, being American operators, they are untouchable, and that because they've had such an outsized presence in Macau that, their removal or ejection may result in massive disruption. But, the decision we believe here in Macau is that the decision is not with the Macau partners, but essentially up north in Beijing. And the drivers for this particular outcome is more than just the local impact. It is a geopolitical issue. Now, the relationship between China and the U.S., as we know, have deteriorated into quite a fractious one over the last 4 to 5 years. And the concession tendering process was actually supposed to have started about 2 years ago, but it was put in abeyance, and we have had no information about what's going on. And I believe that it was possibly due to the fact that Beijing wanted to see the outcome of the last election. They may have thought that the relationships would have improved with the U.S., but it is what it is. Things have not really improved. And I think the decision has finally been made not to keep this issue in postponement anymore, but actually to trigger it and let it run its course.
Ben, is there one casino out of those ones we just showed on screen, is there one that is better positioned to survive this and come out the other side?
You would have to look at the local players versus the foreign operators. So when the original concessions were granted, there were only 3 concessions, out of which the Americans, the foreign operators, only obtained 1, which was Wynn. Now, that was a 2-to-1 ratio. Fast forward to today, we've got the sub-concession, which may or may not be legal, and the gaming academics and lawyers are still debating that. And the Americans have ended up with 50% of this dominant industry in the Macau landscape. So this is the first opportunity for China basically to reset the table here in Macau. Now, so with that in mind, you got to look at the 2 parties. You've got the local operators, and you've got to look at the foreign operators. So the local operators would you probably rank them in terms of their relationship with the Macau government, and more importantly, with Beijing. And then you've got to look at the foreign operators, what they have done in Macau, any history they may have had with the Macau government in Beijing, and how that would stand them in stead. So in terms of favorites, I'll probably be putting Galaxy as my local Macau favorite. Now, in terms of which foreign operators are likely to be at risk, there'll probably be Wynn and Sands because of their previous relationship with President Trump, and there are a couple of other issues as well, which I can't go into here.
Is it highly likely, Ben, that the U.S. casino operators just won't be operating in Macau anymore?
There is always that scenario, and I think that has never been priced into the value of the stocks. There are there are three possible outcomes. One, they get a new concession and they get to remain in Macau. Two, they don't get a new concession and basically everything reverts back to government under the terms of the old concession. Or three, which is probably a compromise solution, and that is for the American operators to be diluted out. They can still probably have the management rights to the gaming, but they may not necessarily have majority control. And I think that could be a possible compromise solution in a final wash.
I'm wondering, Ben, is this space overall, the Macau gaming space, still investable? And if so, is now the right time to go in now that we have had this rout in so many of these major names? Because already there has been a lot of pressure on the industry with travel constraints and the pandemic. So what is your overall expectation for this recovery?
So in the short term, in the next 12 to 18 months, the recovery is likely to be very, very slow because Macau has a zero COVID strategy, and which has been very, very successful to date. What we look for in the long term, and this is a scenario that we actually dive into last year, is that there are moves afoot to possibly introduce the digital renminbi as Macau's default currency. So I don't know if you know, but basically the default currency in the casino here in Macau is not our local currency, which is the patakas, but the Hong Kong dollar, which is freely convertible and exchangeable. And that in itself is an issue. So if the Hong Kong dollar is replaced by the renminbi as a default casino currency, that essentially would allow China to maintain control over the transfer of funds from mainland China to Macau. It basically would bring the whole of the Chinese market into Macau as a domestic mass market, something which we've never really had. And that basically is our blue sky scenario, if and when that happens.
Ben, I have to say, you probably just helped millions of investors on the Yahoo Finance platform right now understand this very complicated situation that appears to continue just to rattle these stock prices. Ben Lee, managing partner at iGameX, good to see you. Appreciate these insights.
Thank you.
All right, ARK Invest's Kathy Wood continues to cut her stake in one of her favorite companies. More on that straight ahead.
Welcome back to Yahoo Finance Live. It's time now for our Sazi take, and Brian will walk you through what he's watching in markets today. And Brian, this morning, you're taking a look at the latest on Cathie Wood's ARK funds, and it looks like the major ARK ETFs are unloading more shares of Tesla. What's the latest on that?
Yeah, Cathie Wood, I think, quietly making some news on one of her favorite companies, and that is, in fact, Tesla stock, and a company that essentially made her name in 2020. Nonetheless, Cathie Wood, her exchange-traded funds are selling more of that Tesla stake. Recently, just sold 81,600 shares as of Wednesday. That's about $62 million worth of shares. Now, month to date, Wood has sold about $266 million worth of Tesla shares. That's about 350,000 shares in total. Now, Tesla is overall, it's still one of Wood's largest holdings in her various ETFs. She continues to like the company. In fact, I just talked to her about this a week and a half ago. Take a listen.
Our new number, our base case for Tesla with this on the split stock is 3,000. The stock right now is a little over 700. On the old basis, that would be 15,000. So what that tells you is our estimate for Tesla's success has gone up. And the main reason for that is their market share, instead of going down from year-end 2017 to today, has actually gone up fairly dramatically around the world.
So it is a little surprising to me, Emily, to see Wood selling, or really just lightening the load here on Tesla so aggressively. And I would say it's somewhat aggressive here. Anytime you dump $300 million worth of stock, that is not chump change, as they would say here, despite Wood looking, or she sees fair value to $3,000 a share. Now, by the same token, I will mention, Wood has not hidden the fact that she likes to trim positions. You know, she's not going to hold on to these stocks for 20 years and not take any profits. She will take profits when she sees fit and allocate that cash into other places. But overall, I would say, Emily, it is a little bit of a red flag to those Tesla bulls to see Cathie Wood selling here. And
yeah,
look,
absolutely, Brian.
That's one of the red flags here. I mean, you have Tesla, you have her selling these stocks. You have to wonder, if you're a bull here, Emily, what does Cathie Wood see that you don't? Is she concerned about component shortages? This is something that Elon Musk warned about recently on Twitter, how that might impact Tesla's sales and profits for the balance of this year. Number two, you know, there is a lot of EV competition. We've been saying this for 2 to 3 years, but this is now starting to finally come to fruition. I'm getting ready to go out to Michigan in early October, spend a day with the General Motors team for their investor day. They're likely to talk up the barrage of electric cars they have coming out over the next few years. And then last but not least, Emily, bring on that Rivian IPO. It is likely that Rivian IPOs at some point this year, and now you have Tesla potentially competing for investors that love the electric vehicle story.
Right. And I think you make a lot of good points, Brian. And I think, as you mentioned, one of the big things that investors should keep in context with this headline news of Cathie Wood unloading more Tesla shares is the fact that, again, Tesla still does remain the largest holding in many of these major ARK funds. But I think as we take a look from an investment perspective here for Tesla, really has had quite a bit of a moderation in terms of its stock price this year compared to that 743% run up that we saw so far in last year in 2020. And, you know, year to date, we have Tesla shares up just 7% so far this year. Over a little bit of a shorter horizon, it has fared a bit better, up about 34% since mid-May. But again, I think these concerns about competition are something that investors are really keeping an eye on here. And the fact that, of course, one of the bull cases that so many analysts have been focusing on for Tesla is about automation, and is the fact that it does have this lead over other competitors when it comes to just the data that it has on its users in terms of being able to deploy software to its fleet, its existing customer base. And of course, just last year, the myriad of really catalysts that we had for Tesla that a lot of other automakers didn't. We had Tesla being included in the S&P 500, posting consecutive quarters of profitability, posting record deliveries when we saw the rest of the legacy auto industry really getting hit by the pandemic. And I think when you try to follow a year like that, it does make it difficult for a stock to really maintain that type of growth. So perhaps no surprise that we are seeing a little bit of profit taking here.
No, you're on the mark there, Emily. And lastly, I will just add too, at its core, what is Tesla? It is a high multiple growth stock. I'm looking at some data here now on our platform. Forward price to earnings multiple, 100 times. price to sales trailing 12 months, 21 times. You have price to book trailing 12 months. I hope I'm not putting anybody to sleep with this stuff, but it is actually important, 31 times. And I think if we've learned anything the past decade since the great financial crisis ended, anytime the Fed pulls back on liquidity, as they are likely to do over the next 12 months with their tapering program, that has brought more challenges for high multiple stocks. So potentially Wood is trying to get out in front of that here.
Absolutely. And again, Brian, we just flashed that 5-year chart for Tesla, and really staggering seeing that growth in the share price over the past couple of years. But we've got much more on the markets after this short break, and including a look at Bitcoin. We did have some comments out from Bridgewater Associates' Ray Dalio. We'll talk about what that might mean for the asset class. Keep it right here on Yahoo Finance Live. Welcome into Yahoo Finance Live on this Thursday, September 16th. I'm Emily McCormick, in today with Brian Sozzi. Julie Hyman will be back tomorrow. Well, we're about half an hour into this trading day, and stocks are moving to the downside. Now, about 90 minutes ago, we got August retail sales data out from the Commerce Department that beat expectations, and weekly jobless claims did come in slightly higher than expected, but still held near a pandemic-era low. Now, we'll also have a chat with the founder and CEO of Taiwanese battery swapping company Gogoro about plans to go public via a SPAC merger. It'd be one of the latest companies to join a crowd of the newly public firms we've seen so far this year. And later this hour, we'll have a chat with Cisco's chairman and CEO Chuck Robbins after the company's investor day yesterday. The firm gave a better than expected multi-year revenue forecast, but profit outlook came in just a little bit light. But first, we're sticking with the topic of the markets and the economic backdrop. And for this, we're bringing into the stream now Seth Carpenter, Global Chief Economist for Morgan Stanley. And Seth, it's great to have you on. First, want to ask about a recent note that you had on global trade. And you mentioned that we're really on the upswing as we continue to move through this recovery. Trade values and volumes are back beyond pre-pandemic levels, but we are still hearing companies talking about supply chain constraints and shortages. So what's your take on this dynamic that's playing out right now?
Emily, that's great. I think you hit on exactly sort of why our baseline view is constructive about the medium term, but simultaneously hitting on where the clear downside risk to all of these things is. For the past year and a half, the downside risk obviously has been COVID, and I think that continues to be the case. I think key points to be optimistic: global trade has recovered to pre-pandemic levels and beyond. We have a handoff from consumer goods trade towards capital goods trades, and that capital goods pickup in the CapEx cycle portends sort of a healthy medium-term outlook for growth. Where we see a shortfall still in global trade is in services, especially tourism. So what does that mean? That means if COVID stays contained and if travel restrictions get lifted, there's that much more room to grow in terms of global trade through services and especially tourism. But those are two really, really big ifs. And if COVID is not contained, if we continue to see these sporadic sort of flare-ups, then we won't get that boost from increased services trade. And worse off, I think we could see more disruptions to the global supply chain, especially in those countries where we see these really aggressive containment policies where they want to go for the so-called COVID zero. So baseline outlook is constructive. The risks, though, remain clear to the downside.
Seth, I let out a when that retail sales report crossed the wires this morning. How fast is the U.S. economy growing right now?
I think we're tracking somewhere around 5% annualized growth for Q3, maybe a little bit above that. It was a really strong report. We were even a little bit below consensus because our auto analyst who covers equity space was looking for a pretty big slump in autos. And it did come down, to be sure, but it wasn't as big as what we were looking for. Clearly, consumers have income. I think even with the cessation of unemployment insurance benefits, we're getting more jobs created, last month's print notwithstanding, to where overall incomes are growing. Consumer spending relative to income in a long run sort of relationship is still depressed. So I think there's lots of ways that consumer spending can still grow. And today's retail sales report, I think, put an exclamation mark behind that statement.
And Seth, is one read off of the retail sales report, maybe I'm reading too much into it, but is that we are starting to move beyond really the worst impact of the Delta variant, and we might be headed into an economic reacceleration into year end?
Yeah, I guess it's a little bit too soon to make that conclusion. Remember that for August, we did see a resurge in Delta variant. And when we get the rest of the data on the rest of services spending, we'll be able to see if there was a pullback maybe in some of those in-person services spending, shifting towards more spending in goods, which is overrepresented in the retail sales report. So I think it's still a little bit too soon to tell. Our view is, the fourth quarter should stay strong, but then as we get into next year, we'll see things start to moderate. But like we were saying, this strong report really does highlight there's two-way risk going on. There's clearly the possibility for the economy to outperform.
Given the economic data that we've gotten recently, between retail sales this morning, the mixed jobs data we've had recently, and inflation with that cooler than expected CPI data out earlier this week, what is your assessment right now of where things stand in terms of the Fed policy and timing for tapering?
Yeah, so our call still is that the taper announcement happens in December. There's clearly lots of probability on it happening in November. I think the soft jobs report should put paid to most speculation about September. And then I think it comes down to how strong is that jobs report that we're going to get before the November meeting. My view is the Fed policymakers, especially the core, Chair Powell and the rest of the center, given the soft jobs report we did getting one or two more extra jobs reports is going to give them that much more comfort that they're in the right position. And that's the reason why we favor the December meeting as the timing for the taper announcement. But I think one key thing to keep in mind is that the Fed policymakers really have in their minds tapering QE is not outright tightening. It is adding accommodation at a slower pace. And so as a result, I don't think they need to see the economy going at full bore for them to taper purchases. They want to make their, quote, substantial progress. And for jobs, even though we only got 200 and something thousand last month, if we have that pick back up to where we're in the 500, 600, 700 range for one or several months, I think that's going to be enough continued progress for them to be ready to start tapering.
Seth, you have a lot of experience in government, the former acting assistant secretary for financial markets if you could put that hat on for a second, how important is it to markets and that Fed Chairman Jerome Powell is kept in this job, that he is the one that has just taken this liquidity to a new level in the markets? How important is it that he is the one that carefully helps unwind it?
I think from a market's perspective, a lot of market participants see Chair Powell as a known quantity. They see him as very accommodative, very dovish. They're used to him. And so in that sense, continuity will provide a lot of comfort. Whereas in contrast, if there were a change, then I think there's at least a short run chance that there'd be a little bit of volatility. I suspect any volatility, if there were a change, though, would be very short lived because from my perspective, realistically, any replacement from the Biden administration for Chair Powell would be very, very, very close in terms of monetary policy specifically to Chair Powell. And so as a result, after the headline passes, after that initial reaction passes, I think people would start to dig a little deeper and ask, what would this person do in terms of policy? And I find it hard to imagine that there'd be a nominee who would be in any way meaningfully different from Powell.
All right, something we'll be watching closely, but thank you so much, Seth Carpenter, Morgan Stanley Global Chief Economist. Turning now to the topic of crypto, Bridgewater Associates founder Ray Dalio issued a sharp warning about Bitcoin at the SALT conference of hedge fund managers yesterday. Now, specifically, Dalio was pointing to the threat of regulation and what that might mean for digital tokens. Now, for more on this, we have Yahoo Finance's own David Hollerith here to break it down for us. David, what's the latest?
Hey, yeah. So I believe it was yesterday, Dalio said at the SALT conference that he's actually reoriented this. He said this a few times, that cryptocurrency, Bitcoin in particular, is a viable asset class and interesting for diversifying a portfolio. However, if it's too successful, then regulators will likely, ban it. So there's a lot of ifs there, obviously. So what too successful means is kind of, Dalio is a much longer term thinker. So it's sort of hard to understand it, but he does own cryptocurrency. He also said that he owns more gold than Bitcoin. So take that with what you will. But I think this comes in light of all these regulatory crackdowns we've seen in the industry. The hearing of Chair Gensler, chairman of the SEC, on Tuesday. And I think what we're looking to see is what will actually happen in terms of U.S. regulation. And I think Dalio is a little bit weary of that.
David, really at the heart of this, it continues to be that the government hasn't really established a clear or strong framework for crypto. It's time, right?
Yeah. I mean, I think it is. And, I've heard a lot of different perspectives on this. And, initially there's a lot of grumbling from people in the industry, but I've also heard some positive perspectives on, and one way to look at this is that the SEC has in some ways been a little bit asleep at the wheel on this. And for the past, 5-6 years. So they've allowed the industry to grow a lot more and now coming in and handing down clearer regulations. I think it helps cryptocurrency businesses a lot because, right now, I think what a lot of businesses need, if they do want to play, by the rules, is just clear, proactive guidance from the SEC.
All right. Thank you so much for that update. Yahoo Finance's own David Hollerith. And on the topic of crypto, join Yahoo Finance on Monday, September 27th from 12 to 1:30 Eastern for a Yahoo Finance special on all things crypto at the All Market Summit Plus Crypto Investing. We'll be tackling all the hot topics about how to get started in crypto, the best investment strategies, and what's next for this asset class. And we'll be bringing on major players like the head of the Blockchain Association, Kristen Smith, and Coinmetrics co-founder Nick Carter. Again, that's the All Market Summit Plus Crypto Investing on Monday, September 27th from 12 to 1:30 Eastern. And coming up now after this short break, we'll chat SpaceX's first ever all-civilian flight into orbit. Keep it right here on Yahoo Finance Live.
SpaceX launched the first all-civilian flight into outer space on Wednesday night from Kennedy Space Center without a hitch. Always a good thing. Yahoo Finance's resident space expert Inez Ferre is here with more. Inez, this is awesome.
It certainly is. I mean, the launch was flawless. It happened last night at 8:02 p.m. Eastern Time from Kennedy Space Center in Florida. This is the first all-civilian non-professional astronauts to go to space in the Dragon capsule, SpaceX's Dragon capsule. They're orbiting Earth for 3 days at an altitude of some 575 kilometers, or that's more than 360 miles. And that's higher than the Hubble telescope. That's higher than the International Space Station. And it's really a first on so many levels. It's a first all-civilian crewed mission, first person with a prosthetic limb to go into space, the youngest American to go into space, a 29-year-old physician's assistant from St. Jude's Hospital, the first female African-American pilot. Now, Jared Isaacman, he's the CEO of Shift4 Payments. He chartered this flight. He is the commander on that flight. He's also a pilot, a jet pilot as well. And he said, few have come before us, many will come after us, when he was inside that capsule. So this really opens up the space for civilians to be going up to space. And it's pretty astonishing. I mean, when you watch these images and when you see what SpaceX has been able to do with this.
Absolutely, Inez. Definitely an incredible feat here for SpaceX. But when we think about the other major players in the space industry, how close is the competition, like Virgin Galactic, for example, to its own civilian launch?
Yeah, I mean, it's what Virgin Galactic, what Blue Origin did. They did suborbital flights, and this is an orbital flight. So it's kind of like what I was speaking to one expert. He said it's kind of like apples to oranges, because really suborbital is very difficult, but orbital flights where you can go around the Earth, when you can go to the ISS, when you can go beyond the ISS, that is so much more difficult than these suborbital flights. And Blue Origin has been around roughly around the same time as SpaceX. So SpaceX has really kind of the leader in when we talk about this. And SpaceX also has different revenue streams. So of course it does also satellites. It takes up satellites. It's got government contracts. So even if SpaceX weren't to do so well when it comes to taking civilians out in its own capsules, it still has other revenue streams. But SpaceX is really the leader on so many levels. I mean, what these companies ultimately want to do is to have like an airline model for taking people up to space, whether that be suborbital or orbital space. And that's the ultimate goal, is to get there so that you or I can go and take a space flight. Now, of course, the cost to get there is significant. The resources to get there is significant. But, you know, Elon Musk has been interviewed about this. Just recently, he said the cost per ton to orbit has to come down. We have to get it to an affordable level in order for us to become a planetary, interplanetary species.
Inez, when is your trip? Is it this year or next year?
I wish it were this year or next year, but we'll see if it's in my lifetime, in your lifetime, Saz. I mean, that it very well could be. It's right now, people say, you know, it's for the wealthy. It's for the wealthy. Well, for cars, it was also for the wealthy as well. When cars first came out, it was for the wealthy, and then Henry Ford came along. So let's see what happens with space.
That's a very good point. Maybe someday going to space will cost $2, like taking a New York City subway. Inez Ferre, thanks so much. Coming up, EV battery swapping player Gogoro revealed plans to go public this morning, valuing the company at $2.35 billion. We're live with the company's founder on the other side of the break.
Welcome back to Yahoo Finance Live. The electric vehicle and battery making space has been heating up lately, and one electric scooter and battery swapping company is set to become the latest to hit the public markets. Earlier today, Taiwanese startup Gogoro announced plans to list on the Nasdaq through a SPAC merger in a deal that would set the company's value at over $2 billion. And that deal is set to close in the first quarter of 2022. And here to discuss more now is Horace Luke, founder, CEO, and chairman of Gogoro. And Horace, thank you so much for joining us today. First, want to ask, in terms of this deal, why now for going public?
Well, thanks for having me on your show. You know, we founded the company back in 2011, with the idea of making cities cleaner and better for the future generation. And it's really important to highlight how important two-wheelers are for Asian cities across the East here. Over 500 million vehicles are moving around every day. Over half of the individual commute miles done every day is on two-wheelers. And we've been, tackling this problem of transitioning to electric from the traditional ICE vehicle maker to now electric for the last several years here in Taiwan. And we've been, using Taiwan as a place for us to develop the technology, to refine our business model, and really prove it out. Before we started, there was less than 1% of the penetration into the vehicle space before Gogoro swap and go infrastructure. And now, after several years, we have over 2,000 locations where people can swap in seconds. And at the same time, we now grew the market 1,000% to over 10% market share. In comparison, if you think about where Tesla is today, they're about 3.5% of the US automotive market. And we've done a really phenomenal job building that. And within the EV space in Taiwan, in the market in Taiwan, we have 97% market share with our partners. And then we just, announced big deals, big partnerships with the world's #1 electric two-wheel maker, Yahoo, in China, which sold about 11 million vehicles last year. And then Dazhangjiang, the largest ICE vehicle maker in China also as well. Combined, they've sold 12 million vehicles last year, and then also a deal with Hero MotoCorp in India. All of which is really, think of us as like the EV of the Android of EV. We make technology and we make the platform to enable our partners to really accelerate the transition to electric. And with those big deals announced, we're taking this next big step to go public, to raise the necessary fund, to build the awareness, bring our company to a level where we can expand very, very quickly into these big territories.
Horace, there's only been 6 SPACs so far in the third quarter. That market has really slowed down since late last year. Why did you choose this structure?
Well, it's really interesting that you asked that. SPAC are designed for companies exactly like Gogoro. We have very solid revenues. We've been in business for many years. Combined between when we start to now, we've accumulated about slightly over $1 billion in revenue. We've been EBITDA positive since 2019. But our business model and our technologies, to be honest with you, is very, very comprehensive. It takes a little while to really understand, vehicles that uses battery swapping as a mean of refueling, and then you're buying a vehicle, but you're subscribing to the battery swapping as a service. That takes time, and when you usually go into an IPO process and you're doing a roadshow, you really get about 10, 15 minutes to tell your story. But in our case, we have complex partnership with, going into large markets. We really need time to tell our story, to really kind of get the investors to understand. And the good thing is, I think investment is like water. It flows to where the good fundamentals are. And in this particular case, we were targeting $175 million pipe. We oversubscribed to slightly over 250 million. So we're going to upsize the pipe. It's been super exciting to have strategic partners as well as existing investor. All the money that's going into the pipe is all primary. So it's really exciting time. We got really good reception in the market. And like you said, when there's only 6, the company like ours with a good fundamental and good strong future really stand out.
Yeah, interesting that you noted that you will be that you are EBITDA profitable this year. What will you do financially? What is your sales and profits? What does that look like? And where are you expecting to grow over the next 5 years?
Well, our biggest target right now, immediately ahead of us, is China. We'll launch in China in Q4 in Hangzhou, and then Wuxi quickly after that, and then about 5 or 6 cities immediately after that in 2022. The China opportunity is gigantic. There's about 290 million vehicles, and because of the 2019 regulation that was in place, to retire these lead-acid battery vehicles that are very environmentally damaging to now, lithium-ion batteries, which are much more powerful, much more efficient, but looking for a solution very much like Gogoro's. Working with our partner, we're going to deploy into their portfolio and transform the portfolio from either the traditional gas vehicles or the plug-in charging vehicles that are using lead acid to now the swappable battery version. In our forecast in 2024, we're forecasting about 1.1 million units in China. When you look at that against our partner's portfolio of this year, about 20 million vehicles, we're really talking about 5% penetration into their portfolio. So quite conservative as how we looking forward. But at the same time, we're very ambitious. I think, China is very binary. Either it works and really takes off. And in our case, we're working with the #1 electric vehicle maker in China, #1 ICE vehicle maker in China, #1 in the world when it comes to Hero MotoCorp. They're in 40 countries, who just celebrated, by the way, 100 million vehicles shipped. And then they put another aggressive target of another 100 million in just 7 years using electric and clean energy. So, I think this partnership was really, really going to take off faster than we think.
You mentioned your expansion plans in China and India, which are, of course, both major markets. But do you see this model, when you think longer term, working in the US or in North America or in any of these kinds of markets as well?
Well, our focus right now is really in Asia, where people, millions of people are living on top of each other, where the challenges of traditional plug-in charging that takes a long time to get, from low energy to high energy. Our swap and go system just overcomes all that with, not only the usability of that so that the consumer can go, not worry about range and not worry about where to go to get refuel, but also about cost economics too, because you don't have to buy the battery. Instead of paying for the battery when you buy the vehicle, you just don't pay for that. So the vehicle actually is about the same cost and same price as the ICE vehicle that they're used to buying. But at the same time, they can transition to electric, and then they pay for battery swapping as a service so that, over time, our customers are subscribers. And what's amazing about our model is that we're super sticky. The cohort stacks up year over year. We're very much like a hardware as a service business model. You sell the vehicle to get in, and then over a lifetime of the vehicle, we acquire 100% of the hardware acquisition revenue. So 1-for-1 over time. Making that a very, very, very attractive, I would say, attractive revenue stream coming in a very, very sustainable and reoccurring kind of way. But, I think, never say never. I think, for densely populated cities, we're targeting cities that where space and time is really hard to come by, and that's where we're going to go after. And of course, China, India, Southeast Asia, South America, those are, of course, really immediately in front of our periscope. But, I think, the cities around the world, that are large and with lots of people living on top of each other, they're looking for cleaner and better solution. Gogoro is going to come their way.
All right, Horace Luke, founder, CEO, and chairman of Gogoro, thank you so much for joining us. And coming up, we'll discuss how you should be thinking about retirement planning with a pension. We'll have Emily Hill, founding partner of Bowersock Capital Advisors, here to discuss. Stick with us here on Yahoo Finance Live.
I'm gonna call you Spirit.
See the all-new movie that has families cheering for more.
Spirit.
Let's run! I smell rule breaking. No!
Spirit Untamed, the movie, is spectacular and the perfect family film.
I made us something.
When did you have the time?
There's always time for friendship-based crafting.
Yahoo Finance Plus. Trade like it's not your first rodeo. Dive deeper with advanced analytics. Trade smarter with in-depth research reports and unique data. Make confident moves and grab your portfolio by the horns with Yahoo Finance Plus.
We're here in Jackson Hole sitting down with Kansas City Fed President Esther George.
So I think the Federal Reserve's commitment has been to being as transparent as they can.
The low inflation is a real challenge for us as central bankers.
It shows that we're data dependent and it shows that we're sensitive to what's going on in the macroeconomic environment.
We certainly should be able to communicate what our policy is.
The waterman is still living up by the lake, searching for his wife so he could bring her back from the dead.
This book says that he's immortal. I need to know more about it.
No one knows where to find him except me.
Hope is a powerful force. It made you see me.
Rent or own the latest movies with Verizon Fios On Demand.
The market may be looking a little shaky this month, but it has enjoyed a pretty solid 2021 thus far. So should you be making any changes to how you plan for retirement given the bid under stocks? Emily Bowersock-Hill is the founding partner at Bowersock Capital Advisors and joins us right now. Emily, good to see you on this Thursday morning. Look, so the market has enjoyed a really strong 2021. Things are getting a little shaky here right now. If one is nearing retirement, how should they be planning right now?
Well, in our view, the market has captured about 5 to 6 years of returns in 1 year. So while we aren't necessarily expecting a serious correction, I do think we have to be modest about our expectations for returns to especially US stocks in the future. So for people who are planning for retirement and especially are close to retirement, we're suggesting taking profits and rigorously rebalancing portfolios and also making sure you have enough of a cash cushion so that, and by that I mean, if you do not have a pension, 2 to 3 years of living expenses so that you will be in a position to ride out a major correction or bear market when those finally occur.
What's the number one concern that your clients have been bringing up to you recently, and what have you been telling them in order to position for this kind of risk?
I think people generally are, unlike back in 2007, when I think there was a lot of optimism about market appreciation continuing, my clients are generally skeptical and they're sort of astounded that the market has continued to rise. So I don't have a hard time talking people into rebalancing their portfolios. I don't see a huge amount of greed out there.
Emily, are you starting to get a lot more questions now on how from high net worth households about the threat of higher taxes, and what should they be doing if they are concerned about higher taxes?
It's been very interesting to watch, and I think it's hard to tell at this point what's going to come out of Congress. I do think that now, especially for high net worth clients, is a time to be thinking about, what would the implications be for a drop in the exemption amount, which I think is possible to happen. I think it's looking less likely that the step up in basis is going to be eliminated. And I do think, yes, I'm getting a lot of questions about it. Really, we knew something like this was in the works, so people should have been talking about this for the last year. So most of our clients who are in a situation where they need to take action are, prepared to do so pretty quickly.
Emily, one of the things you pointed out in a note is that, fewer and fewer clients actually have a pension that they can rely on for retirement, and that Bowersock, one of your goals is to create a portfolio that acts like a type of a pension. And I'm wondering, how would one go about doing that on their own, and what's the benefit of structuring a portfolio in that way?
So, very good question. It used to be 20, 25 years ago that a pretty large percentage of the American public had a pension in addition to Social Security that they could rely on. Those were the days when you'd work for General Motors for, 25 or 30 years, and then a substantial amount of your retirement spending was predictable and, and at least reliable. Fewer and fewer people have that. There's still some really, high-end law firms that provide a predictable pension, and some companies do that. But one of the things we try to do for those people who no longer have a pension, and companies in general have tried to move the risk onto their employees by using, instead of a defined benefit plan or a pension plan, you having a 401k plan instead. So, that obviously can allow for a lot of growth, but you can't be certain that at age 65, you are going to have X number of dollars of an income stream coming in. So how do we address that for the majority of people that don't have a pension? It used to be that you could provide that relatively predictable cash flow by using fixed income, CDs, tax-free bonds, investment-grade corporate bonds. But as you've seen, interest rates have plunged to such an extent that you basically cannot make, you're going to get a negative real return in bonds over the next 5 years. So you can't rely on that income stream. So what we encourage our clients to do is to come up with a pension alternative. And there are a number of options for that. My first choice is typically a private investment. Many of these, unfortunately, are only available for qualified purchasers, which is a qualified purchaser is someone with $5 million in excess of their primary residence. And that would be a private lending fund, private real estate fund, an infrastructure fund. If you are in the category where that is possible, there are options like owning rental real estate in a stable real estate market where you have a different kind of cash flow. It's basically cash flow diversification. Leased farm ground would be another example. One option is annuities. Those tend to be quite complex and expensive. And so it's usually not my first choice, but in some cases, they can make a lot of sense.
Sure. Well, it sounds like this millennial will be working to the age of 100. No pension plan here. We'll leave it there. Emily Bowersock-Hill, founding partner at Bowersock Capital Advisors. Appreciate the insights this morning. Cisco just made a big pitch to investors that it should be viewed more as a software company. We'll talk all about it with Cisco. We'll talk all about it with Cisco's chairman and CEO, Chuck Robbins, coming up next. Cisco wants Wall Street to think of it as a growth company with exposure to fast-growing sectors such as software and hybrid work. That was the pitch to investors on Wednesday afternoon at Cisco's Key Investor Day. Joining us for more is Cisco Chairman and CEO Chuck Robbins. Chuck, always nice to see you. Thanks for taking some time this morning here. My question to you is I think, pretty simple here. Do you think Wall Street is misunderstanding Cisco?
Well, Brian, first of all, it's good to be with you, as always. And I think, look, what we tried to do yesterday was basically remind them of what we told them in 2017 and that we actually delivered on our execution there to give them more visibility to this software transformation that we've been driving. When I took over, we had $3.4 billion in subscription software at the end of last fiscal year, which ended in July. We were roughly around $12 billion, so we've made a lot of progress. And also to just highlight that so many of our customers right now are on the front end of multi-year investment cycles around, to your point, hybrid work, hybrid cloud, the 5G infrastructure build out, the progress we've made in selling into the infrastructure of the major cloud providers, and edge, IoT, all of these we believe are going to be tailwinds for some time to come.
So do you think the street, Chuck, is just too focused on legacy Cisco?
Well, I think what we're trying to do is give them the metrics that they actually need to actually think about our valuation in the proper way. And so I don't blame them. I think we just have to make sure we continue to give them the information they need so they understand the transformation. Scott yesterday announced that we were going to be giving them new metrics around percentage of subscriptions in our revenue, ARR, our RPO metrics. And all of these are metrics that software companies tend to provide. So I think as we do that over time and as we execute against what we told them we were going to do, much like we did against 2017, I think we'll be fine.
Let's talk some really interesting numbers at Investor Day, Chuck. One that stood out to me among many, currently your total addressable market, the way you see it, $260 billion. But looking out longer term, you see it reaching $900 billion. How do you close that gap?
Well, I think if you look at what our customers are doing, again, around the areas that we just talked about, this pandemic has really highlighted the incredible need for technology modernization, the need to have your infrastructure ready for this adaptable hybrid work model of the future, to have your infrastructure more ready for the hybrid cloud world where you have applications in public cloud, private cloud, SaaS applications, the distributed world we're going to see with all the employees and apps and data everywhere. And so I think that as you look at these trends and the fact that we're in the early innings of the 5G transition, we're in the early innings of this 400 gig architectural transition that we see in the cloud providers moving into the enterprise, we just think there's a lot of opportunity for us, and we're really focused on trying to get the technology and the outcomes that our customers are trying to achieve as fast as we possibly can.
Yeah, a large piece of that pie that you talked about yesterday, $500 billion market potential, future of work and automation. I know you have the WebEx platform, but where else do you play in that market?
Well, when you think about the future of work, it's much broader than just WebEx. It's meetings and hybrid work for sure, but it's video devices, it's new network infrastructure to accommodate. Think of the home office now as a small branch, and you have to look at it and be able to deal with it in the same way you would a small branch. You need to manage traffic coming out of the home and going to the cloud. You need to be able to do troubleshooting in your employees' homes in ways that you never had to before. The security architecture that you need for hybrid work is completely different as we go forward. As our employees come back to the offices, there's technology that we can use to ensure the safety around social distancing and other aspects that we want to make sure we're focused on as they come back. So it's a huge market, and IDC actually laid the numbers out, and we think there's a lot of opportunity for us, and that's what we've seen. We saw in Q4 our product order growth was up 31%, the highest we've seen in a decade, and a lot of that was around these categories that make up hybrid work.
Yeah, so I'm hearing what appears to be a different Cisco starting to materialize. Are there, given your, I would say, sharpened focus on software and recurring revenue, are there businesses inside the Cisco portfolio that no longer fit?
Well, Brian, we've always been looking at our portfolio, and we've looked at where we needed to divest businesses. We've done a lot of that since I became CEO, where we where we need to add new capabilities to our platform. But a lot of our software businesses are connected to, cloud management of a network piece of hardware. So there's a lot of integration. And if you just think about what I just described in hybrid work, the architecture that's required across security, across collaboration, across networking, across sort of analytics and insights and troubleshooting, all of those need to be brought together so that our customers, again, they want the outcome. They don't want to be systems integrators. They just want you to help them get to where they need to be. So we're actually really pleased with the portfolio we have, and we think we're probably in the best shape we've been in a very long time.
There was a little disappointment, Chuck, I would say, amongst analysts on the longer-term outlook. So 5 to 7% longer-term revenue growth over the next 4 fiscal quarters. You're looking for something similar in terms of earnings per share. Now, the street was looking for about 9%. Is there something holding the business back right now on why you wouldn't be growing quicker?
Well, there's two things we talked about. First is that if you look at that TAM that we discussed, if you look at these major transitions that are occurring, we want to be able to invest for profitable growth. That's our plan. And I'll give you an example. 5 years ago, we started investing in new silicon capabilities that led us to build new systems that enabled us to insert into the cloud provider's infrastructure, which we hadn't participated in for forever. And so it proves when we invest, we can actually deliver technology that can drive growth. The second piece of it is for some period into the future, we are experiencing higher costs in our supply chain. So our gross margins are a little pressured by the COGS increases that we see right now, and that's going to be with us for a period of time. So we thought it was prudent from both an investment area and some of the pressure we see in the supply chain to make sure that we guide it appropriately, and that's what led us to the 5 to 7 and 5 to 7.
Are you able
but we
to
would
push through?
expect, Brian, over time, as a supply chain improves, and obviously software is a bigger percentage of our revenue, we would expect that to get better.
Have you been able to push through price increases on this environment, just given the inflation you are seeing?
We have done some targeted price increases, but really only at the areas where we felt them. We're not trying to leverage price increases to drive revenue growth or anything like that. We're really just trying to pass through. And our customers largely understand it right now because, candidly, most of them, if they're in any sort of business that has a supply chain, they're doing the same thing. And so we have been able to push some through.
Chuck, what's your read on the global economy here? Since we last spoke, I would say global growth has ticked down a noticeable amount in the U.S. and China. You also do business, of course, in China, in Europe. What's your read on the global economy?
I think that, it's healthy, but obviously the comparisons are going to become tougher as we move forward. So I think you got to just look at the math and make sure you don't read too much into a mathematical change. But from what we see right now, the spending from our customers is very balanced. It's balanced across Asia, it's balanced across Europe, in the United States, and it's balanced across our customer segments: enterprise, public sector, service providers, as well as our commercial or our mid-size and small customers down. So from what we see, it seems to be very balanced on a global basis right now.
All right, we'll leave it there. Cisco Chairman and CEO Chuck Robbins, always appreciate the time. Have a great week and enjoy that football this weekend. All right, and we will be right back with another look at the markets. Do stay tuned.
Welcome back to Yahoo Finance Live. Well, we want to take one more quick look here at the market action before we turn it over to the 11 a.m. hour. We are seeing stocks losing steam and accelerating to the downside. And we have all 11 of the major S&P 500 sectors so far in the red today. And the consumer staples, energy, and material sectors are the big laggards. Now, if we take a look at the Dow, we do have that off down by about 250 points. Shares of Coca-Cola, Amgen, and Procter & Gamble, really the big underperformers here. And all of this is coming, of course, after we got that actually better than expected report out from the Commerce Department on retail sales. Those rose by 0.7% in August compared to the 0.7% decline that had been expected. Although when we take a look here beneath the hood, again, some of those categories that gained were those non-store retailers, those e-commerce outlets, and grocery store sales. So pointing a little bit to a bit of decreased consumer mobility here as we had the coronavirus's latest spread. But Brian, as we take a look at the market action, I know there's one stock in particular that you're looking for, and that's Cisco.
Yes, Emily, I'm still digesting everything that Cisco Chairman and CEO Chuck Robbins just told us here on Yahoo Finance. Really, I think two quick takeaways. One, that fits nicely, I think, with the better than expected retail sales report. Perhaps, the economy is starting to move finally a little bit beyond the Delta variant. Robbins telling us that product order growth looks pretty good for him, for his business. Also, number two is just from a pure stock investing or from an investing perspective, perhaps it's time for a Cisco re-rating on its stock. We mentioned at the top of the show, Cisco shares currently traded about 17 times forward earnings. That is more of an industrial multiple, or a multiple more reflective of a company that just sells routers and switches like they did 10, 15 years ago. They still do it, but they're also now operating in a software space. So perhaps Cisco deserves a multiple over 20 times. Or maybe they should be compared more consistently to Microsoft and Apple and Google. Unclear, but something investors should be watching out for moving forward in Cisco as they digest what the company said yesterday at its big investor day. But that's it for myself and Emily McCormick. On the other side of the break, Zach Guzman has you for the next 2 hours on Yahoo Finance Live. Do stick around.
Welcome into Yahoo Finance Live. Happy Thursday, everybody. As we cross the 11 a.m. Eastern time, we are seeing the markets sell off a bit here. I'm Zach Guzman, happy to have you joining me for our hours on Yahoo Finance. As you can see, the Dow here off more than 200 points as we get some mixed economic data, perhaps shifting the twilight zone that we've seen where worse has been better, but unexpectedly strong retail sales, at least the last clip. And initial jobless claims rising ever so slightly. We'll break down both those reports for whether we're reaching a turning point in this recovery in just a second. Plus, Congress making progress on ironing out what tax hikes might look like to pay for Biden's $3.5 trillion spending surge. Why one watchdog says Democrats could be pushing through a big cut, though, for America's richest families. An electric automaker Lucid catching a boost today on a bullish Bank of America note. The analyst behind that will join us to break down some supply issues he's seeing in the EV space and why Lucid looks poised to win. But first, want to kick things off as we are seeing the Dow and the other markets, other indices here pull back a bit on the stronger than expected retail sales report. I don't necessarily want to connect those dots just yet. We'll save that for later on in the show. But for more on what we learned in the latest retail sales report, I want to bring on Yahoo Finance's Emily McCormick to walk us through that. And Emily, I mean, when we look at it, it's interesting because it comes in a slate of pretty weak economic data that we've gotten. So this would be a break from that norm.
That's right, Zach. Definitely a break from some of that weaker than expected data we've gotten recently because retail sales did unexpectedly increase in August after dropping in July. And that does suggest that consumers held up more strongly than expected despite that latest wave of the Delta variant. But the caveat here is that the categories that saw the biggest sales gains were those that are really more tied to stay in place type behavior. Now, overall, taking a look at this headline number, retail sales were up 0.7% in August on the month. That was versus a drop of the same margin that had been expected. And that also came after a 1.8% drop in July, which was downwardly revised from the 1.1% decrease previously reported. So again, definitely a mixed report when we think about that month-to-month data. But as I was mentioning, taking a look here by category, a lot of the sales increases were among those associated with people staying in place. We had categories including non-store retailers or those e-commerce outlets posting notable monthly rises. That category specifically was up by 5.3% in August. And meanwhile, we also saw grocery store sales up by more than 2%. Now, on the flip side, we saw a lot of those sales categories associated with people going out, showing a little bit more moderation here. We had food services and drinking places sales flat on the month, and clothing and accessory store sales increased by just 0.1%. So that really puts in perspective the type of spending behaviors we've been seeing among the consumer recently. But overall, economists have been relatively upbeat on the whole about this report. Ian Shepherdson of Pantheon Macroeconomics wrote in a note this morning, quote, "Upside surprises on this scale don't come often, and this one indicates a real degree of resilience on the part of consumers," end quote. And then finally, do want to highlight one other piece of weekly economic data that we always keep an eye on, and that is weekly unemployment claims. Now, we did see those come in a little bit higher than expected at 332,000. That was off the previous week's 312,000 and was a little bit higher than expected. But again, we are still seeing an overall downward trajectory here, especially over the past year and the year to date. And if we take a look at the number of individuals still claiming unemployment benefits of all types, that includes state and federal benefits, that did tick up a little bit as well in the latest data, up by nearly 180,000 from the prior week to 12.1 million. But again, we aren't likely to see in the data at least a decrease there until the data actually encapsulates the period beyond September 6th when those federal enhanced unemployment benefits expired at the national level. So something to keep an eye on as we continue to get these weekly reports. Zach?
Yeah, still, I mean, as that chart shows, still we've come down a long ways since earlier in the pandemic and moving in the right direction. So at least there's that optimism. But Emily McCormick bringing us the latest there on both those data fronts. Appreciate that. I want to turn to kind of how this changes maybe the outlook that we have here when it comes to growth and this recovery. Of course, it's stalled out as we've seen the rise of Delta variants. We've been discussing boosters and what that might look like and rolling them out to protect Americans and everyone else really across the globe. But what does it mean more so for how the Fed might be thinking about this recovery? And for more on that, I want to bring on Mark Hamrick, Bankrate Senior Economic Analyst, joins us right now. And Mark, you know, part of the reason why I mention some of the twilight zone that we've been seeing is that equities had really been rallying off of weaker underlying economic data, I think because a lot of people were expecting that gives the Fed more reason to stay accommodative for longer. But what do you make of the data Emily just highlighted there if we are to see maybe a bit of a stronger rebound here on the retail sales front amidst weaker data that we've been seeing?
Well, good news is always welcomed. And so I think today's news was on balance good news. Also, we had a nice increase in the Philly Fed, yet another regional Fed survey that was looking up. And it's also important, as you said, Zach, to acknowledge just how far we've come, let's say, in the last year or so. This jobless claims report marks exactly a year and a half since the downturn began that was related obviously to the pandemic. And, we can easily remember how horrific the economic data was in those early days, going back to the 22 million jobs lost in March and April of last year. And whether you look at continuing claims or the total number of individuals on some form of unemployment compensation or the new jobless claims, those are down by somewhere between 30 and 60% from a year ago. So we're clearly making progress. And with the jobless claims here lately, we've also had some increases or volatility tied to tropical storm season, with, of course, the biggest increases being seen there in the state of Louisiana over the past couple of weeks. So I think that we're going to continue to probably have some restraint to this portion of the economic recovery, with the hope that with more and more people getting vaccinated, with the Delta variant seeming to be peaking, sort of migrating that peak from the south and eventually to the northeast, that perhaps we can get to a better place with all of that. But as we know, the pandemic has been able to produce more than just a few surprise storylines over this past more than year and a half.
Yeah, and I guess that's kind of the big question is earlier in the pandemic, obviously the unemployment claims were far higher, but you did have the support there, I guess, coming from the government. We've seen that roll off now, and the concerns around whether or not, if things do get as bad as we've seen in past winters here in the pandemic, last winter, how bad it could get for consumers out there when it comes to maybe pulling back right at a time when a lot of analysts have been expecting to see a boost in spending.
Obviously, you're right that some of the tailwinds that were related to federal stimulus are basically absent now, the one exception of being the child tax credit payments, which will continue on through the end of the year, and that's not nothing. But the other part is we have to remember that we are continuing to see improvement in the macro economy. The unemployment rate now getting pretty close to 5%, down from the peak of nearly 15 at the official level. And we made more progress there, even though the August employment report wasn't, let's say, anything to write home about per se, but obviously the progress was seen with the unemployment rate. And there is an unintended consequence here, Zach, of sort of having this restraint in the recovery at this point, which you touched on with respect to, what will the Fed do or how will it do it? And that is that we're essentially pushing out the recovery a little bit more through 2022, and we don't know how the whole federal spending piece is going to emerge with respect to not only the infrastructure bill, but the so-called soft infrastructure bill, which doesn't seem to be destined to have a $3.5 trillion price tag attached to it. But I think there's reason for optimism, and science does seem to be prevailing, even though not all individuals are dialed into science and facts in this environment. But that is sort of the order of the day, and we are making a great deal of progress with respect to, I think, putting the worst of the pandemic behind us.
Yeah, that is the hope. And obviously the hope is that people do still pay attention to the science and the facts here driving some of the policies we've been seeing in this pandemic. But just to kind of wrap things up here, I mean, you've been kind of watching how the economy and the stock market here have kind of, been leading one another, maybe when you think about the timing of these recoveries and where we're at now. You talked about maybe the Fed's timeline there and really pushing to see when they're going to start to taper. But we were having this discussion pretty much all week in the way that the Fed has done a pretty good job, depending on who you talk to about, I guess, telling people that this is going to come. They've been pretty clear on their timeline. So, I mean, when you think about taper tantrums and what we saw in the past, I guess those concerns seem to be out of the window now, given the way that they've telegraphed it.
Well, I would never say never with respect to the prospect of a possible tantrum of some kind, or just a correction that is appropriate just over the course of time. And I don't necessarily mean a 10% decline, but just the normal volatility that we haven't been seeing here lately in the stock market. But I think you're right. I think the Fed has learned from some of the past, if you want to call it mistakes, with respect to withdrawing stimulus or reducing stimulus over time. And obviously, Chairman Jerome Powell is trying to be quite cautious with all that. And I think for investors, one of the big takeaways here, maybe two, is that the Fed is continuing to supply accommodation, perhaps just not as much. Those monthly asset purchases aren't going to go away in total this year, and interest rates may remain low for quite some time, particularly if inflation truly is transitory. And then the other part is, where are you going to put your money for the long term? Interest rates and return on savings still very low, and so equities remain the best bet for the long term for everyone who needs to save for retirement. And obviously, we've seen some enthusiasm with respect to that across cohorts with innovations in fintech and the like.
That's been interesting to watch, too, in terms of how those expectations, particularly around inflation, have changed so quickly. But Mark Hamrick, Bankrate Senior Economic Analyst, appreciate you coming back on to chat with us today. Be well. I want to turn our attention over to one ticker we are watching in the session today. That would be faux meat maker, Beyond Meat, seeing some pressure in the session. As you can see here, off by more than 5% on a downbeat note coming from Piper Sandler. Michael Lavery authoring that note there, cutting the stock to underweight after being at neutral for a bit of time, cutting his price target to $95 a share after noting that he expects the growth in their next quarterly update that comes in November to be a bit weaker, looking at all channel retail momentum, which he says lags consensus expectations. Not an optimistic note here for the vegetarians and the vegans watching, as Beyond Meat shares fall by about 5%. Going to take another quick break here on the show, but when we return, digging back into the timelines around boosters as the FDA raises some new questions, echoing questions being raised at the World Health Organization about whether or not boosters are actually needed. We'll discuss that in 2 minutes. Stay with us. Welcome back. As we've been watching play out this week, an interesting timeline around COVID vaccine booster shots as the Biden administration continues to push forward with wanting to be prepared to get those out for Americans who might need them. And I say might because even the scientists now behind the research into boosters are a bit skeptical that they are that necessary. First, we heard from the WHO talking about maybe holding off on boosters, and now the FDA raising questions around that too. And for more on where boosters could be going from here, happy to bring back in Yahoo Finance's Anjali Kamlani, who has more for us today on that. Anjali?
That's right, Zach. So we know that there has been basically a growing discussion and controversy around the idea of whether or not the U.S. needs to broadly open up booster doses for the general population. We heard from the FDA. Scientists released documents yesterday touching on the idea that the data that's being used, especially in the case of Pfizer, which is going to get that review tomorrow, that the FDA has not independently reviewed or verified some of the underlying data or their conclusions. And in general, the studies are known to have either known or unknown biases that can affect their reliability. This is especially in regard to the Israeli data. We know that that has been one of the key reasons why Pfizer has been pushing for booster doses. And that is based off of a relationship that Pfizer already created with Israel. The country did have actually pay a premium and also a specific contract to share a lot of their data with the company in order to have basically observational studies ongoing to see what was happening with the vaccines, with the variants, and with the responses there. Meanwhile, we also heard from Moderna President Stephen Hoge yesterday. The company is also ready to apply for a booster authorization. And he noted that really it is still a discussion. He sort of takes the stance that it's really unknown who specifically would benefit the most, but leaning towards sort of the elderly and immunocompromised population, the latter of which we already know has been authorized. So a lot of debate right now on who should really be prioritized in this booster debate. It's safe to say that the decision tomorrow is going to be just as big as when the initial vaccine was authorized last December.
Yeah, and Anjali, I mean, as we've seen that booster debate continue, the WHO really stems from the idea of maybe hold off on boosters while we get these companies focusing in on the countries that have not vaccinated, even with their first dose, a large swath of their populations. But for those here back in the U.S. that have been vaccinated, we've seen many cities impose restrictions in terms of where you can go if you haven't been vaccinated. Of course, that's been in place in New York for restaurants and bars now for weeks. But L.A. County also looking to join in on that.
That's right. LA announcing that starting tomorrow, they're going to require that anyone going into a bar, nightclub, basically anywhere that you hang out to drink, including breweries and wineries, will have to show proof of vaccination. This is really following a trend that we're seeing nationwide, as you mentioned, New York as well. There are other places that have rolled out at least a masking requirement. So that's sort of the other option that is out there, the other strategy being used. And this all comes at a time where we know the administration of President Joe Biden himself saying last week that businesses should be looking at requiring a vaccine. So a really big push to get more protection in the broader population, especially as we know the late fall and winter months are going to prove pretty much a test against whatever immunity we've built up. So it's going to be really interesting from here on out to see what that timeline looks like and how this race and this push to better protect the population ends up looking.
Anjali Kamlani keeping us posted on all the updates there. Appreciate that. Going to take another break on the show, but coming up, digging into that $3.5 trillion spending push from President Biden, how we're going to pay for it, learning more about the tax hikes attached to it, and potentially another push here from Democrats to give a tax break to some of the wealthiest Americans. We'll put politics aside and dig into the numbers with the Committee for a Responsible Federal Budget on the other side of the break. Stay with us. as the Biden administration continues its push for their $3.5 trillion spending bill, we are seeing the sausage get made on the tax side. The biggest set of U.S. tax increases in what is a generation, people are calling it, as the House Ways and Means Committee pushed forward with $2.1 trillion in new taxes focused on not just corporations, but also America's wealthiest. A lot of questions about whether or not it's going to be enough to offset some of the costs. And for more on that, happy to welcome into the program once again, Mark Goldwine, Senior Policy Director for the Committee for a Responsible Federal Budget, joins us here. And Mark, I mean, we've been talking about it, trying to watch and see what kind of increases are going to come. A lot of people pointing out it might not be as progressive as what even President Biden wanted initially. But what do you make of, I guess, this being enough to fund that $3.5 trillion?
Well, they're not quite there. Look, the Ways and Means Committee has put forward about $2.3 trillion of tax increases. They actually are quite progressive overall, mostly from the rich. They also plan to have some spending reductions from healthcare savings. We don't know how much, maybe 500 billion, 400 billion when it's all said and done. That's not going to quite cover the $3.5 trillion, but it's at least a good start.
I mean, when you say good start, I mean, are we expecting more to come here to kind of pay for the rest? Or I mean, these things are never really paid for fully, as you know better than I do. But I mean, what are the expectations in terms of how wide that gap might be?
Well, look, I'm an optimist that they may add stuff as this goes to the Senate, but I think the more likely approach is they're going to reduce the amount that they're spending. We've heard from enough members that $3.5 trillion ain't happening. So if they can keep this $2.3 trillion of tax increases and get the spending down to $2.3 trillion, then we're set. Then we have a fully paid for bill.
And how, I mean, how does that kind of match up with expectations when all these conversations were beginning, right? We've seen moderates on the Senate side, Joe Manchin being one, really talk about not wanting to increase spending that much. But I mean, the gap seemed wide when these discussions began. So to get here now in the timeline that we've seen, what do you make of that?
I mean, this is going to be a Herculean task. Look, they've basically made about $5 trillion worth of promises, of things that they said they want to do. They're trying to fit into $3.5 trillion, and then they're getting pressure to reduce that to maybe $1.5 trillion. So this is going to be a huge slog just on the spending side, and that's before we even get to the pay-fors.
There is another key thing that people have been watching, maybe not talked about a lot, which is the SALT cap reversal here. It's something that's pretty important for people who fall in Democratic states with high taxes there. And getting that change, as you guys have been pointing out in your research, it seems that it would really only benefit the rich that don't take that minimum deduction there in taxes on that front. So talk to me about what you've seen play out and what we're expecting Democrats to do with that push.
That's right. Maybe the biggest hypocrisy of this whole thing is Democrats have spent the last 4 years complaining about regressive tax cuts for the rich, and now they want to push one of their own. Not all of them, but a number of Democrats are pushing that we lift that $10,000 cap on the state and local tax deduction. Now, the issue here is most people are in the standard deduction. Everyone in the bottom 60%, nobody is getting SALT and nobody will get SALT. Almost all of the benefit of this goes to the top 10%, mainly the top 1%. If you're in the top 0.1% of Americans, you're going to get an average $150,000 tax cut. If you're in the middle, $15. $15 versus $150,000. It is just mind-blowing they're even talking about this kind of tax policy.
Yeah, and it's maybe mind-blowing that we haven't seen pushback on the Republican side yet. As we were kind of discussing, of course, maybe that's because they want to wait until it gets through to have something to attack. I don't know, but just your guys' research lays out exactly how much some of that revenue would be able to pay for rather than going to those families getting the tax breaks if they kept them in place. You'd be able to pay for quite a bit of what the progressive Democrats are pushing for, including free community college, universal pre-K, affordable child care. I mean, it sounds like a lot of money that would be leaving.
That's right. It's not one of those things, by the way. It's all of those things. You can pay for all of those things and EITC with the money for repealing SALT. In fact, every dollar they want to raise from increasing the individual and corporate rate would have to go to the SALT cap relief. It really does not belong in this bill. It's not an investment. It's not support for the middle class. It's a handout for the rich. A lot of them in blue states, but it's actually the handout for the rich around the country.
And in that push, I suppose, I mean, the expectation there, from what we're hearing, sounds like it's going to make its way in regardless. I'm not sure, what the final bill is going to look like or how it's going to shake out here. Obviously, as we said, a lot of back and forth still to come. But I mean, it has been one that has been top of mind, I suppose, for key Democrats here. So the expectations there, in your mind, you see it getting included.
There are a few members, some very progressive, some very moderate, that have basically conditioned their vote on something on SALT. So I think it's likely that it's going to make it into at least the first draft of the bill that passes the House. As they're sugaring stuff off, trying to get from that $3.5 trillion to 1.5 or 2.5 trillion, it's hard for me to understand why they would waste even $1 on, again, this regressive tax cut for the rich. That's actually not tax reform; it's tax deform. It's narrowing the base and making the tax code more complicated.
Yeah, we'll see what happens there. But I guess just kind of finally to recap and look back on everything, right? You guys have done a great job of tracking the money that had been raised during COVID and really put to work here to help American families struggling. It was a lot of money. We've heard a lot of people talking about it being too much money relative to the debt load here in the country. I mean, when you kind of step back and look at the way things are shaping up, as your guys' group kind of does here to try and make it responsible, how would you maybe grade where we're at in terms of trying to navigate and balance kind of what's going out and what's coming in?
Well, look, we passed about $6 trillion worth of COVID relief. I think probably about 4.5 to 5 trillion of that was very much warranted. So we overdid it, but a lot of that was really important, and it's helped support the recovery and protect incomes. But now we got debt as large as the economy headed to record levels. It's time to start paying for what we do, and ultimately to get our spending programs, Social Security, Medicare, in line with their revenue. We really need to address this debt over the medium and long term, not continue to add to it further.
And at the very least, I suppose if you have to add to it further, maybe focus in on the people who might need it most. And as you said there, the SALT cap repeal, not exactly one of those things. Mark Goldwine, appreciate you coming back on here to chat with us. He's Senior Policy Director for the Committee for Responsible Federal Budget. Thanks again. People, we'll chat soon. Going to take another break on the show, but when we return, focusing in on the EV space, as we're seeing the broader market decline today, the Dow off by about 200 points, but there is a stock that is up on optimism coming from Bank of America. That would be Lucid Motors. We're going to be focusing in on the analyst who sees positive steps ahead for that company and other issues in the broader electric vehicle market. Stay with us. He'll join us right after this. Welcome back to Yahoo Finance Live. We've seen lately a lot of crypto companies shelling out cash for some sponsorship deals. Mostly, you might have noticed the FTX patches on the MLB umpires and, of course, the stadium naming rights they've locked up both down in Miami and now out at Berkeley. But it's not just them. Also, Algorand, another crypto blockchain out there, throwing $100 million into the naming rights for the title over at the Drone Racing League, which has by itself been growing quite impressively. And for more on that partnership, I want to bring on Nicholas Horbachevsky, the CEO and founder of the Drone Racing League, joins us once again here. And Nicholas, nice product placement right there, right behind you, man. The Algorand logo right there. Talk to me about how important this is, right, and kind of bridging not only $100 million is a lot, but also I think a crew in crypto that also seems pretty excited about drone racing.
Absolutely. It's a huge step for the league. Obviously, bringing in a new title partner is very exciting. Algorand is the leading blockchain technology partner. They've got the scalable, decentralized blockchain that is going to enable the league to do things that we've never done before. So not only is this an incredible partnership with the league, but it's an opportunity for us to create unique fan experiences that we just wouldn't be able to do without a partner like Algorand.
Yeah, now, I mean, obviously, every time you have that money to put to work, I assume that you'd be able to grow kind of what you want to do in building out the sport. And obviously, it's come a long way since I think we first started talking about it years ago. But what have been maybe the biggest changes you've been able to implement, and what could this unlock moving forward?
Certainly, the league has been growing tremendously, and we continue with our global broadcast. We've really brought the sport of drone racing to a mainstream audience around the world, tens of millions of viewers every season. But now, bringing in Algorand and the potential of blockchain, we're going to have the opportunity to do things that we've never done before with fans. So, NFTs and collectibles and fan tokens that let fans have a direct vote in what happens in the sport. Certainly sort of crypto-powered transactions and opportunities in virtual racing and gaming that you simply can't do without a powerful blockchain partner.
Yeah, I wonder too much how gaming might play a role in there too, right? We've seen a lot of other traditional sporting leagues really lean into that now. You have the NFL pursuing a lot of deals in that side, but what about drone racing particularly?
Yeah, absolutely. I mean, gaming's a big part of our sport. We're a very interesting sport because our fans like to say we sit on the virtual, this blurry line between the virtual and the real. So gaming and esports is part of our sport. We do an annual tryout through a simulator, but then of course we're obviously doing real life racing with drones going 90 plus miles an hour through stadiums. So we have an opportunity to really play with that space in a way that most traditional leagues can't.
We're showing a little bit of the footage here from the drone races of past. And I mean, it's always fun and incredible to kind of watch the footage here. You guys do a great job of making it look great. I'm always curious, though, what the demographic is of the drone racing fans out there.
Yeah, absolutely. Our fans are global. So we have a global fan base of people who are interested in technology, in video games, in sports, and we're this perfect combination for them. We bring together a sport that touches on drones. It obviously brings tech to bear and gives them something exciting and novel to watch. So, it's a pretty young fan base. That's one of our things. And one of the most interesting things about our fan base is that they don't really overlap with traditional sports. More than 70% of our fans don't watch traditional Big Five sports. So it's really a new group of people being introduced to sports. We call them tech setters. They're people who love technology, but also are excited about novel tech-enabled sports like ours.
The other thing too is kind of where to watch. We've seen other kind of startup sports leagues, which I wouldn't necessarily classify you guys as anymore. But we've seen other ones fail without kind of that big media push. You guys obviously broadcast these things across a slate of some pretty major sports networks. But what does kind of the media progress and growth on that side, the partnership side, look like for the future of the Drone Racing League?
We're very excited to be broadcast around the world and to work with incredible media partners. We're actually gearing up now. Our 2021-2022 season starts Wednesday, September 29th at 8 p.m. Eastern on NBCSN and as well as Twitter. And we're particularly excited. This season will be great because this season we're taking over the Wednesday night slots that the NHL used to have on NBCSN. So it's great for us. It's moving into the prime slots of a formerly held by a Big Five sport. And we'll have slots on prime time, over 30 hours of prime time airing on time slots like Christmas Day, lead-ins to the Winter Olympics. So it's a pretty exciting time for us. And you're seeing us take huge steps forward in terms of where we're broadcast and how often.
Is it fair to say that this is mostly an American phenomenon? What are we looking at global-wide with the demographic question I asked? How big is it in terms of international growth now?
No, I mean, we have fans in over 100 countries. It is truly a global sport. Drone racing was always a global sport. We've built a global league on the back of a global sport. So we reach people all over the world. We have obviously tons of fans in North America, but markets like Europe, the Middle East, China are all huge for us as well from a broadcast standpoint.
Yeah, every time I see the footage, it just reminds me of Star Wars and a young Skywalker or droning around and the future there. Obviously, that was a global sport. That was an intergalactic sport, I believe, that time. But very interesting to see the growth. Appreciate you coming on here to chat with us on the new partnership. Congrats again. CEO and founder of the Drone Racing League, Nicholas Horbachevsky, joining us there. Appreciate that. Going to take another quick break on the show. As I said, Lucid seeing a nice 5% pop today on the back of an optimistic report from Bank of America, the analyst behind it. Going to join us on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. Let's chat electric vehicles because we've been hearing a lot about the competition in that space. And of course, we've heard some interesting headlines from China talking about consolidation in the space in general. But today, we are seeing one EV maker catch quite a big boost off some positive notes in an analyst note talking about Lucid. Shares are up more than 5% today as Bank of America put out a $30 price target on that stock, citing some pretty big reasons to be optimistic. And for more on that, happy to welcome in the analyst behind the report. Bank of America's John Murphy joins us right now. And John, it caught a lot of eyes because you compared Lucid to one name you might not. They're Ferrari and Tesla, of course. They're here in the EV side. Talk to me about what has you so excited about Lucid in a sea of companies.
Well, Zach, thanks for having me. I think as we look at these early stage EV auto manufacturers like Lucid, you kind of have to pick some operating metrics and look at the management team to understand what's going on at the companies, because their ability to turn revenue and cash flow positive is a number of years out. And I think when we look at Lucid, we look at Peter Rawlinson, founder and CEO, who was the chief engineer on the Tesla Model S. So that's a pretty good proof point that you've got somebody that's battle tested in one of the biggest EV vehicles that's out there in the market right now. But in addition to that, you've got a company that supplies battery technology sole sourced to Formula E. So that's kind of why we look at it versus Ferrari, is Ferrari provides a lot of powertrains to F1 race teams. So there's kind of a parallel there. I also think that as Lucid is starting out, they're starting out at the high end with their Dream Edition vehicles that are in the $175,000 plus or minus range. Will grind down over time, to some degree, but still stay at luxury price points that are probably at $70,000 plus. So I think when you look at this, you've got the combination of some real good know-how from the chief engineer of the Model S at Tesla, great technology, and then a focus on powertrain tech as well as the luxury market. So it's why you have this combination that's really powerful, I think, that's somewhat somewhere between a combination of Tesla and Ferrari.
Yeah, let's talk more about, I guess, the combination or relative comparison, I should say, to Tesla on a valuation basis, right? Because that's another thing where, the company came public via SPAC. You can have your thoughts on SPACs, but when you talk about maybe how this company should be valued, what do you see when you stack it up against those comps?
Well, I think when you look at it versus the three other SPAC or startup names that we cover in the EV space right now, I think the progression of the plant and the management might be a little bit further along. Some of those companies are doing reasonably well. Certainly wouldn't count out Fisco or maybe even the other two. We're certainly not as favorable in those stocks at the moment, but it's certainly certainly early days for those companies. But I think as we look at Lucid and think about the race to one full plant. So as a dumb auto analyst, you always think about 250,000 units as being one full plant. I think that Lucid is likely to get there a year or two or maybe 3 years earlier than Tesla did. So I think if we look back at the valuation of Tesla in its early days, it's somewhat appropriate and somewhat of a good guide stick. But what we're doing right now in this 3-time EV to sales to get to our $30 price objective on our 2025 estimates is basically simply taking close to the average of the 3 other EV startup companies as well as Tesla. And that's kind of how we're arriving at that. If you look at that, Tesla right now in 2025, it's trading almost 10 times EV to sales. So it's an extreme discount to where Tesla is trading right now, an average of where things are right now in the EV space. And something that's a little bit more aggressive than where Tesla was at this point of its maturation curve, but I think pretty appropriate given the validity of the business model at Lucid that we see so far.
All right, so that's the bull case there on Lucid. But when you back up, and I guess this would also be kind of more impressive for them to reach any kind of milestone faster than Tesla. Of course, they're kind of building on the backs of the giant there in kind of the progress being made on the EV side. But importantly, they are dealing with a few different other things market-wide that you highlighted in a new note as well, which is, of course, chips impacting supply. A lot of people might like to debate the demand side of EVs. My dad bought a Tesla not too long ago. I saw kind of the demand there, even in Texas. But on the supply side, how big of an impact is that on the whole EV market as they kind of battle with other companies out there to secure chips to keep pumping out cars?
So there's a lot of gradations to the semis chip shortage. I think for the majority of the industry, it's a much bigger issue. When we look at a company like Lucid, at the moment, they're going to do a few hundred to maybe 1,000 units this year as they start up production in Arizona. We have them doing about 20,000 units next year. So in the grand scheme of the demand for chips, I don't think, or the supply of chips, I don't think that's going to really derail the Lucid story itself. For the bigger manufacturers and the industry at large, it's a very significant issue, but it's not something that I think is going to really nick these startup EV companies at this point in the maturation curve. And hopefully, a year to 18 months out, we'll be through the bulk of this chip shortage, and the EV manufacturers, as well as the rest of the industry, will go through the muck. And hopefully, we'll get a very good auto cycle off the back of that will help and lift them all.
Yeah, lastly, that was pretty interesting in the note, kind of looking at kind of the dips down still, not returning to pre-COVID levels into Q4 of 2022. I mean, talk to me about why that's the timeline.
Well, I mean, what we're seeing right now is inventory has been worked down to almost record low levels, or lower levels than we've seen in 30 plus years. We're about 1 million units of inventory in absolute terms. Just in the auto industry on dealer lots right now, traditionally normal is around 3 to 3.5 million units. So we're very low on inventory at the moment, and it just keeps getting tougher and tougher with different kinks in the supply chain, particularly around semis, but other places as well for the industry to ramp up production. So we don't think it's really until you get to mid next year, and even in the second half of 2022, you start catching up on production, and not even until 2023 that you start to get some level of normalization on inventory. So the industry is going to operate in total probably at much lower levels than anybody was expecting, and lower than most people are expecting even at the moment. And we'll see strong pricing on the new and used side of the business for the vehicles themselves, which will help automakers offset some of this volume pressure and help profitability. It'll be a bigger problem for the suppliers because they're just getting lower volume, and pretty good for the dealers as well, as they're getting good gross margins off the vehicles. So different links in the value chain are being impacted differently, but it's the toughest for the suppliers, okay for automakers, and the best for dealers at the moment.
Well, it's a very hot space right now. A lot of questions, a lot of interest from our viewers. So I appreciate you coming on, not only with two pretty good notes there in terms of detail, but also an interesting call there in one name particularly. John Murphy, Bank of America analyst, thanks again for the time. I want to highlight too, though, before we go to break, that you out there watching can step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. You can get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. You can check that out today at yahoofinance.com/plus. Coming up, if you've got kids getting back into school, now might be a good time to figure out what they're going to do with the rest of their life and how much it's going to cost them to pay for it. We'll break down how much debt students have by their major, by their degree, on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. It is back to school season, and of course that also means back to college season. But what degree is really worth the cost. Of course, we sit at a time where student loan debt is at a record high. So let's dig into whether or not it makes sense to go one route over the other. And Yahoo Finance's Arti Swaminathan joins us with a breakdown looking at some of those debt levels. Arti, what makes sense here?
Yeah, so basically we have this concern about rising college costs. We have a student debt crisis. We have policymakers trying to erase student loan debt. So when the Department of Education put out this new treasure trove of data through the college scorecard, where they basically list out how much debt you take out by degree and also by school, researchers just went crazy on it, right? So we got a report from the Texas Public Policy Foundation that basically looked at the cheapest bachelor's degree and the most expensive bachelor's degree. We can break it down by state. It's really interesting. Colleges in the Northeast, obviously, people take on a little bit more debt. There's just so many colleges in the Northeast as compared to out West, where California system funds a lot more scholarships. But when we look at the cheapest and the most expensive, it's kind of really interesting. So when you look at cheapest, it's international and comparative education. That's going to put you $10,000 in debt. Real estate development is going to put you $14,000 in debt for a bachelor's degree. Operations research is the third one. And then when you look at the most expensive degrees, it was kind of interesting. I thought these would be really, high paying. Maybe the ROI is really high, but expensive means electromechanical instrumentation and maintenance technologies and technicians. It's about $40,000 in debt. Behavioral sciences, again, $40,000 in debt. So these are pretty high end there. So you're going to take out a lot of debt. Maybe you'll make more money. That's not sort of addressed here, but it's about the debt that you take out.
Yeah, those are bachelor degrees too. I mean, I was just having this discussion last night about whether or not the master's degree winds up being worth it. A lot of people, you have to forego, right? You're giving up those years where you could be making money to go back to school and pay for it. So what does that look like?
Yeah, I think it was a New York Fed or someone who said that every year you forgo, it's about $1 million or something crazy statistic about the opportunity cost. But when you take an associate's degree, you borrow about $14,000. When you take a bachelor's degree, you on average borrow about $23,000. But when you take a master's degree, we've had this conversation, J school, drama school, all these kinds of highly expensive endeavors, I guess, you take a median of $40,000. If you want to go even further, take a professional degree, become a vet, become a lawyer, become a doctor, you take a median of $144,000 in debt. And the kind of weird thing is that if you're doing a PhD, it doesn't cost that much as compared to becoming a vet. It's only $73,000 according to this data. But again, this is generalized data. It depends on each and every individual situation. If you really want to become a doctor, you should go into that debt because the ROI is pretty high. But this is just the government and researchers trying to introduce more transparency into this mysterious cost of college.
Yeah, and obviously it's important if you have a bunch of people in the country, a record number of stacking up that debt. But I guess, this is one of those things where there's invisibility on the other side, right? You kind of take on all this debt with hopes that you'll eventually make enough money to pay it off. But as we've seen, certainly in some for-profit schools, that has never panned out. But generally, I believe, and you would know better than I do, that the stats do point to it still does make sense to go to college, right?
Yeah, it still does make sense because we saw for a very short period of time before COVID that it didn't really matter. Even if you didn't have a college degree, you could still get employed. But right now we saw through the pandemic that those who had a college education, they were the ones who were able to transition to work from home. A lot of people who don't have a college degree, there is a correlation with them being on minimum wage, being working in industries that are very customer facing. So having a college degree, at least during this time, has proved to have some benefits. But again, the ROI on certain majors, especially those like highly paying ones, still makes college worth it's a worthy investment.
Yeah, and if you want to chirp your friends who got a master's degree and might still be paying it off, you can go find Arti's story on yahoofinance.com. Send them the link. I'm sure they'll appreciate it. Arti Swaminathan bringing us the latest there. Thanks again for that. Going to take a quick break here on the show, but when we reset for the 12 noon Eastern Time trading hour, we're bringing you the latest in terms of Ray Dalio's thoughts on Bitcoin, why he's once again issuing the warning that its successes could bring about more intense regulation that could, in his words, kill Bitcoin once and for all. Stay with us. We're back in 2. Welcome in to Yahoo Finance Live as we cross the noon Eastern Time trading hour. I'm Zach Guzman. Happy you're here with me on this fine Thursday. When we look at the broader market action, we're seeing all three major indices pull back a bit. The Dow off nearly 200 points as we see retail sales unexpectedly rise and jobless claims come in pretty much around the level that they were expected to come in at. So we'll break down in just a second what this recovery is looking like. Plus, as we look over at the crypto market, we got an Ethereum counterpart blockchain exploding today, up 22%. Avalanche also up more than 1,500% year to date. Today, raising another $230 million to help attract activity on its own blockchain. The president of Avalabs will join us to explain the growth he sees ahead. And the dust finally settling on Apple's big event. With all the models and price points, things can get complicated, but Yahoo Finance's Dan Howley, our tech editor, is going to walk us through whether or not it makes sense for you to upgrade and what the best option might be. But first, as I said, we saw retail sales coming in stronger than expected, a break from some of the weaker than expected data prints we've been seeing as of late. Overall, the value for retail purchases for the month of August rising 0.7% after a downwardly revised 1.8% jump in July. Economists there impressed by what they saw. We also saw initial jobless claims coming in pretty much around expectations. Expectations were looking for 322,000 jobless claims. We got 332,000. So I'm going to call that one in line. But broadly speaking, a lot of questions maybe about the jitters we're seeing play out in today's session and perhaps whether or not we've moved past that twilight zone of weaker economic data being a good thing because it would mean the Fed would have to stay accommodative for longer. And for more on that, happy to bring back into the show Anik Sen, PineBridge Investments Global Head of Equities, joins us right now. Mr. Sen, happy to be chatting with you today. Thanks for taking the time. I wonder which camp you fall in, whether or not it's a good thing to see that hotter than expected retail print, or whether it means, we could get back to things running hot.
Thanks for having me back, Zach. I think it's always a good thing to see stronger than expected economic data. Obviously the context here is that the Fed and major central banks around the world have been keeping interest rates low through QE primarily, but also, they went to zero bound and negative interest rates a while ago. So we are, as you say, we are in that twilight zone where, central banks are having to really kind of consider how they message the pullback on these trillions of dollars of liquidity that they have been pumping in. My sense is that they will be patient because we're not out of the woods yet in terms of the openings, particularly in Asia. You see that supply chains are incredibly disrupted right now, and they were clearing up until the end of June and July, and then they worsened significantly. So there are tremendous bottlenecks in the system that is causing a lot of price instability. And that is, in my view, bad inflation. This is something that I think particularly the Fed and the ECB are on top of. And so we need to get through this tremendously difficult period with cross currents. So my sense is that the market is starting to worry about the liquidity pullback. It will happen at some point. It has to happen. Because the underlying fundamentals of the economy are strong, save for this terrible bottleneck situation that we are in right now.
Yeah, and I guess it's kind of, some of the choppiness might be coming from that too. As Emily highlighted for us in the last hour, kind of digging deeper into the retail sales report, you saw a lot of strength in a lot of what you would expect, right, in terms of back to school payments and things like that. And we're seeing a boost in some of the apparel makers off of those details. But I guess that kind of just speaks to, the fits and starts we've been seeing. You had travel seeing a nice pop in terms of prices. There was the inflation question around airfares too, as people really got back out there, really reversing once we saw Delta come back. So, it becomes, I suppose, difficult for the Fed to really figure out what's going on if we're seeing kind of haywire readings across different sectors.
Yes, the Fed mainly is concerned about, long-term inflation, its inflation expectations. And of course, they also, they have a very changed framework in terms of employment. They have a much broader dashboard for employment, and they are more concerned about being able to run with an asymmetric target. So it's an average inflation of 2%. So they're able to run their policy with a higher, longer-term inflation expectation almost. But so that is why I think there's tremendous amount of what's the right word? There's a tremendous amount of patience that the Fed is going to be applying. And I think this distinction that I made between good and bad inflation, bad inflation is temporary. It's about bottlenecks. It's about persistency in not being able to bring product to market. And that's where I think what we've already started to see is that it's the worst appears to be behind us. The system is getting smarter. Some of the bottlenecks are already clearing if you see some of the price actions recently. So I think it's a little too early to be concerned about the Fed moving, aggressively. In fact, I think it's going to be the opposite. The Fed is going to be tremendously patient.
Yeah, and that's obviously the picture here in the U.S., but when you back up and kind of look at the global picture for investors out there, we've been hearing people talking about emerging markets in Asia. If you want to talk about China, though, it's been a tough go, sector after sector, dealing with regulations and crackdowns over there. Lately, it's gaming. Before that, it was education and EVs. We could talk about this too. But I mean, when you back up and look at maybe the global picture for investors, what would be the advice there for people who might not be looking outside the U.S. enough?
Well, China cares about what they call their three mountains, and that is healthcare, housing, and education. These are the three big costs that families have to incur. And the latest census data out of China was, I think, shocking for some, in the sense that the disparity of income levels, the disparity of living standards, I think shows that in this 100th year anniversary of the Chinese Communist Party, that China needs to do something in terms of ironing out some of those disparities. And the three mountains is how they have encapsulated policy. So the big difference between Western democracies and China, of course, is that Western democracies have long consultation periods, and they tend, policy does not surprise in the way China, very abruptly comes up with policy changes. And I think that's the big difference. But if you look underneath what China is doing, I would sort of encapsulate the whole thing as a very ESG-centric exercise. It's very anchored on social norms, on social policy. And so when we invest, we are very selective in terms of the companies that really kind of play to that social objective in China. And that is why I think when you invest in emerging markets, you have to really understand the companies, the political situation, and of course, being on the ground for us is a tremendous benefit.
An important distinction there before investing in markets you might not understand. And I think a lot of investors have been learning that lesson over the last few weeks here. But Anik Sen, PineBridge Investments, Global Head of Equities, appreciate you coming back on as always, sir. Be well. I want to shift over to another piece of the market we've been watching closely. That is, of course, Bitcoin. As regulators step up some pressure there, we've seen the crackdown in China as miners were pushed out of that country in droves. Today, seeing a slight pullback here as Ethereum still maintains some gains and some interesting headlines coming out of the SALT conference and Ray Dalio. His thoughts, a lot to get into today, as he says regulators might increase the pressures against Bitcoin if it enjoys future success. Of course, he said that before. But to discuss this with us, I want to bring in Yahoo Finance's David Hollerith, who covers crypto here for us. And David, I mean, a lot to get into here, but at least Ethereum holding gains today. What are you making of what we're hearing? It's a very active time. SALT, mainnet next week, a lot of conferences right now. Could be driving some enthusiasm in the market.
Yeah, I mean, Zach, the bull market's still clearly in full swing, and Bitcoin's kind of hovering around $48,000 right now. And it looks like it's not too affected by Dalio's words at the SALT conference. He said that he thinks Bitcoin is a viable payment method. And could continue to be a viable asset if it's used in payments. But at the end of the day, if it's too successful, regulators will probably want to shut it down. Now, trying to think about this, just technically speaking, it's hard to imagine how regulators can shut down Bitcoin unless there's some sort of global regulatory agreement for that to happen. And in that scenario, I think Bitcoin would have to be doing something pretty nasty. But it's still very interesting, and there are a lot of ifs tied to what Dalio is saying. But it's funny because every time he comes out about this, it's ominous. But he always clues into the fact that he thinks he's showing signs of interest in it, and he does own portions of Bitcoin in his portfolio. So always want to hear more about what Dalio thinks about crypto.
Yeah, no, it's interesting because I had to go back and look to make sure I wasn't just having deja vu, but we heard him issue kind of the same exact warning in May. And now we're here in September, and it's the same exact headlines that regulators will want to kill Bitcoin, but also I'm going to own it and see what happens here. But to your point, I mean, that is the question, right? We saw China basically push it out of the country, try and kill it. I'm not sure if they were trying to kill it or just wanted to figure out kind of those climate concerns around Bitcoin and coal mining. But, it has proven that you can move large chunks of the network offline, turn it back online in other countries. They're rather difficult for it to die.
Sorry, can you say that again?
Yeah, I mean, it just seems like, the attempts here to actually end it would be very difficult, especially considering the fact that we had talked about this yesterday, that the SEC had already come out and basically said Bitcoin's not a security. We've seen that kind of established here. But kind of the grounds to, if regulators wanted to kill it, the routes that they would need to go to actually get it to not run anymore.
Yeah, it would be extreme to say the least. And I don't think that it is necessarily in everyone's best interest that the cryptocurrency were to be killed, if that makes sense. But yeah, I mean, I think it does get to the conflict that's going on right now as the crypto industry is grappling with what regulators want. But to me, a lot of that has been less emphasis on Bitcoin and a lot more on DeFi and stable coins. So I'm actually more curious about how that area handles regulation.
Yeah, we're going to be chatting with the president of Aval Labs behind Avalanche a little bit later on in the show. But we have seen, it's interesting to me to just kind of see the break now in DeFi and what's going on in Bitcoin. Generally they kind of always moved in tandem, but lately I think we've seen some projects enjoying some big price jumps, even on days that Bitcoin's down. So it does seem like we're moving into an interesting chapter here in the crypto space. But David Hollerith joining us once again to kick us off there with our crypto look. I appreciate that. Going to take a break on the show, but when we return, digging deeper into whether or not it's time to finally upgrade. Of course, we got a long slate of new iPhones in terms of the products and the services that they offer with those new models, but does it make sense for you to shell out more cash for them? Yahoo Finance's tech editor, Dan Howley, is going to walk us through that all-important decision on the other side of the break. Well, in this week's tech support, you got a lot of decisions to make in your life, but one of the more important ones, at least if you ask me or Dan Howley, is what phone you're going to have for the rest of the few years you're going to have it. And of course, Apple made that decision maybe a little bit more complicated with the unveiling of their iPhone 13. And our tech editor, Dan Howley, is joining us here in tech support to walk us through whether or not it makes sense to buy one of these and which one if you're going to. Dan.
Yeah, so right out of the gate, let me just say, if you have an iPhone 12, you can hold on to it for a little bit. You don't have to worry about upgrading to an iPhone 13. We talked about that during last week's tech support. But for everybody else who doesn't have an iPhone 12, let's look at the ones that are available, these new iPhone 13s, and who might fit best with what. So start off with the iPhone 13 mini. That one's going to run you $699. It's going to be a kind of phone for someone who doesn't want to have a pocket busting, purse exploding kind of smartphone. 5.4 inch display. It does have the Super Retina XDR display that you find on the regular iPhone 13. It's basically the same right across the board for both phones. It's just that price tag and that smaller size. So I think for most people who are looking for a small size phone, that's really the way to go. There's also the iPhone SE with the familiar fingerprint sensor. That's going to be a little bit cheaper, but it's also going to be a little bit slower. So if you want the newest version, go with this. If you want a bigger phone than that, don't want the pint-sized model. And according to reports, the pint-sized model is not anyone's favorite because it's been selling poorly as far as the iPhone 12 mini goes. Then there's the iPhone 13. That's going to run you $799. Larger screen, 6.1 inches. Now that's kind of the sweet spot. I've been using the iPhone 12 Pro, and that's also 6.1 inches, and it really is perfect. I watch video on it. I read articles. It's a fantastic size display. And then you also have those two cameras, the wide angle and the ultra wide angle. Both of those have been upgraded. You have the new cinematic video view, the A15 Bionic chip, and then obviously you have down below those storage capacities starting at 128 now. So the 64 gigabyte is now kicked the bucket, thankfully, because we all store way too much nonsense on our phones. Now, if you want to go the extra step, you're a little bougie like yours truly, then you would go for the Pro models. And those are the iPhone 13 Pro and iPhone 13 Pro Max. Now, what's the difference here? Well, screen size. The 6.1 inches is still the same on the base Pro, but it's going to run you $200 more at $999. The difference there is that it gets a better display. It's the same Super XDR, but it has ProMotion. So that means that the screen refresh rate can go up to 120 times per second or as low as 10 times per second. That means the screen will refresh as little as 10 times per second. And that's important because that saves battery life, but the 120 times per second is important because it makes everything look nice and smooth when you're scrolling. And there is a visible difference with 120 hertz. Then we have those cameras, 3 cameras on this model. That's the wide angle, the ultra wide angle, and telephoto. And these have all been upgraded from the iPhone 12 Pro. And that's really why I kind of want this one personally. Because of the better low light. You can do macro photography with that new wide angle lens. The telephoto lens now goes 3x. I mean, it's really great across the board. Now, you also have the option of up to 1 terabyte of storage, which is just wild. I mean, I don't know why you would need that, but why not? And then there's the iPhone 13 Pro Max. Sorry, I'm still stuck on the 12. But the Pro Max has a 6.7 inch display. So that's if you have no limits for your pockets. If you're rocking cargo shorts like Adam Sandler, or you're still wearing Jenkos. I don't know if anyone out there remembers them, but I certainly used to wear them to my parents' disappointment. Anyway, this also has the 3 cameras upgraded across the board the same way. The A15 Bionic chip on this version and the smaller Pro is actually better than the one in the iPhone 13. So if you're really looking to go all out with graphics, this is the phone to go with. Also 1 terabyte of storage. I think that the main thing for this one is if you really want to watch a lot of video on your phone and you're not afraid of price because it can be priced up to $15.99, then this is definitely the one to go with. For the average person, I'm going to say the iPhone 13 is pretty much the sweet spot. I like the Pro just for that telephoto lens and the ability to do macro photography. I think the ultra wide angle is fantastic, but that telephoto, believe it or not, is excellent when you're trying to get photos of people and you don't want to get way too close, especially, during COVID times. I think it's an excellent option. For me, I would like the iPhone 13 Pro Max just because I'm bougie and I want everything gigantic. So, and I still wear Jenkos. So that's pretty much where it's at. And, again, if you're the type of person that just wants the smaller one, the 13 mini is a great way to go too.
Yeah, the 13 mini, I still have a 10 as we talked about, Dan, and I still don't know if I really need to upgrade just because it still works for me. I might be a Luddite here. I was telling Akiko, I mean, maybe it's just not, maybe I'm not tech savvy anymore. I'm not our tech editor here either, but there is no confidence like having Jenko jeans. And still, you remember the days when you can walk around with Jenko jeans and a razor in your pocket?
Oh yeah,
Motorola
I mean, look,
razor?
I used to flip that bad boy out. My wife had a juke. I don't know if you remember what a juke was, but it looked like a comb, and you would like switch it out, and it was an absolutely ridiculous phone. So none of these obviously are as cool as those. That was really when smartphones were awesome, where dumb phones were awesome. But I still think that the 13 is probably a good upgrade for you at this point, especially if you're rocking the 10. Go for 13. The camera will blow you away, and it'll be much, much faster.
Yeah, especially if you're still rocking a Juke or a Razor or a chocolate for that matter. It's Throwback Thursday, so I'm just running through them. Dan Howley bringing us the latest on the iPhone front. Appreciate that. We're going to take another quick break here on the show, but when we return, one of the big blockchain applications taking off today after a $230 million raise. That blockchain, the coin that powers it, up more than 1,700% on the year. We'll chat with the president of the group behind Avalanche on the other side of the break to discuss what growth looks like ahead and an interesting partnership on NFTs with Tops. Stay with us. We're back in 2. In today's Crypto Corner, if you haven't been paying attention, there is a huge rush to capture the market in DeFi. As a lot of these protocols have been building on Ethereum, there has been an intense battle to get a lot of coders, developers, users shifting onto some other blockchains. And one that has been pretty active in trying to attract people to come to their platform is Avalanche. We've seen that token there rise more than 1,700% year to date. And today, they announced additional funding coming from Polychain and Three Arrows Capital and a $230 million investment into the ecosystem getting built around Avalanche. And for more on that, happy to bring on the president of the group behind Avalanche, Ava Labs' president, John Wu, joins me once again. And John, it's been only a couple months, I think, since we chatted down in Miami at the Bitcoin conference there. But Avalanche's run has been pretty impressive here. And a lot of it has to do with the effort you put into attracting it. It was $180 million, I think you guys announced with Avalanche Rush to attract a lot of people to shift over, in building out what you guys are working on. But talk to me about the growth you've seen in that effort and the new raise announced today.
Well, Zach, first of all, it's great to see you again. And since the last time we spoke, I think it was BTC Miami in May or June, obviously a lot has happened. And we're very excited today to announce the $230 million raise for Avalanche. So Ava Labs is the services and software team behind the protocol Avalanche. So Avalanche raised $230 million. Great supporters. As you know, the lead guys you mentioned are Polychain, 3 Arrows, but there are others that's supported Avalanche in the past. I need to mention them as well. Dragonfly, Galaxy, A16, Initialized Capital, and many more. But I think it's a testament to all of our partners, VC partners, to the growth in utility on the Avalanche platform. This is why the raise was what it was, being one of the larger ones in recent memory for a protocol. It is so we could continue helping Avalanche with a trajectory that was already on an organic basis growing incredible. Since we spoke, I think in June, there's something close to like 400 or 500 projects and total of 900 since mainnet that the team has been looking at to try to vet and help out. And on top of that, the technology, I wish everyone can go and check out the bridge, how smooth that experience is, so they can get assets over.
Yeah, well, I mean, that's one of the things here too, right? And we talked about this a few months ago, is kind of these layer one protocols now getting a lot of things built on them. And a lot of it has to do with DeFi. We've seen some of those projects, Aave, I think as well, kind of transitioning over to Avalanche and working with you guys. And the total value locks, right? This is one of those metrics that people look at in terms of activity, money flowing into these protocols by users and putting it on chain. Has skyrocketed over the last few months for you guys too. So I mean, talk to me about that in kind of what you're trying to build out.
Yep, this is your stuff. So that is one of the metrics a lot of people use as an indication of real utility in blockchain ecosystems. And if you think about layer ones, there's really only 3 or 4 that are live. Obviously, we know Ethereum. Then there's Avalanche, the fastest growing, I would argue, if you just look at the numbers and compare the different metrics and the growth rates. So what is happening is there are not just crypto native users, but also traditional users who are very, very excited and see the benefits of peer-to-peer finance and decentralized finance, where they can actually get good yield. This is not just individuals either. Institutions are doing this as well.
And we were talking about tokenizing all kinds of assets, right? And doing that on the Avalanche protocol. And obviously, if you're a believer in that kind of expanding, you would be a believer in the protocols that are winning and trying to attract people to tokenize whatever it is they want to tokenize. And I think a lot of the attention has been put on NFTs as of late, and we've seen that space explode. And a lot of that's built on the Ethereum blockchain, and that's produced pretty high gas fees when we're thinking about the transactions on that network, a lot of congestion. But you might not be a believer of NFTs, really. You could say that might be a bubble, and eventually it's not going to be providing the growth anymore. So, I mean, you guys have a new partnership with Tops to build NFTs on Avalanche. Talk to me about that and how important it is maybe to drive some NFT action off Ethereum to what you guys are doing.
Super exciting. And you're right. Another great use case is NFTs. We're seeing in the ecosystem around blockchain, literally hundreds of millions of dollars of transactions per day. With Tops, we're super excited because we're going to be creating NFT, digital collectibles for various licenses they have. And most recently, I think you have a picture up, is Major League Baseball, sport that is very dear to me personally. I can't wait to see all the NFTs and continue to collect them over time, especially into the actual playoffs. But what Avalanche created in the NFT world right now is unique. Most of these platforms and protocols, when they have a NFT product, it's usually one or the other. What I mean is it's either abstracting away the entire blockchain experience, fiat on, centralized custody, fiat off, or it's the other end of the spectrum, very crypto native. It is crypto on, crypto off, self-custody, harder to use, more DIY, but others like that. This platform that the software company Avalanche behind Avalanche has created actually allows both at the choice of the user. If you want a self-custody, great. If you want to have a centralized custodian for you, you can do that too. Different prices for different people, do it yourself versus more service, up to you. From now, as far as I know, there's not too many offerings like that right now.
Yeah, and I mean, I think that adoption cycle has taken some time. It's mostly been people who understand the crypto market, and so it takes a while. I've never had more people asking me how to get a MetaMask set up and how to start using this stuff, but it's happening in real time. And John, I mean, I saw on another network you might have been asked 3 times about Ray Dalio's comments when it comes to Bitcoin and regulations here, but there are regulatory questions, I suppose, to get into about what DeFi is doing here. But it seems like it's so far down the line because they're focusing in on more centralized institutions right now and what's going on. But when you look at maybe regulations in regards to DeFi, as it's getting built out and as more of these things kind of shift from being centralized organizations, I mean, what to you maybe are some of those regulatory risks that might still be there for investors who are looking at not just Avalanche, but really all kinds of DeFi projects right now?
Yeah. So in terms of regulation for DeFi or crypto, and I don't know what's in the regulator's mind, but if I read the words from Gensler and others, they want to mitigate risk for fraud, for money laundering, and they want more investor protection. I think everyone in the blockchain space agrees that that should happen. The key, though, is that they have some sort of collaboration and talk with blockchain developers and blockchain users and give some certainty. Because if you look at other jurisdictions, Japan, Singapore, rules are a lot more clear. Switzerland, rules are kind of clear. EU is about to cement some rules as well. And we do not want to lose talent, innovation, and projects overseas because our rules are uncertain. So I think certainty is what everyone is looking for. Philosophically, everyone believes investor protection rights, mitigation of fraud, mitigation of risk of money laundering. Those are all good things. So hopefully we can work towards that and have a good dialogue.
Yeah, and not lock out some of that progress that's being made here. It's exciting to watch all this and happy to have you join us again today to kind of discuss a lot of what you're working on, seeing a lot of money flow into it and a lot of money raised. But interesting to see some of that getting put to use here in new use cases for everybody out there. But Ava Labs President John Wu, appreciate you coming on again, man. Hope to chat soon. Be well. Going to take another quick break here on the show. We'll be right back after these messages. Welcome back to Yahoo Finance Live. We're going to keep the crypto discussions going here, this time with a clip of influencers. Our editor-in-chief, Andy Serwer, was able to sit down with the head of Facebook Financial, David Marcus, to once again discuss the launch of Facebook's Novi wallet and the role that he sees the company playing in the future of crypto and money. Take a listen.
I want to be super clear on this. So no data that will be used in Novi can or will be used for ad targeting or for any purposes around, the ad model. And basically the way that we've designed this, and it actually took us a lot of effort to build it the right way, is that your financial data is not going to be commingled with your social data. And I feel that people really want that, and it's an important commitment that we need to make and uphold over a long period of time for people to actually trust us over time. And I think that when we look at the use case that we're solving right now, and we're focused on, the next best thing is so much worse than I think what we'll bring with Novi, that I think at least for people who need to send money abroad, they'll give us a shot, and then with that shot that we plan to honor really, really well, over time, we plan to earn people's trust, so they give us a shot for other things over time. But it'll take time, and I'm cognizant of that, and I think that we won't have two opportunities to actually earn people's trust and deserve it, and so we don't plan to miss that opportunity when we get it.
Yeah, I mean, you talked about a trust deficit. You mentioned that the other day. Is that connected to some of Facebook's previous problems, quite frankly, or is that just about this new incipient world of crypto and digital wallets?
I think it's a little bit of both. I think that it's our scale because we're big, and I think it's important to ensure that things that could scale rapidly, although I don't think Novi specifically will scale very rapidly. I think it'll take a long time, and we can dive into that more if you want. But it's our scale, and I think also a number of questions that emanate from whether Facebook should or should not enter the space of financial services, which is kind of an interesting question because we've been in payments since 2009, and in the last 12 months have more or less processed about $100 billion of payment volume for all of the various payments activities that we have, whether it's person-to-person payments in Messenger, in WhatsApp, in Brazil and India, or for donations, or for commerce-related activities across our platforms, or to buy ads on Facebook for smaller merchants and advertisers. So we've been in the payments business for a long time. And so we're already in that industry, and what we're trying to propose here, while it's more ambitious in terms of rewiring our underlying payments and aging payments infrastructure, I think is something that we can do very, very well, and really address the problems that frankly haven't been addressed in over 50 years. And I think it's time.
Definitely is a lot of friction in the system. You mentioned scale and saying that it might be hard for Novi to reach scale quickly. How important is scale for Novi? Is it important unto itself, or is it just part of the, to use that term, flywheel of Facebook?
No, it's important because we really think that it's important to reach, of course, as many people as we can in the process of providing cheaper, more open, more accessible, and interoperable payments. And so the question is where the scale is going to come from. And I think that when you think about the US, the US market for person-to-person domestic payments is really well served. You have no lack of options to send money for free to your friends or to your contacts. Internationally, it's a whole different situation, and cross-border, it's a completely different situation. So I think that when I think about scale, I think about scaling in the use cases, the very specific narrow use cases that we want to solve. For the US, our approach is going to be really more focused on the merchant side, and can we actually reduce costs for merchants to accept digital payments? And if that's the case and we do it well, then merchants will potentially incentivize consumers to pay with this new method of payments, and then we'll get that side of the flywheel going. But that'll take time, and the current user experience for Novi is one where You need to upload your government issued ID to basically authenticate yourself before you can make your first transaction. So unless you're really fixing a problem that no one else is fixing, or rather that the next best thing is really not that bad comparatively, then people are pretty resistant to go through a lot of friction to sign up for a new account. And so, we think it's just going to take a little bit of time, but we're focused. This is a long-term project, and we believe that we can deliver a lot of good over a long period of time. So we're very committed to seeing it through.
And I was looking at it on desktop, NOVI, for those of you who want to check it out. But is it ultimately going to be an app, a freestanding app, or is it already exists? Is there a beta app out there?
Yeah, I have it on my phone, but yes, it's an app for iOS and Android, and eventually it'll also be integrated into WhatsApp and Messenger, so you can send and receive money from Novi in line with the conversations you're having on Messenger and WhatsApp.
And can you get it now, or is it just for you for now?
For now, it's sadly not for everyone yet.
Internal beta.
It's an internal, what we call dog fooding build that we're actually using internally, and it works great. And that's why we're also so passionately eager to release it so everyone can benefit from it.
Welcome back to Yahoo Finance Live. One of the tech companies we haven't talked about lately is Cisco, a legacy enterprise tech company you might think about in terms of establishing the connectivity that is necessary. But as they lean into software sales, the company is now projecting growth about 5 to 7% over the next 4 years. And earlier this morning, Yahoo Finance's Brian Sozzi was able to catch up with the company's CEO for more on that. And Sozzi joins us now with what we learned. Saz, I don't know if you're muted on your end or if that's okay. It was on our end.
It's all good. It's all good. I'm here to talk about Cisco. I know a company we follow very closely here at Yahoo Finance. Cisco held a key investor day yesterday. Street a little disappointed with the longer-term outlook they put up, calling for 9% EPS growth. The Street was looking for 9% EPS growth. Cisco put up about 5 to 7% growth. So I asked Chuck Robbins a little bit about the outlook, but also, does he think Cisco is not being viewed correctly by Wall Street analysts?
I think, look, what we tried to do yesterday was basically remind them of what we told them in 2017 and that we actually delivered on our execution there, to give them more visibility to this software transformation that we've been driving. When I took over, we had $3.4 billion in subscription software. At the end of last fiscal year, which ended in July, we were roughly around $12 billion. So we've made a lot of progress. And also to just highlight that so many of our customers right now are on the front end of multi-year investment cycles around, to your point, hybrid work, hybrid cloud, the 5G infrastructure build out, the progress we've made in selling into the infrastructure of the major cloud providers, and edge, IoT, all of these we believe are going to be tailwinds for some time to come.
So do you think the Street, Chuck, is just too focused on legacy Cisco?
Well, I think what we're trying to do is give them the metrics that they actually need to actually think about our valuation in the proper way. And so I don't blame them. I think we just have to make sure we continue to give them the information they need so they understand the transformation. Scott yesterday announced that we were going to be giving them new metrics around percentage of subscriptions in our revenue, ARR, our RPO metrics. I mean, and all of these are metrics that software companies tend to provide. So I think as we do that over time and as we execute against what we told them we were going to do, much like we did against 2017, I think we'll be fine.
And Zach, there you have Chuck Robbins really making the case to Wall Street that they should be viewed more like a software company instead of a company like Cisco of the past that sold really lower margin hardware. They still do that, but a larger part of their revenues are coming from software and recurring revenues. And their argument is because of that, perhaps their stock should be trading at a multiple more in line, let's say, of a Microsoft, rather than some lower margin tech players.
On the year, up by about 30%, Microsoft up by about 40, so close. And we'll see if whether or not investors start to look at those as peers rather than different companies on both sides of the tech trade. Brian Sozzi bringing us the latest there. Appreciate that. I want to shift over to a broader market check here, as we're still seeing weakness on all three major indices, though the losses have been pared just a bit as the Dow is now off less than 100 points today. And for more on that, I want to bring on Yahoo Finance's Ines Ferre with the latest. Ines?
Yeah, that's right, Zach. And if we just take a look right now at the NASDAQ 100, we are seeing the big cap names like Apple, Alphabet, Microsoft, Facebook, all slightly lower. We're also taking a look at the Dow. You can see quite a bit of red there. And we're taking a look also today at some of the Chinese stock names as well, and the gaming names as well that are still under pressure. You've got Wynn that's under pressure. Las Vegas Sands is also under pressure after scrutiny from regulators in China. I do want to mention a very successful launch last night. That was the SpaceX launch from Kennedy Space Center in Florida that happened at about 8:02 p.m. And that was the liftoff last night on all civilian, no professional astronauts crew going into space, first on many levels for SpaceX. The company is not public, but youngest American to go into space, first person with a prosthetic limb to go into space, first African-American female pilot, Dr. Sion Proctor. And of course, all of this was because of Jared Isaacman, the 38-year-old billionaire founder of Shift4Payments, who chartered that flight.
Yeah, that was one that we've been watching play out here in S2, just because, as we were discussing yesterday, every time you see a big successful mission like that, it gets everybody kind of jazzed about space travel in general. Your takeaway from what we saw there?
I think it was huge for civilians going into space. Yes, the wealthy are doing this because this is all possible because of a billionaire. But when you take a look at the way cars started out, at first it was for the very wealthy, and then Henry Ford came along. So this is something that's significant when it comes to chartering all civilian flights, non-professional astronauts going into space. And Elon Musk was interviewed about this idea of in an interplanetary species. I mean, that's his goal, is to eventually colonize Mars. And whether you think of SpaceX or whether you think of Virgin Galactic, which is doing space tourism, or you think of Blue Origin, all of their goals are really to eventually make it so that it's sort of an airline travel, so that you and I could get on a spacecraft and go into space, whether that be spend several days in space or whether that be spend just a few minutes there and come back. That's the end goal, but really you have to lower the costs per ton to orbit in order to make that happen for everyone.
Yeah, still a long way to go, I suppose, on that front, but exciting to see the progress nonetheless. Ines Ferre bringing us the latest today. Appreciate that. Going to take another break here on the show. To wrap up, though, if you've been watching, maybe my skepticism of NFTs has come through on the program. Now Jay-Z getting caught up in an NFT battle of his own. We'll break that down and what it means for the larger picture of where the space heads right after this. Welcome back. We've been talking a lot lately about NFTs, and of course, it is a broad definition for what exactly a non-fungible token is, but it's essentially a digital tag attached to basically anything you want to put up there on these platforms, and that has now raised the specter of some legal disputes, some lawsuits being filed, and the latest to snag Jay-Z and the record company attached to one of his debut albums that was going to be put through as an NFT from someone who owned the rights to at least a portion of that debut album. And now We've seen a lawsuit sparked there. And for more on it, I just want to bring in Yahoo Finance's Brian Chung for a broader discussion around NFTs. And Brian, you're a sneaker guy, so like you already know about scarcity and value getting placed on things that a lot of people might disagree in terms of how much it's really worth. But I think that that's really what's going on in the NFT space, and it's tough to really have anyone say what's what.
Yeah, and I think that what's interesting about this news headline is there's just a lot of confusion about the ownership here. So basically, Damon Dash, who was part of Rockefeller Records, is in a feud with Jay-Z because he's arguing that he can NFT the Reasonable Doubt album, which is Jay-Z's album, because he says, well, I have a 1/3 stake in the record label, although the record label is saying you don't own, though, even if you have that stake in us. You don't mean you don't have that stake in the album as well. But it does bring over kind of just this broader point of what is the value of an NFT? How much would people be eager to invest in a share of a Jay-Z album, for example? And I think that the comparisons between NFTs to art to stocks is still very much an open question here. Is liquidity for the market for these types of things as relevant as it is for a stock or a bond on the market? But broadly speaking, I think most people would say art is more comparable to NFTs than it is to a security that's more tradable and more liquid, because there is a recency bias. People don't necessarily care as much about a given NFT or a piece of art, maybe X amount of years down the line, which means that there might not be as many counterparties to offer a trade with down the line through that ownership. So I just think it does raise a lot of these questions about ultimately who not only owns these things, but how do you actually assess intrinsic value with so many types of art and NFTs out there, Zach?
Yeah, the securities piece of this too is interesting because before, when we had the ICO boom back in 2017, it was really, you had to have some knowledge of how blockchains worked. But now with NFTs, you come up to these platforms, you mint whatever you want to mint, and then it's on the blockchain and you can trade that. And so we've seen a lot of people who might not have had experience in coding, basically your average retail investor minting things out there. And it might not be to the scale of a Jay-Z debut album here, but it is interesting to see how regulators move forward if it's going to ensnare a lot of people out there, your average Joes, as we see this take off. But the sneakers, Brian, as they always sit behind you, I think we can all agree, very valuable.
Thanks, Zach.
Very valuable. That's going to do it for us on the show today. Stay tuned, though. We got much more coverage coming your way here on Yahoo Finance Live as we see the Dow off more than 100 points. We're back in 2 minutes' time.
Hi, everybody. Welcome to Yahoo Finance Live. I'm Alexis Christoforous, and here's what's happening at this hour. President Biden is set to speak shortly from the White House about, quote, leveling the playing field in our economy. He's expected to make another big push for his $3.5 trillion spending package and the tax hikes that are meant to help pay for it. We'll bring you that president's speech live once it happens. Ford is taking the next step and bringing its own electric truck to consumers. Pre-production models of the Ford F-150 Lightning have started rolling off the assembly line at a plant in Michigan. Ford's President of Americas, Kumar Kalhotra, will be here to tell us when we can expect to see that EV truck in dealerships. And Starbucks workers in Buffalo, New York are leading a rare campaign to unionize. We have one of those workers with us today. Just the latest development in a pandemic-era reckoning on wages and working conditions. First to the markets, though, where stocks continuing to come under pressure here despite a nice rebound in retail sales last month and jobless claims that continue to hold near pandemic-era lows. The Dow off 146, the S&P down 19, the Nasdaq Composite giving back more than 50 points now. I want to bring in Yahoo Finance's Emily McCormick, who has more details on those economic reports, which were market moving earlier, Emily, but it seems like that enthusiasm has faded.
That's right, Alexis. Definitely seeing stocks moving to the downside here this afternoon, even after we got that stronger than expected report on August retail sales. Now, those actually unexpectedly increased last month, so suggesting that the consumer did hold up more strongly than expected despite the latest wave of the Delta variant. But the caveat in this data is that the fact that the categories that saw the biggest gains were those that are more aligned with stay-in-place type behavior. So a little bit of a virus impact when we take a look on case-by-case and industry basis here. But overall, we saw sales rise by 0.7% on the month. That was in compared to a drop of the same margin that had been expected. Now, this did come after a 1.8% drop in sales in July, which was downwardly revised from the 1.1% decrease previously reported. So again, some good news and some bad news in this morning's report. But as I was mentioning, the categories of sales where we saw some of the strength does point to some stay-in-place behavior. We saw non-store retailers or those e-commerce stores post sales increases of 5.3% in August. And we also saw grocery store sales up more than 2%. Now, by contrast, some of the categories more associated with going out and actually returning to in-person activities did post some moderation. We saw food services and drinking places sales be flat on the month, and clothing and accessory store sales were up by just 0.1%. Now, all in all, economists were still relatively upbeat about this report. Ian Shepherdson of Pantheon Macroeconomics wrote in a note this morning, quote, upside surprises of this scale don't come often, and this one indicates a real degree of resilience on the part of consumers, end quote. Now, Alexis, before I turn it back to you, want to highlight one other report that we got out from the Labor Department, and that is, of course, those weekly unemployment claims. Now, those did rise compared to the prior week, coming in at 332,000. That was 10,000 ahead of estimates. But again, just a slight uptick when we think about the prior week's pandemic era low of 312,000. So overall, some mixed data that we got out this morning, both on consumer spending and on the labor market picture overall. But of course, right now, it does seem like market participants are weighing the risk to the downside as we do have stocks moving lower this afternoon. Alexis?
All right, thanks for making sense of all that for us. Yahoo Finance's Emily McCormick. Want to continue our markets discussion and bring in Marcy McGregor, Managing Director and Senior Investment Strategist at Bank of America Merrill Lynch. Marcy, good to see you. So look, we had this really nice, surprising retail sales report that showed that consumers are still out there spending, even though the Delta variant was on the rise and continues to be. Were you surprised by that report?
Thanks for having me on, Alexis. I really wasn't surprised by this report. The consumer is strong. They have so much cash sitting in their checking and savings account. Wages are rising. I think what you've seen lately, though, is almost this divergence between the actual spending and confidence, which I think has really taken a hit from the headlines and the rise of the Delta variant. I would expect that that will fade. The consumer is going to become more and more mobile, and is still a key part of this economic growth story as we head into 2022.
You know, we have not seen a meaningful pullback in this market, not even a 5% pullback since last year. And so, you know, investors are sort of saying, When's that next shoe going to drop? When are we in for a correction? Do you believe we're going to grind higher here for the rest of the year, or is that correction in the offing?
I think it's going to be exactly that. I think it's going to be a grind from here because I think the next 5 to 10% higher in the equity market is going to be a bit harder to come by than the previous 100% off of those March lows. And September seasonals are weak, but I wouldn't expect this volatility to derail the market. My sense is that these pullbacks may feel sharp, but I think they're pretty shallow as well. I would see it as a buying opportunity. You know, one fact that I can't get out of my mind is how much cash is sitting in money market accounts. That is now at a higher peak than we saw at the lows of the market in 2009, and that's after the recovery from the COVID crisis. So much cash on the sidelines. I would expect pullbacks to be a buying opportunity, and that's what we've been saying to our clients.
Okay, so if you see it as a buying opportunity, what sectors do you like right now?
So we've taken a barbell approach to sectors. We have a preference for U.S. equities overall relative to the rest of the world. And this barbell approach, where on one hand, I don't think you abandon tech. You know, this is a free cash flow story. I think it's a dividend growth story. Tech will also be a beneficiary on CapEx, which I think is going to be key to the 2022 outlook. But on the other end of that barbell are cyclicals. I think that's ultimately what leads this market higher. So think about energy, which has significant operating leverage, financials, I think that's another capital return story once again, materials and industrials as well. So don't abandon tech, but I still like those cyclicals to once again lead the market.
Now, will your view on these sectors change when the Fed does the inevitable and starts to taper those bond asset purchases, which we are expecting them to do possibly before the end of the year?
Yeah, I think we're going to hear about that from the Fed next week. Our expectation is tapering may start in November, but here's what I have to say on this. Don't fear the taper. If you look back to the lessons of May of 2013, if you look at the S&P 500, if you push 6 months out from that taper tantrum, the market was up 8.7%. If you pushed a year out from the taper tantrum, the market was up over 15%. I think we get a more muted response this year, but I've been telling clients, don't fear the taper. And the early signals from Europe, I know Lagarde said she's not tapering, but they are reducing bond purchases, and she seems to have avoided a tantrum. So I wouldn't fear the taper when it comes to equity markets. It doesn't change our view. It's very different from being deep in a hiking cycle.
Right. All right. So Marcy, what do you see in terms of key drivers for this market in the fourth quarter?
Yeah, so I think once again, it's all about cash, whether it's cash on the corporate side driving CapEx. We're starting to see CapEx turning higher in earnings guidance and as well as in orders. And then cash on the part of the consumer that's going to keep spending. That's why we're getting inflation pressure, right? It's a demand story. So I think it's all about the consumer and CapEx and the cash that both of them are sitting on. That drives markets. I think it drives corporate profits, which we don't think have peaked. You may have seen peak growth, but you haven't seen peak earnings. That's what's underpinning this market.
So I don't hear in our conversation you very concerned about rising inflation and the supply chain hiccups that continue to paralyze parts of our economy and different industries. What's your take on inflation and how concerned should investors be and how should they be hedging against it?
I think the thing that we often forget about inflation is this is a function of stronger U.S. economic growth. Once again, it's a demand story. So on one hand, while I don't see it backing off, and I think many of these bottlenecks are reflective of a U.S. economy that's at capacity, probably at about 6.5%. So I think even once the noise is gone, we're going to still keep seeing inflation that's higher than certainly what we've been used to in the past. Now, that said, the big question is how does the Fed react, of course, but also it's for investors about positioning for higher inflation. Right now, it's a positive dynamic. Companies are passing through higher prices to the consumer who's been able to pay it, and that protects margins. So I would say it's equities over bonds, and it's those cyclical sectors that I think are really preparing our clients for what is going to be higher inflation going forward.
Marcy, if you could, before we wrap up, just connect the dots for me on this. You're saying we may have reached peak economic growth, but we haven't reached peak earnings. How do those two things, live side by side?
Yeah, so I think we're going to come off this, I think of it as almost a sugar high of this front-end loaded COVID relief from the Fed and from Washington. But you have a U.S. economy that I still think is going to grow above what we've seen as trend growth for the last few years, even as we look out past the second half of next year. Now, earnings, I hear so much buzz from my peers about peak earnings growth. Well, easy comps last year with how we saw earnings contract. Now, I think it's the absolute level of earnings. I think you have companies that have protected margins well. Like I said, they're passing through prices. And now that CapEx is, I think, going to be part of this dynamic, I think that you're going to continue to see strength in earnings, even if we're past peak growth. And one of the signals I love to look at is the earnings revision ratio. Wall Street analysts are still playing catch up in earnings. You're seeing them continue to raise their estimates. U.S. is leading the way globally, and you're seeing those cyclical sectors lead as well.
All right, Marcy McGregor, Managing Director, Senior Investment Strategist there at Bank of America Merrill Lynch. Thanks so much for being with us. And a reminder that you can step up your investment strategy today with a free 14-day trial for Yahoo Finance Plus. You'll get expert research reports, actionable investment ideas, advanced portfolio tools, and a whole lot more. It comes to you in a sleek ad-light experience. You can check it all out at yahoofinance.com/plus. Coming up next, we're going to be joined by a Starbucks worker in Buffalo who is trying to form the company's first U.S. union. We're back after this. Welcome back. A unionization effort led by Starbucks employees in 3 stores in Buffalo, New York, is now becoming a citywide issue. Joining us today is Michelle Eisen. She has been a barista at Starbucks for 11 years. We're also joined by Yahoo Finance's Danny Romero. And Michelle, I should mention, is joining us by phone. Michelle, thanks so much for making time for us. Just talk to us about this push to unionize and how your 11 years at Starbucks maybe has evolved or changed over the years to get you to this point?
Absolutely. Thank you for having me. I actually just walked off the floor from a 7-hour shift, so thank you for letting me come to you by phone. I have been with the company for 11 years. I've been a very proud member of the Starbucks team. I really respect what the company stands for and the right side of the fight that they're usually on. Unfortunately, the last couple of years, probably made a little bit worse or heightened by the pandemic, has put a lot of myself and my fellow partners in a position to where we think that our working conditions have suffered. And we think that Starbucks can do better. We know that they want to do better. They are a company who says that they put their partners first, and that's what we're asking them to do now.
And Michelle, you sent us a photo of Rosanne Williams, the vice president of Starbucks of North America, and she's sweeping the floors, which is really astonishing to see a top executive do that. But talk to us about some of these recent visits from these executives, and how would you characterize them?
Absolutely. I have been fortunate or unfortunate, I'm not sure, not to have been present at my store during any of these visits. They just seem to miss me. These are executives that we have never in the 11 years I've been with the company have I ever even seen them step foot into our market. So all of a sudden, a few days after we announced our union campaign, all of these people who I'd never seen were coming into town, telling us that they were coming here for reasons other than the fact that we announced a union campaign. They are holding mandatory meetings that we are being asked to come to. The first round, these meetings, I should say, are happening weekly. They were initially only happening at 3 stores that had filed union petitions, but in a recent letter that went out from our regional vice president, it seems like they are going to start holding these meetings at all of our area Buffalo stores. The first one was very, we're sorry, what can we do? Please, let us come in and help you. I've been told that this next round of meetings, I have not attended my second meeting yet, is much more vocally anti-union. I mean, they have said out loud, we want you to vote no to this union. So it seems to me they're going to get more and more intense. They're coming in, they've taken over, these high execs have taken over hiring of new partners from the store managers. I think the assumption is that they want to make sure that the next round of partners that comes in knows that they should be anti-union. So they've taken that out of the hands of the actual managers of these stores. It's been a very interesting experience.
Michelle, maybe we should just map out, because we haven't done it yet, what exactly are you and your fellow colleagues there at Starbucks asking for?
Well, I think the biggest thing we're asking for is just to have a seat at the table. I mean, we have to enact and carry out all of these policies and protocols that come down from up above, and we never have a say in these policies or protocols. We are the ones who are solely responsible for making sure that things happen within our stores, that things happen within our communities, and we have absolutely no say at this point in what those are. So that's the first thing, first and foremost. There's certainly a laundry list, and I think a lot of those can be store specific, which is exactly why we're trying to unionize individual stores as opposed to market wide at this point. There's issues with pay raises. There's issues, I'm a tenured partner. I've been with the company 11 years. At this point, someone who's hired tomorrow will make 16 cents less an hour than I make currently after being there for 11 years. That's a huge issue right now. We're dealing with facilities issues. We're dealing with supply chain issues. We're dealing with a lot of issues that we're being told couldn't be fixed, couldn't be handled until we announced a union campaign. And now all of a sudden there's a fleet of facilities people being brought into every store, and things that were broken for 6 months to a year are all of a sudden being fixed like it could have happened anytime. So we're just very confused as to why it took the announcement of a union campaign to all of a sudden have these issues addressed. It seems like they probably could have been addressed immediately all along.
And Michelle, one last note, Starbucks is now wants all of its employees across the 20 stores in the Buffalo area to vote on the union effort. What is your response to that? And are any of these tactics that they're using swaying your decision from unionizing?
None of them are swaying my decision. I do fear that there are younger people who have not been with the company for as long who would absolutely be scared into thinking that there is some sort of retaliation going on. Right now, their big talking points are telling partners that they cannot pick up shifts at other stores if the store happens to be unionized, or if you happen to be at a unionized store. They're telling the workers that the managers are no longer allowed to come onto the floor to help if it's busy. They're even addressing whether or not we would be able to still be tipped. I mean, there's a lot of issues being discussed, all of which are flat out lies. We know that anyone who knows anything about unions or labor laws or any other stores that have been unionized knows that those are completely untrue. So I do think that they're deliberately spreading misinformation in order to scare some of these partners who may be on the fence. What we're doing on the end of the union, those of us who are very pro and very strong, are just trying to alleviate these fears. We do have a hearing scheduled next week where they will argue that we should vote as a market as opposed to individual stores. We already know that the NLRB has dealt with this issue in the past. It's already been established. There's a precedent that says individual stores can unionize on their own. So I think we're very, very confident that the court will side in our favor when it comes to that. But it's another delay tactic. It's just to further delay this vote in order to hopefully sway enough people so that we are unable to form this union. I don't think they fully realize the level of support, but I think that they will very soon.
Yeah, Michelle Eisen, a barista there at Starbucks, attempting to unionize with her fellow workers in the state of Buffalo. Thanks for joining us and thanks for sharing your story. We're going to continue to watch as it unfolds. Also want to thank Yahoo Finance's Danny Romero for joining us. Coming up on the other side of the break, how job applications for remote work are surging. We're going to tell you the hottest markets next. may come as no surprise that job applications for remote work on the LinkedIn platform are up nearly tenfold from January of 2020. So what are the top cities for remote work? Thankfully, we've got Sabeel Marcellus here now to tell us in this installment of Career Control. Sabeel?
Job applications for remote work have more than tripled since last year. So LinkedIn put out a list of the remote work hotspots, and there are some surprises in there. First, I want to bring in George Anders. He's LinkedIn's senior editor-at-large to break this all down for us. Now, George, prior to the pandemic, it was major cities like New York and San Francisco that were the hotspots for job seekers. But in this new era of remote work, we're seeing those two cities dead last, and it's cities in the Sunshine State that are rising to the top in terms of most desirable places for people to live and work remotely. George, what's behind all that? Does it all come down to higher or lower costs of living?
So it's a lot of things going on at once. People have peeled out of some of the big cities. Living under all of the COVID restrictions can be pretty onerous. And if you move to somewhere smaller, that gives you a little bit more breathing room. Yes, your cost of living goes down, but the beach is closer. You can go for a walk, you can get on your bike, you can do whatever you want. So when we look at some of the metros where people are really eager to get remote work, where they're applying for a lot of remote work, these tend to be the kind of places that a lot of people go for vacation. As you can see on the grid, Cape Coral, Florida, Charleston, South Carolina, Tampa Bay, Jacksonville, Orlando. So, for a lot of people, this is just a better deal. You live where you want, and then you look for work somewhere else. And thanks to laptops and Skype and everything else, you've got the ability to stay connected and get a job that could be 1,000 miles away from where you're living.
And when I look at that list of the top remote work hotspots, 4 out of 5 for the larger cities are in the Sunshine State. So what's so great about Florida besides the warm weather? What's attracting
So
that?
we've got an extra dynamic going on in Florida, and that is Florida traditionally, their biggest industry is hospitality. And this is the home of Disney World. And, with the pandemic, a lot of those jobs have kind of been constricted. Fewer tourists have come. Places aren't open as much. So people need work. Even if they're already living there, they haven't made a move. They're going, where else can I get employed? What can I do? And the nice thing about remote work is you can tap into things like medical billing. You can tap into, blogging, social media work, software engineering. There are a lot of fields that you can do now without being in the same zip code or even the same time zone as your boss.
And why are San Francisco and New York City ranked as the cities with the lowest interest in remote work? Does it make financial sense for someone to, for example, live in New York City or San Francisco and get a remote job at a company based in Florida?
So that's a crucial question. I've lived in both New York and San Francisco at different times in my life. You earn a lot of money, you pay a lot of money. And if you stay in those cities and live there, you've still got all your expenses, but you're no longer getting that magic high-paying job that you can get locally. And remote work is solid, it's good, but if you're looking for 6 figures, that's a lot harder to make happen. So if you're in a city like New York or San Francisco, probably your dream job is still going to be close, and what you're going to look at in the remote spectrum is not really going to meet your rent. So for that dynamic alone, as long as you're in those kind of cities, you're going to want to find work there too, and participate in all the excitement of being in the city.
And has the interest, the surge that you're seeing on LinkedIn for remote work, has that increased competition for those remote work jobs versus on-site jobs? And what would be some good tips for someone who wants to secure one of these remote jobs?
Yep, we're seeing more than double the number of applications for these jobs compared with traditional physical ones. And that makes sense. People all over the country can apply for that job. You're no longer limited to just a small area. So if you want to make your application stand out, you've got to do all the classic things. Make sure you've got the right keywords in your resume. Reply early, follow up, see if you can get that first interview. Get a sense of the schedule with them of when it's going to be. It's a hard competition. In some cases, we're talking about more than 100 people going for the same job. But someone has to get hired, and hopefully it's you.
Exactly. Someone has to get the job, and LinkedIn's out there trying to position people for the ability to actually get that job. George Anders, it was great to have you on. Thanks so much.
All right, thanks, guys. Yeah, I got to keep that positivity going. I like that thinking. All right, coming up next, Ford's all-electric F-150 pickup truck is one step closer to becoming a reality for millions of drivers. We're joined by Ford's President of Americas next to talk about it. Company is taking the next step in bringing its own electric truck to consumers. Pre-production models of the Ford F-150 Lightning have started rolling off the line at a plant in Michigan. Ford's president of Americas and International Markets Group, Kumar Galhotra, is here now with some details for us. So, Kumar, first off, congratulations. The electric F-150 Lightning hasn't even gone on sale yet demand is so hot the company is already expanding production. Tell us exactly what's happening at that Michigan plant today and the investment that Ford is making there.
Yeah, thanks for having me. We introduced this vehicle at this very site about a year ago and started taking reservations. And the reservations have far outstripped what we were originally planning on building. So seeing that kind of interest in the vehicle, we immediately started working on breaking constraints both in our factory right here at the Rouge and in our supply base. So today we're happy to announce that we're investing $250 million incremental dollars and creating 450 incremental jobs in southeastern Michigan over three different plants in this area to meet that demand. So our capacity now will be more than will be about 80,000 units out of this plant, all F-150 like this.
That is definitely a sizable investment to try to meet this demand. When can we expect the truck to hit dealerships? And also give us an idea for what pre-orders are like right now.
So we priced the product very, very aggressively. It starts at under $40,000. It is a lot of fun to drive, and as all of our trucks, it's built for tough, and it's extremely capable. And you can also power your house with it in case you expect a power failure of some kind. The truck we're building, I'm in the plant right now. We're building pre-production vehicles as I speak. And it should start getting to our dealerships around spring of next year.
And when you say that, you say it's a starting price of $140,000, or is that it sort of, really blitzed out, Kumar?
No, it's starting price of under $40,000, $39,900 something.
Right. Okay. I'm sorry. I misheard you, and I don't know if other folks did too, but that sounds a lot better and a lot more accessible for folks. So starting at just under $40,000. Talk to me about some of the challenges. I mean, you're trying to get this truck out there during a pandemic. You're dealing with a global chip shortage and supply chain hiccups. What have you been experiencing while trying to produce this truck?
Yeah. So this year for overall production has been very challenging, not just for us, for the entire industry because of the wafer shortage that's led to the chip shortage. So we have a unbelievable manufacturing and materials planning and logistics team that is working 24/7 to get as many wafers and chips as we can, and then more importantly, deploy them in the products that our customers really truly need. So that is one challenge you mentioned. The second challenge, of course, unfortunately, COVID has continued, and sometimes the two intersect. For example, there's a chip supplier in Malaysia that didn't experience the chip shortage per se, but was hit with a substantial COVID outbreak. So when the two intersect, it causes more disruptions for us. But we're managing through it very well to the best of our ability. Third quarter production is going to be better than second quarter. And in the middle of that mix, getting the vehicles that our customers really want to our customers, we're also protecting our launches like this one. This is a very important launch for us, and we are doing everything possible to get the right chips to this vehicle line so that we can keep the launch on track for spring of this year.
A lot of people question whether or not truck buyers, would trade in their gas-powered workhorse, if you will, for an electric pickup that needs to be plugged in every day. By the looks of things, by the looks of the investment that Ford is making, you're pretty confident that the answer there is yes, they want an electric pickup truck.
Absolutely. So we know our truck customers very, very well. By the way, we had similar skepticism from a lot of folks when we launched the EcoBoost. People were telling us that truck customers only like V8, so the EcoBoost may not be successful, yet it was incredibly successful. And I think we're repeating a similar transformation here. Truck customers are very, very savvy. They know the electric motors can provide great torque, which they value. And as far as charging goes, it is actually quite simple. You know, you simply go home and plug it in. So it actually takes less time to do so than to fill up your tank. And you leave your house every morning with a quote unquote full tank. By that I mean a fully charged battery. And if you are going on a longer trip, it can get up to 80% charge within, at one of the high-speed chargers in less than 20 minutes. So it's extremely convenient. And I would argue that the proof of the is in the pudding, because the reservation numbers are so strong for us that ever since we launched it, our team has been working on continuously breaking constraints so that we can satisfy the demand. So yeah, the truck customers are ready for the F-150 Lightning.
Yeah, the last number I saw was 150,000 pre-orders. Is that accurate?
150,000 reservations, yes. So we've been taking reservations, and at some point when we get closer to production, the customers take that reservation and convert it into orders, and we expect majority of those reservations to convert into orders. And we followed a very similar reservation system both for our Bronco launch and for our Mustang Mach-E launch as well.
Yeah, there's a lot to look forward to here in certainly the fourth quarter, but in the spring of next year when this truck and the Bronco are going to hit dealerships. Kumar Galhotra, Ford's president of Americas and International Markets Group, thanks so much for being with us. Coming up, attention all sneakerheads. eBay is launching a rare opportunity. We've got all the details with sneaker expert Jacques Slade coming up next. Welcome back. eBay has launched a rare opportunity for sneakerheads. It's called eBay's Inside Drop, and it will celebrate and reward eBay's community of sellers, both new and old, with some of the rarest, most incredible friends and family sneakers on the planet. Joining us now to learn more about this drop event is sneaker expert and longtime eBay seller Jacques Slade, and of course our resident sneakerhead Reggie Wade. Good to have you here, guys. Jacques, with all the sneaker platforms out there, why do you think eBay sets it apart?
I think one of the key things about eBay that sets it apart is the fact that they have no seller fees. On a lot of the other platforms, they actually charge you to sell. And eBay, being an OG in the game, recognizes the value in the community. And they took away those seller fees if you're selling a sneaker over $100.
Jacques, it's great to see you again, my brother. Now,
Good to see you too, Reggie.
Tell us about what are some of the pairs that are up for grabs in this drop?
I think the most popular pair is probably going to be the Fragment Air Jordan 1 that came out about 5 or 6 years ago. It's a collaboration with Fragment Design and Jordan Brand. And that sneaker, as a friends and family sneaker, goes for about $8,000, maybe a little more, depending on where you get it from.
And we all know something that dismays many sneakerheads is bots. And we all have to deal with them when we're trying to get these shoes on release day. And it's taken away some of the joy out of people. I've known people that said, I'm leaving the sneaker game because of this. Do you think the larger companies like the Nikes and Adidas of the world are doing a good job in trying to root them out?
I think they are doing a good job of trying to root them out. It's a very difficult process. It's like a moving target. Like a lot of these people that make bots, they're constantly refining and constantly improving the things that they're doing for their systems. And so it makes it harder for these brands to keep up. But I think the brands know how this is affecting the community, and they're getting a lot of pushback from the community. So it's in their best interest to try their best to fix things and get rid of those bots as much as possible. So you see a lot more raffles happening. Nike has their draw on the sneakers app. Adidas has confirmed on their confirmed app. So these brands, they're definitely taking the steps to make it possible so that the consumer can actually get the shoes and that they're not dealing with the bots.
Speaking, do you think that's why it's a better option to go on secondary sites like eBay so that you don't have to deal with them?
Yeah, that's one of the benefits of going onto the secondary market directly. You don't have to deal with the bots. You know the sneaker that you want. If you're on eBay, you can just simply do a search and you can find that sneaker right away, and then you can place a bid or make an offer on that sneaker right then and there. You don't have to worry about the bots and the shoes selling out because you have them there with the inventory that's right on eBay.
How has it been working with eBay? Because they're not a shoe marketplace. They're a marketplace for many things. But how have the sneaker people on the site interacted with you? And do you really feel that it's truly run by sneakerheads?
Luckily, I've been inside some of the meetings with eBay, and I do know that they have some sneakerheads on the staff that are working. So that definitely made me feel comfortable in establishing a relationship with them and working with them as a creative consultant and a sneakerhead. And I do believe that sneakerheads do have a better chance of getting what they want on eBay. There's other platforms out there, but when it comes to someone that I think is really taking a look into the community and making themselves a part of the community, I don't see anyone doing it quite like eBay is doing it.
Jax, how do you think the pandemic has changed the way that the sneaker community interacts with each other? Because I remember before the pandemic going to shows and going to stores, being able to touch these things, these sneakers, but that's changed. Do you think it's changed for the better or for the worse?
I don't want to say it's for the better or for the worse. I think it's just forced this community and really everyone to just look at things differently and interact with each other differently. A lot of these conversations are happening on Zoom and things like that. So sneakerheads are interacting a lot more online versus important. The sneakerhead community is a very communal group. People used to line up together. Some of the best friends that I have, I've met in the world of sneakers, either standing in line or at an event or something like that. So there's a very communal nature to the world of sneakers. for the pandemic, in that situation, obviously that communal aspect isn't there, but it has allowed us to get together digitally. So you see events happening online or through Instagram or talking on Twitter or talking on YouTube. So you have these platforms that have really risen up, and that's kind of become the communal place. That's where we have conversation. Doing live chats with the sneaker consumer is a big thing now. So I'll do live chats on my channel where I'm talking to the consumer directly because we can't really meet with them in person anymore. So yes, it has changed some aspects of the sneaker community, but it's just allowed us to find other avenues to have those same conversations and to share those same passions in different ways.
Jack, do you think the bigger brands are listening more to the sneaker community? Because I remember back in the day, they just gave us what they felt we wanted, but it looks like they're starting to listen to us sneakerheads a little bit more. Do you think that's true?
Yeah, absolutely. I think we, as a collective, we all have a voice. And one of the biggest changes I think we've seen in the sneaker world is the influence of women. Women have always been a part of the sneaker culture, but their voices haven't always been heard. And I think over the last 2, maybe 3 years, you've seen a huge influx of women and into the conversation of sneakers, and women in positions at brands and being a decision maker at a brand, and brands pushing the women forward and having them out there in the public to know, like, this is a larger community. Yes, there's a ton of guys in it, but there's a huge community of women that have contributed to the sneaker world in ways that I can't even imagine. And now we're really starting to see the things that they've been doing to this community and how they're helping to push the community forward as well.
Jackson, I'll put you on the spot. What sneaker made you a sneakerhead?
Oh my gosh, the sneaker that made me a sneakerhead. There's a couple. And it's not the main one. I would say it's not probably the most popular sneaker, but it's the Converse Chuck Taylor. I wanted to be a musician as a kid, and it seemed like every time I watched TV, all the cool musicians had on like the low top Converse Chuck Taylors that were all beat up. And so I think that's the shoe that kind of turned me into a sneakerhead, because I wanted to be cool like those musicians. And in order to be cool like a musician, you know, you've obviously got to have the same shoes they have on. So that's where it all started for me.
It all starts from the feet up, right? Jacques Slade.
Absolutely.
And Reggie Wade, thanks, guys. I learned a lot. And look, it's a huge industry, $21 billion sneaker industry, but $2 billion resale industry. So there's a lot at stake. Guys, thanks again. And don't go anywhere, because coming up next, we are waiting for President Biden to outline his administration's goal of raising taxes on the wealthy to strengthen the middle class and boost the economy. We're waiting for his remarks after this. President Biden is set to speak shortly from the White House about, quote, leveling the playing field in our economy. He's also going to make a push for raising taxes on the wealthy to pay for that $3.5 trillion spending package and to help boost the economy and help the middle class. Our Washington correspondent, Jessica Smith, here now with a preview of what we expect the president to say. Jess?
Yeah, Alexis, we expect the president to really make the case for his economic plan, as he calls it, the Build Back Better plan. The White House says that he'll talk about how to bring down cost and ensure the backbone of the country, the middle class, can finally get a break. So the president is going to argue that Congress should pass his economic plan, which will include tax hikes on the wealthy and on corporations, as well as expanded social programs. President Biden is reportedly going to say that the U.S. cannot go back to the way things were before the pandemic, and that the U.S. can't let the richest Americans and the biggest corporations play by their own set of rules. Now, the plan, as we have talked about, is also going to include proposals that President Biden says will help parents afford to raise kids. It will help them care for aging parents or aging elderly family members. They also say that it's going to lower health care costs and much more. But that $3.5 trillion plan right now is in a pretty precarious position, as you have moderates and progressives within the Democratic Party fighting with each other about what this package should look like. The House is expected to come back to Washington next week and start compiling all the individual pieces of legislation into one big reconciliation package. So we expect today to hear President Biden encourage Congress to pass that plan and just try to build support among the public for it. Alexis?
All right, Jess, thanks so much. And a reminder that once the president begins to speak, we will bring that to you live. Taking a look at the markets, we're lower, but off our worst levels of the day. Still a triple-digit decline for the Dow. Oh, actually, scratch that. It's now down 98 points. The S&P 500 off 12. The Nasdaq down 18. Let's take a deeper dive into the Dow Jones Industrial Average right now. I want to take a look at some of the winners and losers there, because the last time I checked, there were just 6 Dow stocks that were actually in the green. We have got a little bit more than that right now. Salesforce, Amex, Home Depot, McDonald's, JP Morgan, also Walmart is higher among the Dow stocks today. Taking a look at some of the biggest losers for the Dow, we have got Goldman Sachs, Merck, Intel, Walgreens, and Dow, all of those pulling on the Dow the other way. And also want to take a look at the bond market, because we are seeing some activity there today. Things are rallying. We've got the yield on the 10-year Treasury up now nearly 2% to 1.33%. Haven't seen that in a while. And the yield on the 30-year is now up about 0.5% to 1.88%. You know, this is happening, folks. The market is a bit lower today, even though we got some pretty nice and encouraging economic news. Retail sales rebounding in the month of August, up 0.7%. And that's despite the rise we continue to see in the Delta variant across the country, and also those jobless claims continuing to hang out near those pandemic era lows. We've got much more to come. More on the markets for you right after this. It is just about 2 p.m. Here on the East Coast. Welcome back to Yahoo Finance Live. I'm Alexis Christoforous. The market's still under pressure, but well off its worst levels of the day. We did get some good economic news earlier. Retail sales rebounded in August, up 0.7%. And that's despite that rise in the Delta variant across the country. Also, continuing to see that the job market is healing. Jobless claims continue to hold near a pandemic-era low after being down triple digits really for most of today. The Dow now down just 83, the S&P off 10, the Nasdaq giving back 11. Let's take Okay, we want to toss to President Biden now live at the White House.
Put before the Congress. I know we still have a long way to go, but I'm confident the Congress will deliver to my desk both the bipartisan physical infrastructure plan and the Build Back Better plan that I have proposed. And I've said many times before, I believe we're at an inflection point in this country. One of those moments where the decisions we're about to make can change, literally change the trajectory of our nation for years and possibly decades to come. Each inflection point in this nation's history represents a fundamental choice. I believe that America at this moment is facing such a choice. And the choice is this: are we going to continue with an economy where the overwhelming share of the benefits go to big corporations and the very wealthy? Or are we going to take this moment right now to set this country on a new path, one that invests in this nation, creates real sustained economic growth, and that benefits everyone, including working people and middle-class folks? That's something we haven't realized in this country for decades. The data is absolutely clear. Over the past 40 years, the wealthy have gotten wealthier, and too many corporations have lost their sense of responsibility to their workers, their communities, and the country. Just look at the facts. CEOs used to make about 20 times the average worker in the company that they ran. Today, they make more than 350 times what the average worker in their corporation makes. Since the pandemic began, billionaires have seen their wealth go up by $1.8 trillion. That is, everyone was a billionaire before the pandemic began. The total accumulated wealth beyond the billions they already had has gone up by $1.8 trillion. Simply not fair. And how is it possible that 55 of the largest corporations in this country paid $0 in federal income taxes? They made over $40 billion in the year 2020, and they paid zero. Think about that. $0 in federal taxes on $40 billion in profits. How is it possible that the wealthiest billionaires in the country can entirely escape paying income tax on what they've made? How is it possible for millionaires and billionaires that can pay a lower rate of tax than teachers, firefighters, or law enforcement officers? Here's the simple truth. For a long time, this economy has worked great for those at the very top, while ordinary, hardworking Americans, the people who built this country, have been basically cut out of the deal. And I've said this from the time I announced I was going to run. I believe this is a moment of potentially great change. This is our moment to deal working people back into the economy. This is our moment to prove the American people that their government works for them, not just for the big corporations and those at the very top. When I was sworn in as president, the nation was struggling to pull out of the worst economic crisis since the Great Depression. Job growth was anemic, with just over 60,000 new jobs per month in the 3 months before I was sworn in. Then we went to work and passed the American Rescue Plan back in March. And it worked. It's still working. Over the last 3 months, we've been creating on average 750,000 new jobs per month. Our economy is growing at the fastest rate we've seen in nearly 40 years. Our recovery is unique in the world. We're the only developed country in the world whose economy is now bigger than it was before the pandemic. While this is all good news, I know many Americans are still struggling to make it through each and every day. For too many, it's harder and harder to pay the bills, food, gas, rent, Healthcare, I get it. We still have a long way to go to get the economy where it needs to be. As I've said for a long time, coming out of this economic crisis as deep as the one we're in was never going to be easy, but we're doing it, and we can continue to do it. COVID, supply chain issues, bad actors seeking to profit off the pandemic are all contributing to the challenges we're facing. That's why I've made getting COVID under control my top priority from my first day as president. Everything from our public health to our economy depends on this. We've made enormous progress against the virus through the summer, and now we put ourselves in a strong position to battle this Delta variant. That's why the actions I proposed on vaccines last week are so critical. From requiring federal workers to get vaccinated, requiring healthcare workers to be vaccinated, requiring employers with over 100 employees to institute vaccine and/or test protocols, calling on for them to be able to know what their employees are doing before they walk through the door, calling for vaccine or test requirements to enter big venues, and a whole series of steps I propose to protect our kids in schools. Wall Street firms have analyzed the impact of these plans, and they're projecting that these new requirements will help 12 million more Americans get vaccinated, which will help more businesses stay open and more Americans back to work. The data shows that the overwhelming majority of Americans agree with my proposal. There's no surprise, given that 76% of American adults have already gotten at least one shot. But we're facing a lot of pushback, especially from some of the Republican governors. The governors of Florida and Texas are doing everything they can to undermine the life-saving requirements that I proposed. And some of the same governors attacking me are in states with the strictest vaccine mandates for children attending school in the entire country. For example, in Mississippi, children are required to be vaccinated against measles, mumps, rubella, chickenpox, hepatitis B, polio, tetanus, and more. These are state requirements. But in the midst of a pandemic that has already taken over 660,000 lives, I propose a requirement for COVID vaccines, and the governor of that state calls it, quote, a tyrannical type move? A tyrannical type move? This is the worst kind of politics, because it's putting the lives of citizens of their states, especially children, at risk. And I refuse to give in to it. These policies are what the science tells us we need to do. They're going to save lives. They'll protect our economic recovery as well and allow the economy to continue to grow. We're also going after the bad actors and pandemic profiteers in our economy. There's lots of evidence that gas prices should be going down, but they haven't. We're taking a close look at that. Taxpayers in this country also have paid for extraordinary effort to keep our country going over the past year or so. Unlike the last administration, which resisted oversight and allowed taxpayers to be victimized by fraud, we're working hard to protect vulnerable Americans from having their identity stolen. As a consequence, their unemployment checks stolen as well. And we're going to offer organized criminals, we're going to go after organized criminals that defraud America or misuse COVID funds. Look, we're also taking a closer look at places in our economy where fewer and fewer corporate giants are controlling more and more of the marketplace in the areas they work. Just look at agriculture and the food industry. A very small number of giant corporations now dominate the market, which gives them the ability to drive up prices because they face so little competition. As we work to build healthier competition in our economy and crack down on bad actors, the American Rescue Plan, which we passed in March, is still working to give hardworking Americans, hardworking people, some relief. One of the best examples of that relief is the expansion of the child tax credit, which in effect is essentially a historic tax cut for families with children. Just yesterday, 39 million working moms and dads got their direct payment. That money is going to help cover groceries, the mortgage, new pairs of shoes, all the things that kids need. It's a tax cut for working families. So we're working to provide as much relief as we can right now to American families. But here's the truth. Yes, the pandemic has caused a lot of economic problems in the country. But the fact is, our economy faced challenges long before this pandemic struck. Working people were struggling to make it long before the pandemic arrived. Big corporations and the very wealthy were doing very well before the pandemic. That's why I've said, starting back in my campaign for president, that it's not enough to just build back. We have to build back better than before. And that's how it all begins. Big corporations and the super wealthy have to start paying their fair share of taxes. It's long overdue. I'm not out to punish anyone. I'm a capitalist. If you can make $1 million or $1 billion, that's great. God bless you. All I'm asking is you pay your fair share. Pay your fair share, just like middle-class folks do. But that isn't happening now. Today in this country right now, the top 1%, for example, evade an estimated $160 billion in taxes that they owe each year. Not new taxes, taxes that they owe. And the way it works is this. If you're a typical American, like I suspect most of the press people sitting in front of me here, you pay your taxes. Why? Because you get a W-2 form. It comes in the mail every year. The IRS gets that information as well. Your taxes get deducted from your paycheck, and you pay what is owed beyond that. That's why 99% of working people pay the taxes they owe. But that's not how it works for people with tens of millions of dollars. They play by a different set of rules, and they're often not employees themselves. So the IRS can't see what they make and can't tell if they're cheating. That's how many of the top 1% get away with paying virtually nothing. It's estimated by serious economists that that number is about $160 billion collectively owed each year that doesn't get paid. It's not an even playing field. My plan would help solve that. For example, it would give the IRS the resources it needs to keep up with the lawyers and accountants and the super wealthy. It would ask just for 2 pieces of information from the banks of these folks, that amounts that come into their bank accounts and what amounts go out of their bank accounts, so that the wealthy can no longer hide what they're making, and they can finally begin to pay their fair share of what they owe. That isn't about raising their taxes. It's about the super wealthy finally beginning to pay what they owe, what the existing tax code calls for. Just like hardworking Americans do all over this country every tax day. Look, and like I said just a few minutes ago, 55 of the most profitable corporations in America paid 0 in federal income taxes on what amounted to $40 billion in profit. Not a penny. That's not right. My economic plan will change that. Not punish anybody, just make them pay their fair share. But my Republican friends in Congress don't want to change the law. So what are they doing? They're attacking me and my plan, which is fine. But if you're going to have a debate, let's have an honest debate. My Republican friends are attacking my plan, saying it's big spending. Let me remind you, these are the same folks who just 4 years ago passed the Trump tax cut, totaling almost $2 trillion in tax cuts. A giant giveaway to the largest corporations in the top 1%. And listen to this, almost none of that $2 trillion tax cut was paid for. It just ballooned the federal deficit. In fact, the unpaid bills racked up by the last administration are projected to increase the national debt by more than $8 trillion over time. What I'm proposing is totally different from that approach for 3 reasons. First, my plan is paid for. It's fiscally responsible. because our investments are paid for by making sure that corporations and wealthy Americans pay their fair share. Second, we're not going to raise taxes on anyone making under $400,000. That's a lot of money. Some of my liberal friends are saying it should be lower than that. But only corporations and people making over $400,000 a year are going to pay any additional tax. And third, not only will no one making under $400,000 see their taxes go up, the middle class are going to get some tax cuts, some breaks. My plan benefits ordinary Americans, not those at the top who don't need the help. It's a historic middle class tax cut, cutting taxes for over 50 million families. My Republican friends are making a different choice, though. They'd rather protect the tax breaks of those at the very top than give tax breaks to working families. It's that simple. But let me ask you this. Where is it written that all the tax breaks in the American tax code go to corporations and the very top? I think it's enough. I'm tired of it. For me, it's pretty simple. It's about time working people got the tax breaks in this country. That's what my plan does. And here's what it also does. By asking big corporations and the very wealthy to pay their fair share, it makes it possible to invest in America, to invest in the American people. According to leading economists, forecasters like Moody's and major international financial institutions, my plan will create jobs, make us more competitive, and grow our economy and lessen, not increase, inflationary pressure. I don't know if it's been handed out today, but by the way, 15 Nobel laureates in economics released a letter yesterday arguing that exact same point. They said, and I quote, and this is from 15 Nobel laureates in economics, quote, because this agenda, the one I'm talking about, mine, because this agenda invests in long-term economic capacity and will enhance the ability of more Americans to participate productively in the economy, it will ease long-term inflationary pressures. It will ease it. Let me highlight just a few provisions of my plan. I know this is long and I apologize, but it's important, I think. My plan lowers the cost of daycare and childcare and elder care for families. And the added benefit of allowing millions of people, mostly women, who are not able to go back to work because of very young family members or elderly people they're taking care of. Allow them to go back to work. It's estimated in the millions can't go back. It lowers health care premiums for millions of families. It lowers prescription drug costs by giving Medicare the power to negotiate lower drug prices. And it strengthens Medicare by adding dental, vision, and hearing coverage if you're on Medicare. It also extends a tax cut for families with kids that we passed in the American Rescue Plan in March. All of this will mean thousands of dollars in savings for the average American family on some of the toughest and most important bills they have to pay every month. My Republican friends talk a lot about inflation, but if you want to talk about actually lowering the cost of living for people in this country, my plan does just that. By strengthening the capacity of our economy, it will also reduce inflationary pressures over the long run. Here's something else my plan does. It confronts the crisis of extreme weather events that we're seeing all around us and around the world, but just here in America. We see it everywhere. We know it's real. In just the past few weeks, and there's more to come, I've seen the destruction of hurricanes in Louisiana, where winds got up to gusts to 179 miles an hour. A deadly toll from flooding in New York, where 20 inches of rain, in New Jersey, more than 11 inches of rain in some areas. More than 5 million acres of our lands and communities have burned to the ground in wildfires just this year alone. That's more than the size of the entire state of New Jersey burned to the ground. When I was out in California, I flew over some of these areas. In addition, there's a severe drought in the West and the Midwest. There's a blinking code red out there for the nation. We can't wait to act. Extreme weather just last year cost the American public $99 billion in damage. $99 billion in damage last year. And unfortunately, we're likely to break that record this year. And the evidence is overwhelming that every dollar we invest in resilience saves $6 down the road when the next fire doesn't spread as widely or the power station holds up against a storm. We need to rebuild with resilience in mind, so roads are built higher, levees are built made more stronger, transmission lines are better protected, and so much more. You know, I hope we're past debating climate change in this country. Now we have to act, and we have to act fast. And my plan does that. Let me end with this. This pandemic has been god-awful for so many reasons. The lost lives, as I said, over 660,000. The jobs, the businesses lost, the lost time in school for our kids. But it does present us with an opportunity. We can build an economy that gives working people a fair shot this time. We can restore some sanity and fairness to our tax code. We can make the investments that we know are long overdue in this nation. That's exactly what my bipartisan infrastructure plan does. I should say our bipartisan infrastructure plan does. Investments in roads, bridges, highways, clean water in every home and every school, universal broadband, quality, affordable places for families to live. And we can invest in our people, giving our families a little help with their toughest expenses, like daycare, childcare, elder care, prescription drugs, healthcare, preparing the young people to compete against any country in the world with preschool and community college. We can confront this crisis of extreme weather and climate change and not only protect our communities, but create new opportunities, new industries, and new jobs. In short, this is an opportunity to be the nation we know we can be. A nation where all of us, not just those at the top, are getting to share the benefits of a growing economy in the years ahead. Let's not squander this moment trying to preserve an economy that hasn't worked too well for Americans for a long time. Let's not look backward, just trying to rebuild what we had. Let's look forward together as one America, not to build back, but to build back better. Thank you all very much. God bless you all. May God protect our troops. Thank you.
Mr. President, what kind of impact does it have when celebrities like Nicki Minaj?
About, I'm going to say, almost 20 minutes there, pushing his $3.5 trillion spending plan and outlining how he hopes to pay for it. And that includes raising taxes on the wealthy to help what he says the middle and the lower class. We've got Jessica Smith, our Washington correspondent here now, who was listening to that. And just what are some of the big takeaways? Because he went through a lot there in that speech, including his vaccine mandate and the hurricanes. But we know that the message was really about the economy.
Yeah, he did cover a lot of ground in that speech, talking about his economic agenda, just trying to build support for both the bipartisan infrastructure plan and that $3.5 trillion reconciliation package that Democrats are still arguing over what it should actually look like. So I think in that speech, he was trying to build support among Americans, but also urging lawmakers to get this done. We heard him say that the U.S. is at an inflection point that could change the trajectory of the nation for years to come. He said there is a fundamental choice whether the U.S. will continue with an economy that he says benefits mostly the corporations and the wealthy, or will the U.S. set on a new path that benefits everyone. Most of that speech, or a good chunk of that speech, as you mentioned, was focused on raising taxes on the wealthy and on big corporations. You heard him contrast his plan
with the 2017 tax cuts that Republicans put in place. President Biden saying that his plan is paid for, that his plan will benefit the middle class, and that he's trying to get the richest in America to pay their fair share. As you mentioned, he did talk about the vaccine mandate as well, addressing some of that criticism that we've heard from Republicans that say vaccine and testing mandates should not be in place. And again, he argued that that is the best way to save lives, get people back to work, and get businesses open again. The House is set to come back and start putting together this reconciliation package into one big piece of legislation next week. And there are a lot of divides between progressives and moderates. The president did say in that speech that he's confident they'll get both the infrastructure and reconciliation bill on his desk. So we'll see if President Biden is able to accomplish that in the weeks ahead. Alexis.
All right, Jess Smith, thanks so much. I want to bring in Chris Versace now for some quick reaction. He is Chief Investment Officer at MACAU Research. Chris, thanks for standing by. I know you were listening to the president, as we all were. What is your take on his plan to raise taxes? And do you think it's really going to make a marked difference to investors if it does indeed become reality?
Well, I think the real question is, there was a lot of talk in there. I would say that was a everything in the kitchen sink type of speech. I'm not really sure what we're going to see come out of this. This has to go back, to Congress, and we'll see what they haggle out. That's when I think investors are really going to start focusing on what the potential is. As what we saw today, again, there's a lot of, how do we say, this is what I want, this is what we need, this is what we should do. The rubber's going to hit the road coming out of Congress. And again, I think that as that crystallizes and we have these divides start to fall and 1, 2, 3 plans start to crystallize, that's when the folks on Wall Street are going to start to really roll up their pencils and roll up their sleeves, pull out their pencils and focus on what sectors are likely to benefit, what sectors are likely to be hit, and how to position themselves for what comes next.
In the 30 seconds I have left, what sectors do you like given the economic backdrop right now, Chris?
I'll give you more specifics. I actually love Costco here. I like Target as well. Those companies are enabling what we call the cash-strapped consumer to extend the disposable dollars that they have. And between the two, if I had to pick one, it's Costco all day long.
All right, we're going to leave it there. To be continued for sure. Thanks for your patience, and we'll have you back soon to talk about some of your other stock picks. Chris Versace of MACAU Research, thanks so much. Stay with us, though. Much more here on Yahoo Finance Live, including continued market reaction to President Biden's speech. That's going to do it for me. I'm Alexis Christoforous. Thanks for watching. We're back right after this.
Welcome back to Yahoo Finance. I'm Shauna Smith. We've got 90 minutes until the closing bell, and you're looking at losses across the board. The Dow, S&P, and Nasdaq all moving to the downside. President Biden just wrapping up his speech on the economic recovery, pushing his agenda forward. We, of course, will recap that for you in just a bit. But as we do come out of that speech, you are looking at the market off of the lows of the day. The Dow off 63 points, S&P off just around 0.2%. The Nasdaq barely in negative territory. In terms of the sector action that we are looking at, materials and energy are the laggards so far today. Let's kick things off with one of the big stories that investors are watching. That's the econ data that we got out this morning. Retail sales and jobless claims, a little bit of a mixed picture, but let's start with those stronger than expected retail sales numbers that we got out. 0.7% increase here in the month of August. Emily McCormick has more on that for us. Emily.
Well, Shauna, as you mentioned, an upside surprise in this morning's retail sales data, that coming in well above consensus expectations and suggesting that the consumer has actually held up better than expected despite the latest wave of the Delta variant. Now, overall sales rose by 0.7% in August compared to July. That was compared to a drop of the same margin that had been expected. Though we should also mention that this came after a 1.8% decline in retail sales in July, which was downwardly revised from the 1.1% decrease previously reported. So definitely some good news as well as bad news in today's report. And one other thing that is worth pointing out is that the August retail sales increases by category really pointed to some more stay-in-place behavior by consumers and a shift back towards goods spending. Now, notably, we saw non-store retailers or e-commerce sales rise by 5.3% in August, and we also saw grocery store sales up more than 2%. And then on the flip side, some of the categories that are more associated with people going back out did post some moderation. We saw food services and drinking places sales come in flat for the month of August, and clothing and accessory store sales were up by just 0.1%. But all in all here, economists are still relatively upbeat when it comes to the landscape for the consumer spending picture, at least. And one note in particular that stood out to me was from Ian Shepherdson of Pantheon Macroeconomics. And what he said in a note this morning was, quote, upside surprises of this scale don't come often, and this one indicates a real degree of resilience on the part of consumers. So Shauna, again, a 0.7% increase in August versus a 0.7% decrease expected. So definitely an upside surprise here for retail sales.
And Emily, another key number that the street was very closely watching was that jobless claims number. Now heading in the wrong direction, up another 20,000 to a seasonally adjusted 332,000 for the most recent week. I guess, what does this tell us just about where we are in the recovery? Because we know the labor market has been one of the areas of concern here for investors when we talk about getting to the other side of this pandemic.
Well, absolutely. Of course, as you mentioned, we did see a bit of an uptick here in the initial jobless claims figure for this latest data. But we have to remember, too, that for the prior week, we were at the lowest level since March 2020. That was at 312,000. So not really too much of some backsliding that we're seeing here. And one other data point that I like to look at every week is, of course, the total number of claimants across both state and federal programs. And what we saw in this latest report is that as of August 28th, the total number of claimants was at 12.1 million. That did increase on a week-on-week basis, but we're still down significantly from the same week last year when we had total claimants of more than 30 million. And then one other thing that we have to keep in mind is that this data is on a multi-week delay, so we aren't capturing that impact of the ending of these federal enhanced unemployment benefits that took place at the national level on September 6th. So in the coming weeks, we are likely going to see that overall claimants number come down even further. And again, all pointing to the fact that, firings and separations aren't really the main drag on the labor market right now. It really is about meeting the demand from the employers. Shauna.
All right, Emily McCormick, thanks so much. Let's get to the other big story that we are watching. President Biden wrapping up his speech on the economic recovery just a few minutes ago. Now, his focus was, of course, on leveling the playing field, pushing some of the Biden administration's economic agenda. We want to bring in Jessica Smith for the latest on that for us. Jess, what stood out to you?
Yeah, Shauna, well, President Biden was trying to build support for his economic plan while encouraging Congress to actually pass it and get this done. Democrats are, of course, arguing over what this plan should look like. But the president also addressed much of the criticism that he's been facing from Republicans. He contrasted his plan with the 2017 tax cuts that Republicans passed. He said that he wants to make sure that the richest people and the biggest corporations are paying their fair share. His plan, of course, is likely going to be paid for in large part by those tax hikes. And he says the plan as a whole will benefit middle-class Americans and actually reduce inflation with things like the child tax credit, lower child care costs. He stressed that the U.S. is at an inflection point, which he says could change the trajectory of the nation for years to come. He says that the U.S. should not just go back to the way things were before the pandemic, but should use this moment to change things for the better. Let's watch.
Each inflection point in this nation's history represents a fundamental choice. I believe that America at this moment is facing such a choice. And the choice is this: are we going to continue with an economy where the overwhelming share of the benefits go to big corporations and the very wealthy? Or are we going to take this moment right now to set this country on a new path? One that invests in this nation, creates real sustained economic growth, and that benefits everyone.
We also heard the president defending his vaccine and/or testing requirements that he announced last week. Of course, he has faced quite a bit of criticism from many Republicans on that front. The president reiterating that he believes it is the best way to save lives, to get people back to work, and to reopen businesses. But of course, Shauna, he is going to need Congress for most of his economic agenda. He did say he was confident that he would have the bipartisan infrastructure plan and the reconciliation bill on his desk. We will see what they're able to get done in the weeks ahead as Democrats continue to try to figure out what exactly is going to be in those packages.
Just lawmakers are facing a number of deadlines. You mentioned the fact that we have the infrastructure bill, also the reconciliation bill, and then, of course, we have the debt ceiling, and that's something that we were focusing on yesterday, just in terms of what that could potentially look like, how important that is for the economy and the markets going forward. When it comes to the timing of all this, any idea of what this could potentially look like as we wait for some of these events to unfold over the next couple of weeks?
Yeah, it's going to be a hectic few weeks here in Washington. I think that's safe to say. We have September 27th coming up. That is the date that Speaker Pelosi promised moderates they would take up the bipartisan infrastructure bill. But you also have progressives saying they won't vote for that until they consider the reconciliation bill. But they're still working on getting that bill put together. The House is going to try to take all of the individual pieces of legislation and put it into one next week. Of course, they still have to debate with the Senate. The government is set to run out of money at the end of the month, so they're dealing with a government shutdown. The House is set to start thinking about a short-term spending bill to keep the government open next week. And then, of course, as you mentioned, you have the debt ceiling. We think that we'll hit the debt ceiling at some point in October. The timing is pretty uncertain there. And Republicans have really dug in and said they are not going to vote to address the debt limit. They are leaving that to Democrats. Democrats should say it should be bipartisan. So that is a big standoff that we're going to be watching over the next couple weeks. So a lot to get done here. Again, you heard the president say he's confident, but we'll see what happens.
All right, Jessica Smith, certainly not the last on this. So we, of course, will continue to get updates from you. Thanks so much for bringing us the latest. We are going to take a quick break, but when we come back, of course, it's NFL, it's football season. And I don't know if you caught this, but last weekend, this clip ended up going viral on social media. The Panthers clip is being called a, quote, milestone in augmented reality. You can see the Panther there stomping all over the field. We are going to talk to the company behind this and what this potentially means for the sports world going forward. We have that for you when we come back. It's football season, and if you were watching the highlights of the games last weekend, you might have caught this viral video of a panther. Now, this is ahead of the Carolina football game on Sunday, leaping around the stadium. Well, we've got the company behind this very, very cool technology, and for that, we want to bring in John Slusser. He's the owner of the Famous Group. And John, lots of people were very excited about this. Certainly, it was all over social media over the past several days. I guess just talk to us just about what goes into something like this and what you see as the future of this when it comes to sports.
Yeah, thanks so much. This has been a wild few days for our company. We're thrilled at the response because it has taken a lot of work. And you talk about what it takes. It takes a lot of people, a lot of time, and a lot of technology to put this together because it's really a video game that we're superimposing into a live broadcast. And that is a complicated feat, but the results have been amazing. I mean, people from all over the world have been contacting us and wondering how this is done and also wanting to do it themselves for their events. So we couldn't be more thrilled.
I'll talk a little bit about that in a second, but first, because I know you did something similar with the Baltimore Ravens a couple of years ago before the pandemic, but how's what we saw last Sunday? How is that different from what we saw from you guys 2 years ago?
Well, yeah, the Raven was a great viral hit as well, and people really liked it. I think that one was one of our first times using mixed reality, and that was a night game, and so I think the realism of the lighting and things really threw people off. As you can see here, it looks really great. I think the difference with this one is the interaction with the environment. When you see these 3D characters in a live shot, seemingly interacting with the stadium, with the field, with the goalposts, it really throws you off. People haven't really seen that before, especially knowing it's a live broadcast. So, and you can move that camera, the camera operator can move that in any direction they want to look around this world. So it's a really, really complex, but really cool effect. And it wasn't easy, but you got to give credit all to the Panthers. I mean, they're the ones who've taken the risk. They're the ones who believed in this technology and believed in us, and it paid off because it's gotten a lot of attention, and we're really proud of it.
John, how long does something like this take to create? Are we talking a couple of weeks? Are we talking a couple of months, a year? I mean, just give us a better sense of the time frame of something like this.
Yeah, something like this would take about 2 months, about 8 to 10 weeks of planning from the creative idea to the building it out ahead of time, building the models, and then showing up on site. So it takes a lot of hardware. It takes a lot of preparation on site and working with the live production team. Because although it's not there in the stadium, meaning if you're sitting in your stands, you don't see it. You see it through the broadcast. You see it through the Jumbotron, through all the screens on the arena. That's one of the most common questions. Can I see this if I'm at the stadium? And the answer is yes. If you look in the Jumbotron, you can see it. If you look at the screens. But it is an augmented reality. It's called mixed reality because it's interacting with the environment. But this effect is it's definitely new, and it takes a lot of time and a lot of people on the ground to coordinate this. And because it's a live shot, the camera operators are part of this story. They have to follow this object in the environment, which in this case is the Panther. So it's not, there's a lot of elements to it, including a lot of show elements in the live broadcast.
Yeah, it certainly sounds like it. John, you mentioned that you're hearing from people all over the world. Are other teams within the league interested? I mean, or is this something that you could potentially bring to other leagues, maybe the MLB or the MLS, the NBA, just in terms of where we could see this going in the future?
Yeah, we have seen unbelievable interest, and it's so fun to be in the middle of this kind of storm. But yes, we are currently working with the Texans on doing a lot of different mixed reality things for them. Last weekend did a really cool sponsored race that is in NRG Stadium. It looks really cool. So this has the capability of more than just doing entertainment elements. Like this Panther's a lot of fun and people love it, but it's also can be used for business. It is sponsorship and promotion. It can be, you can have a blimp that's not really in the scene. You can have virtual signage. We can take parts of the arena that are not utilized and turn that into product placement or cover it up if it's ugly, or cover up maybe seats that aren't sold and looks kind of ugly in the shot. So what you're seeing here, and I think this is what's so cool, and the reason this is going to be the future of graphics and animation within live events, is that we can manipulate the environment to the point where you don't know what's real and what's not. These are video game elements rendered live in a live scene. And what we can do with that, this is just the tip of the iceberg. The technology is way ahead of the creative, meaning that we just have a panther running around the stadium. When you really start thinking about the creative possibilities for both entertainment, sponsorship, promotion, information, and data that can be put into the scene, it's very, very powerful technology, and I think it's going to be it'll be the standard moving forward in broadcast.
John, talking about being in the early innings of this, I guess your conversations with various CEOs, various executives, when you're looking to do business with them, what has the reception been like? Can people visualize this yet, or is this something that people are still trying to wrap their heads around?
People have a hard time understanding what they're looking at, and because if you're there live, you get it. If you're watching a live broadcast, you get it. But to see it like in these clips afterwards, you're thinking, well, hey, I've seen 3D animation before. What's so big? Because if you can do this in post, who cares? But the fact of the matter is, this is a live shot. This is for live events, and everything can be reactive. In other words, it does take a second to figure out what's going on and why this is special if you're seeing it on YouTube or something like that. So yeah, it needs to be explained to people. But moments like this with the Panther have really opened up people's eyes to what is possible with mixed reality.
Certainly something that looks very cool, with something that we are excited about. John Slessor, thanks so much for taking the time to join us, owner of the Famous Group. We wish you all the best. And we look forward to seeing more of those cool types of videos over the next several weeks. Well, coming up, we're going to take a quick break, but when we come back, we're a year and a half into the pandemic. We'll talk about people's mental health, the wellness, how people are feeling right now, especially with the rise of the Delta variant. Deepak Chopra will join us to discuss that. Also a new podcast that he's launching today. We'll be right back. Well, the pandemic has had a significant impact on mental health. We're seeing this reflected in people's well-being. So here to talk about that in a new podcast that is launching today, we want to welcome back to Yahoo Finance Deepak Chopra. He's an author, wellness guru, and founder of the Chopra Foundation and Chopra Global. Deepak, it's good to see you again. The last time you and I spoke was about three or 4 months ago. We were talking about the state of how people are feeling right now, just around a year into the pandemic. Now we're about 18 months into the pandemic. I guess, what's your assessment on how people are feeling and the well-being of people at this point?
I think people are stressed. The pandemic is obviously very serious, but even more serious is our reaction to the pandemic, which is panic, sympathetic overdrive, inflammation, and therefore the stress actually aggravates the morbidity and mortality from the pandemic. What we need to do is override this stress response through a nervous system which is called parasympathetic nervous system. The mediator of that is the vagus nerve, and all mind-body practices, including meditation, yoga, breathing, tai chi, martial arts, dancing, music, poetry, can help you alleviate the stress.
Deepak, when you're talking about ways to alleviate the stress, certainly I think people have felt a little bit more stress over the last several weeks when they look at the numbers when it comes to the Delta variant. In terms of how receptive people have been to some of these methods, have you seen people be a little bit more open at this point into the pandemic, just in terms of, I guess, different ways or various ways for them to feel a little bit better or to get to the other side of where we are right now?
I think they just need to be aware of what's going on. You can't deny what's going on. There is the Delta variant, but we also know that every booster addresses the variants, and people are not succumbing to the Delta variant unless they're highly stressed and they have what we call inflammatory storms. And so we need to be aware. We need to be vaccinated. We need to do all the hygiene that's important, including masks, social, physical distancing. But be reassured, the vaccines are working 95 to 97 to 98% of the time. People are also developing herd immunity. And we are learning a lot. Actually, in the last 2 years, science has advanced so enormously that understanding the mechanics of developing these new vaccines actually has an advantage. We'll be able to soon develop vaccines for various types of other illnesses through these technologies.
Deepak, you're launching a new podcast today. It's on Audible. It's called Mind, Body, Zone, Living Outside the Box. Oprah is actually one of your guests. And I know you have a couple of key themes here throughout this series, but when it comes to the conversations and what you've learned about some of the biggest takeaways just in terms of physical and emotional well-being, what would those be?
You know, it's very interesting. Even though we call it outside the box, the people I spoke to had no box at all, including Oprah. And that's total freedom. And Oprah's conversation with me was amazing because she delved into her own stories from when she was a young journalist all the way up to now. And she expressed so eloquently that vulnerability is power.
What are some of the specific themes for this podcast? Because you mentioned the fact that the world has changed. I think the way people are viewing the world has changed. And so how is that impacting the content that people are consuming and what people are looking for?
Well, people are still consuming melodramatic content, good and bad stories. But outside the box is not about that. Outside the box is about shared vision, complementing each other's strengths, emotional and spiritual bonding, and not giving any credence to polarization. Ultimately, my intention with the podcast is to reach a critical mass of 1 billion people for a more peaceful, just, sustainable, healthier, and joyful world.
Deepak, the appetite, I guess, for wellness and meditation content, how quickly has that grown, do you think, in the recent months?
Well, you know, the research on meditation has been there for 35 years. There are tens of thousands of scientific papers in peer-reviewed journals, but, you know, the public was not aware of that. Now, because of the story of the pandemic and the science behind it, it's become mainstream. So meditation is now mainstream.
Deepak, as we wrap this up, what's the most important thing for people to keep in mind as we head into the fall and the winter months?
Stay calm, stay sober, don't get drawn into melodrama, pay attention to each other, appreciate each other, share love and empathy and compassion with each other, and accept each other. That's the way to healing.
All right, Deepak Chopra, always great to get you on the program. Author, wellness guru, and founder of the Chopra Foundation and Chopra Global. Thanks so much for taking the time. We look forward to having you back. Let's get a check on the markets here because we are well off the lows of the day. It looks like we're seeing some buying action here heading into the final hour of trading. You're looking at the Dow now off only 21 points. The S&P off just around 0.1%. The Nasdaq flipping back into positive territory, now up 11 points. We'll keep it right here on Yahoo Finance because investors are also keeping a close eye on crypto, with Bitcoin today hovering just around 48,000. We are going to hear from Shark Tank star Kevin O'Leary. He is here to talk about a new deal that he just did with FTX President Brett Harrison. They join us right after the break. August retail sales surprising the market, beating the street's expectations, but the excitement, though, is being kept in check after July's initial reading was revised sharply lower. We are going to discuss the state of the consumer and what this means for the economic recovery. The White House maintaining its plan to start the vaccine booster program on the 20th if it does get the necessary approvals, but mixed messaging and conflicting scientific conclusions are complicating the Biden administration's message. We are going to break this down and exactly what you can expect over the next couple of weeks. And investors keeping a close eye on crypto, with Bitcoin hovering just around 47,000 today. Now, crypto exchange FTX partnering with football star Tom Brady in a new $20 million ad campaign, and recently teaming up with Shark Tank star Kevin O'Leary. We will hear from Kevin O'Leary and FTX President President Brett Harrison in just a bit. We've got 60 minutes to go until the closing bell. Welcome back to Yahoo Finance Live. I'm Shauna Smith. Let's check in on where things stand because we're seeing some buying here as we kick off the final hour of trading. The Dow now well off the lows of the day, barely in negative territory, just below the flat line. That's the case for the S&P as well. The Nasdaq has flipped into positive territory, now up just around 0.1%. But let's kick things off in the final hour with Ines Ferre for a closer look at some of these big movers. Ines?
And Shauna, taking a look at our Wi-Fi Interactive board, you can see some apparel stocks today that are seeing some gains. We're looking at some back-to-school stocks. Express, you've got Abercrombie & Fitch, also Gap up 2%. This is after those better-than-expected retail sales. Consumers refreshing their wardrobes, buying more clothes as they go back to school. I also want to mention what's happening with the airline stocks because we have been seeing today those in the green. We've got Ryanair that over in Europe boosting its forecast, helping some of these airline stocks today. The FTA also saying that its waivers for minimum flight requirements will be extended to March of 2022. So that's giving these stocks a boost today as well. And then I also want to take a look at what's happening with some of the casino stocks, which have been battered over the last week because of more regulation in MACAU. So we are looking at Wynn today that's down about 1%. This is after Wall Street started weighing in on that tighter regulation on casinos. JP Morgan downgrading to neutral. Las Vegas Sands also Wynn, as well as Melco Group. I finally want to mention also what's happening in the EV space. We are seeing Lucid up more than 6%. This is after a bullish note from Wall Street analyst John Murphy over at Bank of America, and also after the EPA confirmed that the AirDream Edition, this is the high-end car that Lucid is working on, can reach 520 miles on a full battery, beating Tesla's Model S long range by more than 100 miles. So certainly that confirmation giving a boost to the stock today. Shauna?
All right, Ines Ferre, thanks so much. Well, investors are also keeping a close eye on crypto. We want to take a look at Bitcoin because Bitcoin under a bit of pressure today, still holding above 47,000 right now. But we want to get it over to Danny Ramiro, who's joined by two special guests. Danny?
Thanks, Shauna. In the world of cryptocurrency, FTX US, the US arm of the world's biggest crypto exchanges, has partnered with Shark Tank investor Kevin O'Leary as an official ambassador. And joining us with more on this partnership is Kevin O'Leary himself and Brett Harrison, president of FTX US. Thanks so much, guys, for joining us.
Thank you.
Thanks for having us.
And Kevin, let's start with your deal with FTX. What was your thought process there, and why FTX US, and does it solve your compliance problems?
Yes, it does. I don't endorse products or services that I don't actually use. I eat my own cooking. I think that's important. I have been trying to solve this compliance issue with my own internal compliance department, my external auditors, and of course the regulators for quite some time now. The truth about crypto and the opportunity as well is that it really hasn't yet been adopted by large institutions the way people think. And the number one reason for that is not lack of interest. They want to allocate Bitcoin, Ethereum, et cetera, and many other tokens, coins, change, whatever, but they don't have the infrastructure to report into their systems. It's that simple. When you buy a stock or a bond, let's say you're running $1 billion mandate and you want to allocate 10% into a portfolio of crypto, that's $100 million. You don't download an app on your phone and do that. You have to have it built into the infrastructure so that it marks to market by the second, like a stock or bond does. Your compliance department can see your position every second. At the end of the day, reports it to your external auditors. They sign off on your statements, and it goes off to the regulator. There is no infrastructure for that yet. So FTX is the largest and has the most invested in building out what I call institutional grade compliance. So I've been able to do that. I've been able to structure a situation where I can manage now my own portfolio on an FTX, and I'm starting to build up from a 3% weighting up to 7% in my operating company by the end of the year, and I'm going to be using FTX to do it. So I feel very comfortable endorsing this product for what it does, provides as a service, and how it can help someone like me and thousands of other institutional players solve for this compliance problem. It boils down to, I get the best service, I get access, all that, but it's compliant. And that is what I have to care about first.
And was the deal paid in dollars or in crypto? And I guess I know you mentioned a little bit about your portfolio. So what does that really look like now?
Well, actually, I didn't want to be paid in dollars. I want the smartest guys on the trading desk at FTX to tell me what I should own. It's that simple, because they get to look at a lot of different products from all around the world. I want crypto. I want to have an allocation of around 7%. And I don't want it to be just in Bitcoin. That's not diversified enough. So I'm building a portfolio with them now, deciding what I want to hold. And I've decided going forward, I'm going to disclose and be transparent on the percentage ownerships of what I own. And I think that's very important, because one of the things I get concerned about is I have millions of followers. I don't want people to think that I'm buying things and then promoting them. I'm going to disclose what I own and why I own it, why I think the merits of each of these positions are on a monthly basis. I'm really, really interested in DeFi. I think it's disruptive. It's going to be much less friction in the costs of all kinds of services. You know, just my FX costs of the largest market in the world is currency. When I want to buy a Swiss stock or a European stock in euro or British stock in British pounds, I've got a trader in front of me clipping me for bips every time, both ways. I detest them. Okay, sorry, those words are too strong. I don't like those guys, and I want to get rid of them. And I'm hopeful over time. They add no value. They add no value, and that's just one use case of what the future holds for decentralized finance. And I think FTX is at the fore of all that. And why wouldn't I want to be associated with a player like that? It makes total sense for me. And for me, it's to be that dialogue with the institutions that I talk to every day about how I'm tiptoeing into crypto.
Yeah, and Brett, onto that point, I know that you're planning on entering, crypto derivatives and, expanding your user base. Where is the company on that?
Absolutely. So as you may know, recently FTX US, which is currently a regulated spot cryptocurrency exchange, we trade around $200 million a day of spot crypto volume on the exchange. We recently acquired LedgerX, which is a CFTC regulated derivatives exchange and clearinghouse, which is going to give us the ability, in collaboration with LedgerX and also in collaboration with the CFTC, who regulates derivatives in the US, the ability to offer crypto futures, crypto options, and other kinds of futures and options to our customer base. And we're really excited about this because, of course, crypto is immensely popular, but not many people know that more than half of all crypto-related volume globally trades in derivative products like futures. And what we want to do is bring that volume onshore onto the US within the regulatory envelope of the CFTC in a way that's available easily and safely, reliably, and in a compliant fashion to institutions and to retail customers.
And to that point, are you concerned of any of these regulatory crackdowns, especially that have occurred with DeFi?
At FTX US, we have found through our many different conversations with regulators, the SEC, the CFTC, that their door is open and they want us to walk in through the front door and talk with them about what we're doing, how we can work with them to be compliant with the regulations that they want to create and have already created in many circumstances, to bring these products, again, in a safe, reliable way to consumers in the US. And through those conversations, we found actually they are quite open-minded. I think that there's this misconception that the regulatory agencies in Washington just want to clamp down on all innovation in crypto. And it's just not true. What they want people to do is to work with them openly and collaboratively to make this happen. So at FTX, we're not concerned. We're very excited about these ongoing discussions that we're having with the SEC and with the CFTC.
And Kevin, what is your thought process in terms of the infrastructure bill, the taxation, the regulatory debate that's going on? What do you see happening?
I'm actually very pleased that the regulator is getting far more involved. We've obviously had a bad press in the last couple of weeks regarding their role with some of the players in the industry. But the truth is Innovation is being created through decentralized finance. They know that. The U.S. should lead that. They should pioneer it. They should lead it. They should invest in it. That's not lost on the regulator. The best analogy I've used for this is I love to watch Sunday football. I watch every game. I go into my man cave and I watch it. Those players can't play unless they know the rules. They have to know the rules. There's so many people that want to play but don't know the rules yet, and it's the job of the regulator to provide those rules and the rule book, and they're going to do that. And so I'm very, very pleased with the innovation that's been coming. I know we're going to get it right. The amount of buying, you got to look at it from the upside. If all of a sudden the rule book was published and the regulator made the rules up from NFT through to derivatives to futures to coins to chains, and all that stuff was settled, then all of a sudden you would have trillions of dollars of buying coming into this market, and that would be great for every participant and great for competition and great for services. And maybe I can get rid of those FX traders while we're at it. So, the way I look at it is this is all good. And just because there's friction and a little volatility and some positioning, it's not true that the industry wants to go to war with the regulator. It's far from that. It's like Brett said, everybody wants to talk to them and find out what the rule book is so we can play ball.
Totally agree. This is such a positive sign that this debate's happening in Washington right now. It's definitely shown us that the senators on the floor, they want to be educated about this. They want to craft legislation that helps encourage innovation in the space and responsibility. We believe that crypto exchanges like FTX US should be able to report taxes to the government, and that's to the IRS, and that's totally reasonable and normal. We want to make sure that we craft this legislation such that it encourages innovation for players in the crypto space and in the DeFi world.
Well, such a great conversation. Thank you so much, Kevin and Brett, for joining us. And back to you, Shauna.
All right, Danny, thanks so much for bringing us that. Let's check in on where we stand here with just around 45 minutes to go until the closing bell. Again, you're looking at the Dow, S&P, and NASDAQ gaining some steam here in the final hour of trading. All three of the major averages now in positive territory. Now, this comes after that better than expected retail sales number that was out this morning. Coming up, we will hear from Vested Chief Economist Milton Ezrati. He'll join us right after the break. Investors are trying to make sense of that mixed economic data that we got out this morning. Retail sales for the month of August was much better than what the street was anticipating that we would see. Jobless claims, however, heading in the wrong direction, up just around 20,000 from the previous week. So we want to talk a little bit more about this and where we stand in this recovery with Milton Ezrati. He's Vested's chief economist. Milton, it's great to see you again. Let's start with the retail sales number, because I think a lot of people are saying, hey, this points to the fact that the consumer is very resilient, especially in the face of the Delta variant. What's your perspective on this? And I guess what this tells us about where we are in this recovery?
Resilient is the word. The consensus view was a decline of 0.8%. I was a little skeptical that it would be that bad, especially after a bad July. But this number blew everybody away. The consumer is showing tremendous resilience. Delta hasn't improved very much, and they're buying. Now, it varies throughout the subsectors, but the balance is that the consumer is optimistic and ready to spend.
And Milton, I also mentioned that jobless claims number, and I bring that up because the labor market, I think that's something that investors have been trying to wrap their heads around, or trying to make sense of this stall that we've seen. And we saw jobless claims head in the wrong direction last week, 332,000, still historically an extremely high number. I guess what needs to happen in order for us to see a bigger bounce back in the labor market?
Well, I think there are two things. I think we're going to see that now that we've dispensed with the extra unemployment insurance, so that people can no longer actually make more sitting at home than they would at work. So I think we're going to see the participation rate come up. But I think the jobless claims number can be misleading, because if there's a lot of turnover, and there is a lot of turnover because we're in a very different economic environment than we were in pre-pandemic, a lot of turnover it's going to create claims. If those people who make the claim this month get a job tomorrow or next month, it doesn't make the number come down. And if there's a lot of churning, and there is a lot of churning in this economy with new businesses forming, you're going to see these jobless claims numbers remain historically high. It doesn't mean that there aren't jobs there. It doesn't mean that people aren't finding work. It just means that there's a lot of churning in the market. A lot of people are being let go, and new jobs are being created elsewhere.
Milton, we also got that CPI number, the inflation reading earlier this week, up just around 0.3%. Some people are pointing to the fact that, hey, maybe these inflationary pressures, maybe they are transient. Does that strengthen that argument, the transitory argument, in your view?
Marginally. It gives a little sense to the transitory. The inflation was just an adjustment after the pandemic. But these numbers in no means say we're out of the woods here. And I'm very skeptical that we're going to see a complete decline in the inflation numbers back to where the Fed and the Treasury say they're likely to be, although I disagree with them. I think what's important here is this whole decline was really centered on two areas. Used cars, yes, that was a supply shortage problem. Which is what Powell and Yellen said. But we also saw airfares collapse. That was Delta. It was people stopped traveling, and they can make a quick adjustment. That's what happened. For the rest of the numbers, most of them were still well above the Fed's informal target of a 2% annual rate. In fact, only 4 of the 13 major subcategories of the CPI were within the range the Fed says is acceptable. Everything else was stronger. So I don't think we're out of the woods yet on the inflation, not by a long shot.
Milton, we just heard from President Biden just last hour, and he was talking about, he was, of course, pushing for his economic agenda, saying what's necessary at this point in the recovery to keep this momentum going. I want to play a quick soundbite from what we just heard from the president and then get your reaction. Let's listen.
Each inflection point in this nation's history represents a fundamental choice. I believe that America at this moment is facing such a choice. And the choice is this: are we going to continue with an economy where the overwhelming share of the benefits go to big corporations and the very wealthy? Or are we going to take this moment right now to set this country on a new path? One that invests in this nation, creates real sustained economic growth, and that benefits everyone.
Milton, President Biden there pushing for his infrastructure package, also that reconciliation bill that he wants to see pass $3.5 trillion. I guess, how big of an assist do you see those being to the economy, and also just the direction that the economy will then be headed in over the next several years as a result?
Well, that's the question. You can't argue with his objectives. We want a fair economy. We want it to be spread out more. We don't want just a few rich people to get rich. It's hard to argue with that unless you're one of those few very rich people. But the question is whether these programs do it. Now, we've had trillions of dollars of stimulus poured into this economy in the last couple of years. We had the first COVID relief package under Trump last year. We had a new one this year, fresh out of the gate in the Biden administration. That's a lot of money. It takes a long time to see the economic impact there. To say we need more is to say that either these efforts were useless, and I don't think President Biden wants to say that his last effort was useless, or to say that it was in the wrong direction, and I don't think he wants to say that. So he's pushing an agenda. It's a very long-term agenda. He's trying to change the nature of the U.S. economy. I'm not here to judge that yet, but to suggest that the economic momentum we saw, say, in these retail sales numbers, to say that that will die without still more stimulus is pushing the envelope in terms of economic logic. We have a lot of momentum here. It's coming out of the pandemic, and there's been a lot of stimulus poured on this economy that should carry it for quite a while further. I would suggest, since we had good wage gains in this past year, but most of them were eaten up by inflation, that the best way to help the working man and the working woman is to try to get this inflation under control.
Milton Ezrati, always great to get your thoughts. Vested's chief economist. We look forward to having you back here soon. Coming up, AMC Theaters making a big announcement saying that they will accept cryptocurrencies beyond Bitcoin. We're going to talk about this and what this means for mainstream adoption when we come back. Some big news today. Cryptocurrencies are gaining more acceptance. AMC announcing that customers, they are going to be able to use Ether, Bitcoin Cash, Litecoin alongside Bitcoin to make some purchases at AMC Theaters. We want to bring in David Hollerith, our crypto reporter, to talk a little bit more about this. And David, we have some of those cryptocurrencies up on the screen. We're not seeing a big reaction in the market here on the heels of this news. But I think the big question, though, is what does this signal? What does this tell us about mainstream adoption when it comes to cryptocurrencies?
Yeah, right. I mean, you know, I think of it in terms of what AMC's CEO Adam Aron is doing. And by accepting cryptocurrencies, Bitcoin first and now Ethereum, Bitcoin Cash, and Litecoin. He's sort of signaling to his retail cohort, the people who since beginning of January have put so much money into shares of AMC, that the company's open to technological innovation, if you will. There's a lot to add to that, and I guess one side from the crypto standpoint, regulation. There has been some friction with U.S. regulators, so seeing continued adoption from companies, corporates showing that they want to be exposed to this is interesting. It's also, cryptocurrency, especially for Bitcoin, the use case for whether or not it's a good means of payment hasn't really been officially proved out yet, although I do know people who do use crypto to buy things and sell things. So, it'll be interesting to see how much AMC actually receives in crypto and what they do with it, whether or not they hold on to it or keep it on their balance sheet.
Yeah, certainly. It's going to be interesting to see how popular this initiative is. And then, David, of course, the other question is, when it comes to some of the big topics that we've been talking about with crypto, especially this week, of course, is regulation. We got those comments from SEC Chair Gary Gensler earlier this week. But in terms of what this means for the retail trading crowd, because we know that's so important when it comes specifically to a stock like AMC, how are they viewing this?
Yeah, so the retail traders I've talked to who call themselves apes, the Reddit frequenters, they are actually, as far as the stock market is concerned, they're very pro-regulation, and I don't want to speak for all of them because they all have different views. But from what I hear, they're very down on Robinhood's model for payment of order flow, and they definitely want higher reporting requirements for short sellers. So they're very pro-regulation in the stock market, and it will be interesting to see if they show more interest in cryptocurrencies. I know a lot of them already are interested in cryptocurrencies. What their interpretation is there, whether or not sort of like some of their ideas flip. I mean, they are two different markets, so.
We will say. All right, David Hallerith, great to have you again. Thanks so much for joining us. We'll talk with you soon. Coming up next, we're going to check in on the pandemic, and one of the biggest debates right now are booster shots, whether or not they are needed, and what that timeline potentially looks like for millions of Americans who are eager to get one. We're going to have more on that when we come back. Welcome back to Yahoo Finance. Now, one of the big stories that we have been watching very closely is the debate on booster shots, whether or not they are needed, what the timeline potentially looks like. We heard the White House maintaining the fact that they do plan to push forward for that September 20th plan to roll out booster shots if they do get approved. But let's bring in Anjali Khemlani for the latest on this. Anj?
Well, Shauna, it's really setting up to be a very interesting day tomorrow with that FDA advisory panel set to discuss the need for boosters, and many debating whether or not it would be a broad release of booster shots for the general population, or possibly more limited, maybe to certain age groups or those with certain underlying conditions. And that's really what we're waiting to hear about. The really key issue at hand is also the data, and what does it point to. FDA documents that were released yesterday highlighted the fact that specifically when it comes to the Pfizer booster shot and the data from Israel, the FDA has not independently reviewed or verified that underlying data, and could have some known or unknown biases that could really, throw into question the reliability of that data. And so that's really coming into play, and a key issue. Whether or not boosters are broadly needed, of course, is also a question, but also the idea that despite the White House setting that timeline, it could be a tough fight to get to the finish line, even though it's largely expected that boosters will be approved. Yesterday, we had a chance to catch up with Moderna President Stephen Hoge, and he had this to say about the debate.
This is the key scientific question we're all wrestling with right now, which isn't how the vaccines are doing today. It's how are they going to do this winter? 3 months from now, when we would expect there to be an increase in cases as people go traveling for the holidays and come together. It's important to note that there's a higher risk for those who are older and those who have comorbidities. And so while we do see breakthrough cases across the entire adult population, and we ultimately do think there's a benefit to boosters for the whole adult population, it's clear the need is most acute in those over the age of 65 or those who have diabetes, obesity, or chronic pulmonary diseases, other things that put them at high risk of severe disease if they ever did get COVID-19.
So as you can hear, kind of a hint of what we expect to see. Moderna, of course, is also applying for its booster, though it has applied for a half dose compared to the original dosing, saying that it does provide equal protections. It's really going to be interesting to see how these two companies fare when it comes to the debate over boosters soon. Back to you.
All right, Anj, thanks so much for bringing us the latest on that. We want to continue the conversation with Dr. Jabran Pasha at University of Oklahoma Medical Center in Tulsa. And Dr. Pasha, it's great to have you on Yahoo Finance. I don't know if you caught what Anjali was just talking about, but she was walking through the fact that we're expecting the meeting tomorrow on COVID booster shots. We know the Biden administration has put forward that September 20th date. When you take a look, I guess, at the mixed messaging that we have received over the last couple of weeks, I think there's lots of confusion out there about what's necessary, what we should expect going forward. I guess help break down exactly your point of view on this and how important booster shots are at this point in the pandemic.
Yeah, thanks for having me. I think the first thing to say is that it's not terribly surprising to hear what we're hearing from the FDA. If we think about the fact that it was about 9 months before we actually got FDA approval after the first COVID vaccine was given. Their processes just take longer. And I think that's appropriate. That doesn't mean that the booster isn't safe and that the booster isn't necessary. We know very well from all the data is that the antibody levels go down with time. And eventually there's going to be a threshold in every person in which their antibody levels are not enough to keep them from catching COVID. And so at some point, every individual is going to benefit from receiving a booster shot.
And Dr., I guess, how big of a difference do you expect this to make, and how critical is it at this point in the pandemic when we see Delta and the number of cases continuing to remain high nationwide?
I think it's really important. I think we're at a very critical turning point. And as we see that some parts of the country are starting to plateau a bit, we are not far away from this taking off again. And I think it's really important for people to understand that it may not be the thing to do to wait for FDA approval, where most of us didn't wait for FDA approval to get the COVID vaccine in the first place.
Doctor, you're currently based down in Tulsa, Oklahoma. The state I know has seen a rise in the number of cases like many other states. ICU beds are of a concern. Just give us a better picture of what's currently going on the ground down there.
Yeah. We're seeing numbers that are rivaling what happened in the winter in November and December. There are some critical differences in what we're seeing, though. We are seeing a population that is much younger and anecdotally much sicker. And it is almost uniformly unvaccinated individuals. We know that about 90% of hospitalized individuals are unvaccinated. We know that about 95 to 96% of individuals who are either in the ICU or intubated are unvaccinated. And so because our elderly population did a really good job all over the country at getting vaccinated, we're seeing much younger people sick in the hospital. And we're talking 30s to 50s.
And we heard President Biden put forward the vaccine mandate plan, or at least for employers who employ 100 or more workers, or at least have a weekly testing plan. Is that something that's necessary in order to get to the other side of this pandemic?
I hope it's not necessary because I think it's really going to be difficult to get everyone on board, but it surely is going to help. We can see that in states like Oklahoma, where the vaccination rates aren't where we would want them to be, we're struggling, right? And we can look at other states where they've had much more success at getting their folks vaccinated. They're doing better. And so I'm of the mindset, the more people we can vaccinate, the better. And sometimes you have to do it in ways that not everyone is going to be happy about.
And Doctor, talk to us just about some of those ways and the different avenues that you are exploring, because you're right, Oklahoma isn't up to par, I guess, with some other states just in terms of their vaccination numbers. So what messaging needs to happen, or what, I guess, how do we change our strategy in order to reach the people that haven't been receptive yet?
I think first and foremost, we really got to work to depoliticize this. I think the politicization of this has led to us being in the situation that we are. I think that's priority number one. Priority number two is really combating the misinformation that's out there. We know that these vaccines are safe and effective, and they are keeping people from dying. And so those are the things that we have to stand on. And it is our role as healthcare providers to really get that information out. And I think we're doing our best. But in some situations, it feels like we're losing that battle at times.
And of course, it brings up, this is so critical right now because we have millions of students, young children who are back in school, many of them not eligible for a vaccine yet. I'm curious, just from your perspective or what you're seeing on the ground, are you seeing more and more children come in that are infected with COVID, and what are their symptoms like?
Yeah, the data is showing that more kids than in the winter are getting COVID. Some of that is because, those under 12 can't be vaccinated. But we're seeing about 20% of the cases are children, and that's much more than what we had seen at the end of last year. We know that Delta is making adults and children sicker than what we saw last year, and that's mainly because of the high viral load that we're finding with Delta. Kids still are faring well with COVID, but we are seeing kids get sicker than what we saw before.
Dr. Jibran Pasha, University of Oklahoma Medical Center in Tulsa, thanks so much for taking the time to hop on with us. We know you're very busy. We look forward to having you back soon. Let's check in on the markets because we have just around 19 minutes to go until the closing bell. And we've seen the markets take a little bit of a different direction than when we started the hour. The Dow barely positive, just holding on to gains. S&P back in negative territory. The Nasdaq is still trading to the upside, up just around 23 points. So certainly we need to watch the final 20 minutes or so of trading because a lot can happen. But again, Dow just trading around the flat line. We'll be right back. We've got 15 minutes to go until the closing bell, and you're still looking at a mixed picture. So certainly a critical last final minutes of trading here. Dow and S&P both in negative territory right now, although just barely. NASDAQ is holding on to gains. In terms of some of the movers that we're seeing, the winners at least leading consumer discretionary and real estate. Those two sectors are the outperformers today. Dow winners, Salesforce, Home Depot, American Express, those three stocks up over 1%. So certainly we will continue to watch and see whether or not we are able to flip back into positive territory before the closing bell. But let's take a look at a couple of individual stocks that we are also closely watching here in the final minutes of trading. First up, casino stocks, because Wynn, Las Vegas Sands, and MACAU, those three companies you can see are under pressure today, with the stock off just around 2% when it comes to Wynn. Las Vegas Sands, the same thing. MACAU Resorts off just around 1%. We've talked about the fact that these casino stocks have been under pressure for most of the week because of regulations coming out of MACAU. Investors a little bit worried about what this means for the companies going forward. Well, JP Morgan was out today downgrading these three names, saying that there's too much uncertainty when it comes to potential changes in MACAU. MACAU, that stock is off around 27% in the past 5 days. Las Vegas off 15% in the past 5 days. Wynn Resorts off nearly 20%. Let's flip over to retailers, because it's a very different picture when you're taking a look at a couple of these names. We have Macy's, Nordstrom, Target among the retailers posting gains today. Now, we got the stronger than expected retail sales number before the bell, 0.7 percentage point increase here in August compared to the month of July. That took investors by surprise a little bit, just the resiliency that we're seeing in consumers in the midst of the Delta variant and what that has done for the pandemic numbers. But sales up 0.7% for August. The estimate was for a decline of 0.8%. Macy's hitting $22.47 earlier today, so we're just off the highs of the day. It also traded just around $1 short of its 52-week high. Let's take a look at the broader market action. For that, we want to bring in Scott Crow. He's Center Square's Investment Management Chief Investment Officer. And Scott, the retail sales, they were better than expected. Jobless claims coming in a bit short of what the street was expecting. What's your assessment, though, of what we've seen in the market over the last several days, or really so far this month, because we've seen a bit of a pullback?
Yeah, we have. Some of that's being driven by the softening in China, for instance. But the data that you just pointed to as it relates to the U.S. consumer continues to be very strong, despite headwinds such as Delta, the roll-off of some of the unemployment benefits. And what we're really looking at right now is a self-sustaining cycle. Jobs continue to be created. And that's flowing into inflation, however, and that's something to watch out for, because inflation really is now creeping into wages, is creeping into rents, consumer inflation expectations, and commodities. And so I think as we hit the fourth quarter, I don't think you should expect a market slowdown in growth. And the thing to really watch out for is what happens with inflation and how does the Fed respond?
Well, Scott, that is a big question going forward. I mean, we've talked to a number of guests here just in terms of what to expect when it comes to inflation, what to expect when it comes to the Fed's plan here, in terms of whether or not they will announce tapering and when, I guess more so when that would be. But when it comes to inflation, what camp are you in? Are you in the transitory camp, or are some of these higher prices, do you think, here to stay?
I don't think that there's much transitory about inflation. I don't think there's much that's transitory about how the world has evolved post-COVID. There is no sort of going back to the old normal. This is the new normal. And I think it's a deliberate policy by the Fed. They want to run negative real interest rates to get the economy going and also deleverage the economy as well. The trick is you don't want to let the genie out of the bottle. You don't want to permanently see a runaway in inflation and inflation expectations look like they did back in the early 80s, because then you have to really increase interest rates very dramatically to reset expectations. So, for now, I think that the inflation, we're a little bit of Goldilocks right now, just enough inflation. But at some point, the Fed is going to have to move. The first move will be to taper off their quantitative easing, and interest rates are still going to probably be zero for most of next year. It does seem right now.
And Scott, when you talk about the Fed moving, the timing of that, of course, is so critical. How do you think investors should be positioned, in anticipation of that?
Yeah, well, at Center Square, we focus on real estate in its various forms, including publicly traded REITs. One of the ways, and this backdrop is actually very constructive for real estate because negative interest rates imply higher and asset price inflation, right? So getting that coming through. The key thing to the key thing to remember when you're buying real estate, investing in real estate, is that the best way to hedge against inflation is to own asset classes that are going to be correlated with inflation and have shorter lease durations. So that would include, in our space, pretty much all things residential, apartments, but also single-family residential, even student housing, and then other shorter duration asset classes like self-storage, etc. Where there's risk is if you own an asset that has a very long duration lease, it's very bond-like, and that's going to be, get the negative of higher interest rates without the positive of higher net operating income and NOI growth. And so, thinking about the market in terms of how can I hedge against and benefit from inflation, because I am inherently taking some risk as it relates to will the 10-year bond yield still be like 1.35% in a year from now?
Scott, I think the big question when it comes to real estate, more specifically residential housing, is whether or not some of the numbers can be sustained. The trajectory that it has been on has been incredible, to say the least. We were just talking to a guest yesterday warning about a potential bubble that could be brewing in the housing market. I'm curious, since you do focus on this area, are you seeing any signs of that at all?
Yeah, well, look, the housing market is on fire as it relates to single family homes for purchase, but also the rental market. Even in a city like New York, which was heavily impacted by COVID, rents are back up ahead of where they were pre-COVID. And essentially, what's going on is you've got a lot of people in motion. You've got a lot of people moving. You've had delayed household formation, so there's some pent up demand there as well. And you've got low supply because COVID shut things down, and B has now created supply chain issues. And at the same time, the home builders today are much less aggressive than they were back in the early before the GFC, and manage their book much more carefully. In other words, they don't want to be caught with too much inventory if and when things slow down. And certainly prices are responding in a very aggressive fashion. I do think it's too early to call it a bubble. And the reason is, if you look at the cost of servicing a mortgage today, as a percentage of income, it's still low relative to history. Now, again, that's why interest rates are so important, because if the interest rate outlook changes significantly and quickly, then that equation will change as well.
Scott Crow, great to have you back on, Chief Investment Officer at Center Square Investment Management. Thanks so much for taking the time. Let's take a quick look here at where things stand, because the Dow in negative territory, off just around 32 points. You can see the biggest laggards in the Dow today: Goldman, Dow Inc., and Caterpillar. We'll be right back with more. We are down to the final minutes of trading. Dow and S&P still in negative territory. NASDAQ holding on to gains. We want to bring in Ines Ferre for a little bit more on this. And Ines, when you take a look at the sectors, one sector that's helping to mute some of the losses that we're seeing today are the retailers.
Yeah, that's right. And earlier in the hour, I had noticed the back to school retailers. Now we're taking a look at the online retailers like Amazon, the big box ones like Walmart, like Target. You can see on our Wi-Fi interactive board that all of these look to end the session in the green today. Also home builders, Lowe's, Home Depot up more than 1%. We're also taking a look today at the China companies that are trading here in the U.S. to see how they're ending the session. Baba down about 1%. We've got Baidu that's down about 1% as well. And just to mention with some of these China companies, some of these names are posting their longest losing streak since May. You can see here just a 5-day chart on how much they've lost this week just because of tighter restrictions in China. Looking also at where we're going to end with the airline stocks, those look like they will be ending in the green. The American Airlines, United, Delta, all up more than 1%. This is after the FDA said that it's going to extend its waivers for minimum flight requirements until March of 2022 for next year. Shauna.
All right, Ines Ferre, thanks so much. We are going to take a quick break, and then when we come back, we'll bring you the closing bell. Got a minute to go here until the closing bell, and we have full coverage for you. Mark Lashiniza, Janie Montgomery Scott, Chief Investment Strategist, John Lynch, Comerica Asset Management's Chief Investment Officer, to help us break down the action that we're seeing today. But again, less than a minute to go until the closing bell, and the Dow back in negative territory, off 62 points, although the one bright spot is it's off the lows of the day. The S&P also in negative territory, off nearly 0.2%. The NASDAQ is holding on to gains. In terms of the sector action today, what's not working, materials, energy, and industrials, those three sectors are the laggards in today's action. The winners, consumer discretionary and real estate. Retail has also been a big story today, helping to keep some of those losses that we're looking at in check. Target, Abercrombie, Nordstrom among the winners today. And that does it for today's action as we hit the gavel there. Again, we're looking at a mixed picture with the Dow closing well off. Both sales are still in negative territory. S&P off just around 6 points. The NASDAQ up about 0.1%. We have Mark Lashini and John Lynch standing by to help us break down the action that we're seeing. Mark, let me go to you first. I guess, what's your big takeaway from the whipsaw action that we saw in this final hour of trading, then also just the selling that we've seen over the last couple of weeks?
Well, I think today's close is indicative of the resiliency of this market. It almost seems like nothing is kind of a Teflon market. Nothing can keep it down. Every time you start any kind of pullback that you alluded to, which kind of began this sideways action over the last couple of weeks that may have deteriorated or metastasized into something a little bit more sinister in nature, the market pulls out of it, pulls up on the yoke, and we end up putting in a couple of very strong days like we had yesterday. And today, even while we were down quite a bit at one point, we rally into the close. And I think it's really this tug of war at the moment that's underway, which is to say there's still good news on the economy. In fact, in the last 2 days, we've got some good regional Fed survey reports and today's retail sales number. But at the same time, it's in the context of this overall deceleration of growth here we've seen so far in the third quarter, worries about the Delta variant. And of course, we are facing prospects and discussions around now taxes to fund fiscal stimulus programs and as well a potential debt ceiling debacle again being replayed in front of us here in the next month or so. So there's a lot of things that are creating cross currents for investors at the moment, which is sort of creating this environment in which day over day you flip-flop between cyclicals and defensives with no real pattern being elicited by either.
Yeah, John, I guess what do you make of the recent action? Is it more of a season? Is it just a seasonal slump, or do you think it's something a little bit more critical or more concerning?
Oh, good afternoon, Shauna. I think the market right now, to Mark's point, we've had a lot of back and forth, and I think it's reflective of a market that's been up 20%. A lot has already been priced in. We're entering the quiet period for third quarter earnings. Even if third quarter earnings are up 30%, they'll be a third of what earnings did in the second quarter. So, investors have a lot to process with that. I do suspect, to Mark's point about how this market proving resilience, if you're thinking about real rates still being negative, M2 growing or money supply growing twice the rate of GDP, that is a bid for equities in spite of some of the uncertainty. We've seen subtle breakdown, if you will, in about a seventh of the market right now. 15% of the market is down about 20% from their 2021 highs. So we've seen advanced decline line not being reflective of an S&P that's within 1% of a record. So the market's trying to digest a few things at this point, but ultimately we believe that cyclicality will gain traction.
Mark, you mentioned the cyclical versus the defensive debate. I guess going into the final few months of the year and then, of course, into 2021, how would you advise investors be positioned?
Well, currently we've been kind of playing small ball, which is to say we've taken a very neutral approach and have really very limited biases on either side of the sector weights as they're represented in the broad market as being defined as the S&P 500 in anticipation of some conviction that may come by way of some signs that give us evidence which way this market may be breaking. One of the things that we're looking for, and we're biased to think this is what we're likely to see, is that one, we see a rebound in some of the economic data, not so much that they're going to re-accelerate to levels we saw in the first half of this year. It's just that if you look at an index like the Citigroup surprise numbers that have been beaten down to the point where we pretty much flushed out expectations at this point, numbers that are coming in comparatively good relative to those lowered expectations will, I think, help to serve as a boost, a catalyst to re-energize investors into some sectors or the market at large. And the second thing, of course, is to see that we continue to see a lower rate of change in case count associated with the Delta variant that will lead investors to once again reassert that reopening narrative that was so strong and robust in the first half of this year. And I think the combination of those two is likely once again to put a bid under those cyclical sectors, namely industrials, materials, energy, and financials, perhaps at the expense of their defensive growth counterparts, of which, of course, I'm referring to technology and healthcare, primarily speaking. So right now we're playing kind of small ball, not making our biases particularly pronounced, but we believe the tide will turn and are likely poised, therefore, to advocate for more of a cyclical approach that we may embrace here in the coming weeks, if not a quarter or two.
John, we heard from President Biden just earlier this afternoon, and he was pushing his economic agenda, citing the reasons that we need the infrastructure package, also, of course, the $3.5 trillion budget reconciliation bill. What's your assessment just in terms of what this means for the market, or how is the market viewing the potential for more fiscal policy?
Well, I think fiscal policy and certainly monetary policy, they've both been massive tailwinds over the last 18 months, certainly since the pandemic started. I think right now, and potentially this is why we're seeing this, beyond just a seasonal struggle, if you will, in September, what had been massive tailwinds, investors could be questioning. I think investors are questioning to what degree things become headwinds. 3.5 trillion is a big number, and you throw that in with the $6 trillion that we've seen in the three previous pandemic-related recovery packages. Supportive for the markets. Yet now that you're seeing $2 trillion in taxes, it's conceivable that if we go to 26.5%, that could wipe out anywhere from 8 to up to 10% of earnings forecast for the S&P 500 next year. So to the degree investors are pricing in $200 in operating earnings this year and $220 next year, if you wipe out 8% of that, I don't think this market is priced currently for flat earnings growth next year. And I think that's going to be the biggest issue of the fiscal announcement, is to what degree the corporate tax rate hits S&P earnings. Now, for companies to be successful, obviously you want sales growth, benefit from pricing pressure, but you have to maintain margins to some extent. So to the degree the best run companies, and I think that's why it's going to come down to more of an active market going forward as opposed to more passive strategies that have been successful most recently.
Mark, what do you think? Do you agree?
Yeah, I largely do. I think that is going to be a concern because, again, investors at the moment are struggling with this notion that GDP growth for Q2, subsequent to the revision we just had last week, showed 6.6% at an annualized pace. Today, both the Atlanta Fed and New York Fed nowcasts are showing high-frequency data indicative of a pace of growth less than 4%. And if that glide path continues to show a downward bias, coupled with those prospects of higher taxes, which applied against those earnings prospects that are double digits on a year-over-year basis, that warrants a diminution of market multiples. And with the market trading at 21 times, roughly speaking, those forward earnings estimates, it doesn't justify a valuation other than one that's more compressed to reflect a slower pace of those earnings growth projections, both that which is being trimmed by the higher tax rates, as well as that which is not likely to be engendered by a slower pace of economic activity than was otherwise anticipated.
Mark Lucchini, Janie Montgomery, Scott's Chief Investment Strategist. Our thanks to you, and of course our thanks to John Lynch, Comerica Asset Management's Chief Investment Officer. We want to turn to another big story, and one that our Fed reporter Brian Chung is following very closely, and Fed Chair Jay Powell ordering the review of the Fed's rules around stock trading. Now, this comes after a story that we covered earlier in the week. A couple of senior policymakers, they disclosed several large transactions. So, Brian, I guess, what does this mean just in terms of what the Fed could potentially do going forward? Because it has the potential to be pretty significant.
Rules are in the news, probably not a good thing. All of this having to do with the revelations that we got earlier in the month, first reported by the Wall Street Journal and then by Bloomberg, disclosing a number of multi-million-dollar transactions being done over the course of 2020 by Dallas Fed President Robert Kaplan, covering individual stocks like Apple, Facebook, Verizon, which is actually Yahoo's former parent company, in addition to, in some cases, a floating rate bond ETF. And then you have the Boston Fed President Eric Rosengren, who has disclosed he had several transactions in separate real estate investment trusts. Now, both of those Fed presidents said that they would be selling those positions by the end of the month and would not be engaging in any more trading under those accounts, at least during the time that they will remain presidents of their respective Federal Reserve banks. But now we're hearing from the Federal Reserve chairman, who apparently said last week that he would be interested in having the board take a fresh look, is the way that they described it, at the ethics rule around permissible financial transactions and holdings by senior Fed officials. I want to read to you an excerpt from this statement from a Fed spokesperson saying, quote, "Because the trust of the American people is essential for the Federal Reserve to effectively carry out our important mission, Chair Powell late last week directed board staff to take a fresh and comprehensive look at the ethics rules." Now, whether or not this could change anything remains an open question. Whether or not that review will be public remains an open question. But regardless, the Federal Reserve spokesman adding later in that statement that this could lead to a tightening of rules and standards. We have to remember that the Fed board is the head that presides over the 12 Federal Reserve banks, which all have codes of conduct that in many cases are similar to one another. But again, never a good thing when the code of ethics is necessarily in the news cycle. We'll see if the Federal Reserve chairman is pressed on this topic when there is that press conference after the Fed's next policy setting decision meeting. That'll be next week, Shauna.
Yeah, it will be interesting to see if he has anything more to say about this. Brian, you mentioned the fact that we could see tighter rules as in regards to this, but when it comes to the rules that could be implemented, I guess, will they be much more stringent, do you think, or is it still a little bit just too early to tell?
Well, the challenge is that when you unpack the rules, at least at the Federal Reserve Bank level, there is a wide prohibition across ownership of any bank or depository institution. That makes sense because the Federal Reserve is a major regulator over the banking industry. But outside of that, a lot of the Federal Reserve banks have language that say it is okay to be invested in stocks or even bonds of companies that are not tangentially related to the banking industry, as long as they don't have any sort of substantial banking business, that it actually is allowed. And when there is gray area, as long as the Federal Reserve official clears it through their ethics officer, which is inside the Federal Reserve Bank, not necessarily coming from the Board of Governors in Washington, D.C., then it's an A-OK for them to invest in that. Now, it's possible that you can put some sort of restriction in place that would say you can't hold stocks of any sort. Again, we'll see if the Federal Reserve wants to do that. Another way this could happen is if Congress wanted to move on that. We saw an interest from Senator Elizabeth Warren, the Democrat from Massachusetts, writing a letter to all the 12 reserve banks saying you should all be imposing a ban entirely on any sort of stock trading within 60 days. We'll see if that's going to happen, because this type of letter writing isn't necessarily a mandate for them. But of course, Congress does have the power to legislate that into law if they wanted to. And maybe Elizabeth Warren's letter is a hint that they might be interested in doing so, Shauna.
All right, Brian Chung, thanks so much for breaking that down for us. Coming up next, a number of states are threatening to sue President Biden over his vaccine mandate. We will talk to the CEO of one company about what it could potentially mean for his business. He joins us right after the break. President Biden mandating vaccines or that workers be tested at least weekly for companies that employ 100 or more people. So we want to talk about what this could potentially mean for some of these employers. And for that, we want to bring in Maytab Bogle. He is the co-CEO, of Forever Floral. Maytab, it's good to see you. Your company employs just around 130 people. So you're one of the companies that will be affected by the president's mandate. I know you've raised some concerns about this. What are some of your worries?
Yeah, absolutely. I mean, ultimately, in our opinion, it's really the job of the government to enforce policy. We've been very good about following CDC guidelines in general since 2020 when they were first established, and we've endured the associated costs with that that come along with those guidelines and enforcing them. And for us, this is just really going to be it kind of crosses the line in terms of what small businesses are expected to endure. As far as costs go, an already very difficult and bumpy year.
So, Maytab, are you looking for funding from the government in order to enforce this, or what would you like to see done?
Yeah, ideally, it would be something that the government enforces outside of work. Really, we're happy to. We always comply with anything that the government's wanted, including mask mandates, with a smile on our face, but. I think expecting a floral producer, and we make artificial flowers out of wood, expecting us to kind of set up testing, et cetera, is a bit of a leap. So, especially in a warehouse or production environment.
Have you thought about outsourcing some of this? I know you were saying in a recent article that you were quoted in, there was some concern just about your HR division being able to handle some of these tasks that they would now be responsible for. Would hiring a third party, would that help resolve some of these issues?
Possibly, but again, it comes back to cost, just drives costs up unnecessarily. We'd always rather invest in our people and keep putting capital behind our people, which we've done very aggressively over the last 2 years. We grew from about 20 employees to where we are today at 130. So for us, putting capital back into the company, growing it as aggressively as possible is critical. And this is just another thing that's going to slow us down. And we've looked at a few different alternatives, but the core issue is that there's not really enough clarity yet. It reminds me a lot of what the last administration did with sudden tariffs that appeared out of nowhere with very little advance notice. And we kind of see that happening again where clear guidelines aren't laid out. And it's just kind of being sprung on us.
Do you have employees back in the office? And I guess what then are you doing? What are some of the policies that you do have in place currently to keep your workers safe? Because we know that's so important, obviously, especially at this time.
Yeah, absolutely. So we have the majority of our employee base is on the production, warehousing, and fulfillment side. We do have a small office there as well as a remote team. But for our team on the production side, they've obviously been at the facility kind of throughout the pandemic. Otherwise, we wouldn't be producing. So with that team, we followed CDC guidelines very carefully, everything from cleaning and hygiene best practices that the CDC had put out, alongside with following any relevant mask mandates in the county that we operate inside of.
I mean, Maytab, your business, you obviously you're talking about expansion efforts. I'm sure that you have been looking to hire. More recently, we've talked to a number of CEOs, a number of business leaders about the labor shortage and the difficulty that that's presenting them over the last several months. Are you facing this? And I guess, what are you doing to address this challenge?
Yeah, absolutely. So it's been really big for us. I spoke to Wall Street Journal about it recently, and really our strategy has been to move towards more of a Trader Joe's and Costco model where we have fewer employees and fewer heads per dollar of revenue effectively, but we're paying everyone more and providing what I feel is better employment opportunities as opposed to the kind of traditional Walmart model where it's the exact opposite. So we've moved towards that, made heavy investments in machinery, automation, et cetera, as well as technology to kind of offset that and really work towards training our existing team more and doubling down on our winners.
We also had the supply chain disruptions. We've talked to a number of CEOs about that. Certainly, I guess the situation has improved a bit, but it is a headwind, especially heading in to the holidays. How have you navigated this?
Yeah, the supply chain disruptions have been, I think, surprising for everyone. We never saw freight. We never expected freight to go from, when we started before COVID, freight was maybe $3,000, $3,500 to get a container from India or China stateside to where we are. And now we're looking at that cost really exceeding $20,000. I'm seeing quotes for around 22, 25. We're hoping it drops off after the Q4 window is over, but it doesn't really look like it will. If you look at port congestion in LA, I believe there's around 50 ships there right now. Just a few, I think about a month ago, it was closer to 30. So it doesn't really seem to be improving. We've unfortunately just had to bear the cost. We don't feel it's worth slowing the company down as far as growth goes. For us, our ultimate goal is always to grow the company as aggressively as possible.
MACAU, we got the retail sales numbers that were out this morning, better than what the street was expecting. You have an inside look at the strength of the consumer. What are some of the trends that you noticed? Are people spending more now than they were maybe, say, at the start of the pandemic?
Yeah, so the bulk of our sales are driven by e-commerce channels. So we, surprisingly, even though despite 70% of our sales being wedding focused, we actually doubled year over year from 2019. And we've seen similar growth this year. When stimulus, it was a little bit of an odd mix given we're e-commerce focused, and e-commerce saw a huge surge in growth last year. So we've seen sales really continue to spike. Haven't noticed a slowdown in our growth really. So still quite strong.
Mehtab Bogle, co-CEO of Forever Floral, thanks so much for joining us today. We wish you all the best. Coming up next, we know that the student debt crisis has not improved significantly in this country. Well, coming up, there's new data out that shows the average debt of recent graduates by degree. RT Swaminathan is going to join us with those details when we come back. Student debt, it's a massive issue in this country. About 43 million Americans owing nearly $1.7 trillion. So we want to talk about a new report out that actually shows the median student loan debt by degree and which degrees are going to set you back the most. RT Swaminathan has been looking into these numbers for us. And RT, I think the big question is, what are the most expensive degrees out there?
Yeah, Shauna, I just want to take a little step back and just think about like this conversation on the cost of degree. And basically it's just crazy high, right? And that's why we're having these alternative conversations about student debt and canceling student debt, because it's just so expensive for parents, students, everyone to sort of juggle this burden. And we look across the state, across the country, you see that, in this map, the Northeast is sort of more burdened with this issue of student loan debt because there's just more colleges in these areas. And also the West is a little bit less burdened because the UC system kind of offers more scholarships and things like that. So coming back to this report, we spoke with the Texas Public Policy Foundation, which looked at new data from the Department of Education's College Scorecard, which is amazing resource because it details how much you take out by degree and by school. And what we basically observed, thanks to them, was that the most expensive bachelor's degree was actually electromechanical and instrumentation and maintenance technologies and technicians, which is kind of an interesting one. $40,000 to do this degree. Maybe the ROI is pretty high. Behavioral sciences, also a $40,000 price tag. And the third most expensive, so I'm going from the opposite end, but theology, curriculum, and instruction, also very expensive degrees. Flipping over to the cheapest bachelor's degree, I thought this was very interesting. Real estate development, international and comparative education, operations research. These seem like stuff that you kind of really, really want these people employed in your company right now. So this entire list is obviously a work in progress. It kind of gets updated over time based on labor market needs. But this is a pretty interesting list if your child is going to college and you have to help them make a decision.
And Archie, what's also interesting, it's not just about undergrad or some of those associate degrees, but also master's, doctoral, professional degrees. How do they stack up against each other?
Yeah, so associate's degree is kind of cheap, $14,000 on basically a median in debt, as compared to bachelor's degree, which is about $23,000. But master's degrees, you need to think about those. We're having a lot of conversations, right? $40,000 in median debt, as compared to professional degree recipients who have had taken out a median of $144,000 in debt. That's like doctors, vets, those kind of people. PhDs don't cost that much. Very interestingly, it's about $73,000 median, but just overall, if you're doing a master's degree, just think a little bit about the price tag if you're thinking about doing one, rather.
Yeah, you certainly do, because you certainly have to get ready to pay up for that. R.T. Swaminathan, thanks so much for joining us. Keep it right here on Yahoo Finance. Influencers is next. David Marcus, head of Facebook's F2, is going to join us.
Built on blockchain technology, Facebook's Novi is being hailed as the next generation of digital wallet, designed to send and receive secure payments within a matter of seconds. Leading the charge for Facebook's foray into digital currencies is David Marcus, head of Facebook Financial and an online payments pioneer from the early days of the .com era. In this episode of Influencers, I'm joined by David Marcus as we discuss the launch of the Novi wallet and Facebook's role in the future of money.
Hello, everyone. I'm Andy Sherwer, and this is Influencers. And welcome to our guest, David Marcus, head of F2, also known as Facebook Financial. David, nice to see you.
Thanks for having me.
So I want to ask you about Novi, which is a digital wallet that Facebook has. How is it different from other digital payment systems, I guess, offered by companies like Venmo or by your former business, PayPal?
So both of these products very, very near and dear my heart for having spent time on them. The biggest difference is really the fact that Novi is a next generation digital wallet that is built on new payments infrastructure, ideally with Diem, which was formerly known as Libra, which basically serves, if you will, as a protocol for money on the internet. And the biggest difference is actually the fact that these wallets that we will be built on top of this infrastructure, including Novi, the Facebook upcoming wallet, will enable people to move money around different wallets. So you'll have interoperability. Today, most wallets are a little bit like older communication systems that weren't interoperable before email. We're a little bit in a world as if, you were using Gmail and you couldn't send an email to Yahoo Mail. Which would be kind of odd in these days, but that's true for money and wallets today. So Novi will be interoperable, and also while it will enable people to send money domestically for free and really conveniently, it will also focus intently on cross-border payments and international payments.
That interoperability is a big focus today with, say, the metaverse, which is kind of an interesting concept as well. One focus of Novi is, my understanding, to provide financial services for the unbanked worldwide. Why will Novi reach them where others have not?
So I think we need a paradigm shift in our current payments infrastructure. When you come to think about it, it hasn't evolved all that much in the last 50 years. About 70% of our total payment volume in terms of value goes on top of ACH, which are rails that were built in the early 70s and take about 3 days to clear. And the current system is kind of tilted in such a way that for the people who need it the most, they're actually charged the most. And so we're thinking that new infrastructure, the same way it actually played out in communications when you come to think about it, will actually help lower the cost and the barrier of entry for many, many people, 1.7 billion people currently who are completely unbanked, and another billion who are underserved by financial services. And if I may just elaborate on that parallel with communications, we used to spend $1 a minute for an international call and 15 to 25 cents per text message. And with the internet, and over-the-top apps, among which WhatsApp and Messenger were big players and still are big players in the space, we were able to completely change the game. And now with a $25 smartphone, you have access to unlimited high-fidelity communications. And that was a privilege that was reserved to the more wealthy of us back in the day. And I think we can help do the same thing for money.
You said you plan to release Novi, late this year, early next year? Do you have a target date? How many countries will it be available in? And what payment features will users get immediately?
So we're planning to launch this half, so before the end of this year, 2021. And in an initial less than a handful of countries, and then gradually go from there. We want to be very deliberate in the way that we scale the product, because we're also very cognizant that in some of these regions, there are lots of local integrations that need to be built, notably for cash out and cash in locations, because if you're the recipient of a cross-border payment, you often don't have a bank account on the receiving end, and so you need to make sure that you can actually physically go to a local cash out point and get your cash out immediately, or use it with other people who will be on the network in your country, which is also why interoperability, by the way, is so important, because we can't pretend or think that we're going to have the ability to build the best wallet for everyone. We're going to build a very good wallet where we know the market really well. And our hope is that over time, you have a lot of local players that will build much better experiences than we can ever build in some parts of the world. And we want to make sure that customers on Novi are able to send and receive money with these other wallets.
David, I have to ask you, has Mark Zuckerberg been very involved with Novi? How often do you talk to him about this project?
Oh, we talk regularly about this. And it's definitely a project that's important to him, and I feel that it's important for the company at this time. I think we can help be a solution to long-standing problems that many people have experienced for a very long time, and that's why we're also passionate about this mission and about our ability to bring a really good solution to the issues.
Now, I mentioned the metaverse earlier, and I know Mark is very keen on that concept for the company. Is Novi connected to the metaverse somehow?
Well, in a way, yes, because in the metaverse, and actually it's a very helpful way to think about future-proofing our products, by the way, but when you think about the metaverse, you think about a digital-only world. And when you think about a digital-only world or environment, then you can actually completely get rid of antiquated infrastructure and concepts that have no reason to exist in a digital-only world. And that's very helpful because it helps you think from a blank sheet of paper. And I think when you start to think about how payments should be invented for a world that was fully digital, it would look very different than the current world where you have to actually walk to a branch to do a wire transfer or cut paper checks. And a world like this will need a protocol for money, will need interoperability, not only for the world itself or the environment itself, but also for the wallets. And it will require smart contracts, programming language, and programmable money, because it'll enable creators to build all kinds of new monetization models that will be great for them and really great for consumers. And so we believe that we can be an enabling part of the vision for the metaverse. And while building for that, also building the right product and sets of experiences for the very people who are on those $25 smartphones right now, and who probably won't experience the metaverse for a little while, but they will get the benefits of lower cost and more accessibility for payments and storing their money digitally.
We'll be right back with more from Facebook Financial's David Marcus. Welcome back to Influencers. I'm Andy Serwer, and I'm here with the head of Facebook Financial, David Marcus.
So Axios reported that you were in Washington, D.C. last week meeting with regulatory stakeholders. So have you spoken with, say, Treasury Secretary Janet Yellen, SEC Commissioner Gensler, or other top lawmakers like, say, Elizabeth Warren? And if so, what did you guys talk about?
So I'm not going to be specific with the meetings we've had, because those were private meetings that we've had with a number of regulators. But it's been a while for me. I think we've basically focused on the work for the last 18 months or so, and building the best possible digital wallet out there, and building all of the operational readiness that is actually required, both from a customer service standpoint and from a compliance and regulatory standpoint, in terms of our readiness to meet or exceed these standards on the Novi side. And it's been a while, and it felt like it was the right time. And this all started with this Medium piece that I put out 2 weeks ago now, and basically restating our ambitions and our motivations. And I think, if I could redo one thing, is really to state our motivations, where we're going to make money, because I think in the absence of explaining where our business model, basically we had left a vacuum for people to interpret all kinds of different things that ended up not being true. And so, being out there and explaining exactly how we're going to build a business on top of this, keeping still absolutely free transactions for consumers, whether for domestic or cross-border transactions, was an important part of the conversation. And also just to check in with regulators more generally about where we are on this journey and where the market is headed.
Well, let's talk about that revenue piece a little bit, David, because you said you didn't expect to get revenue from Novi until 2023. So do you expect it to be a revenue generator after that, and how?
So when I mentioned it was not going to be a revenue generator until 2023, I meant that in terms of the scale of Facebook, for something to register, it takes quite a bit of work, and so I don't expect the Novi or payments revenues in general at Facebook to be meaningful until at least 2023, which is basically the time it'll take to start building the merchant services side of the house, and really enable merchants to accept digital payments at a lower cost than what they're currently paying, and doing so with more flexibility as well, because I think that a great deal of innovation will come from a protocol for money on the internet and programmable money, and next generation of digital wallets like Novi, but many others as well.
Well, as head of F2, do you expect Facebook to get into the business of loans and deposits and other traditional banking services?
So not directly. So in other words, and I also think that when the market is talking about stablecoins, it's also talking a lot about a use case that I don't think is going to be very big, because we're talking about deposits, and people typically, certainly I do, and I'm sure you do as well, we like to earn interest on our deposits, and stable coins typically don't pay interest, at least those that are fully backed with a reserve that doesn't allow them to actually pay interests. And so my expectation is that banks will still be the primary deposit holders, and those who are actually forward-leaning and will integrate with the likes of DM or new protocols for money on the internet will actually be able to not only retain that role but expand from there. And I think from our standpoint, we're really focused narrowly as a first step, at least, on payments and enabling more people to have access to a modern payment network and a modern wallet. But I think over time, we might develop into other lines of businesses, but most likely in partnerships with existing banking institutions and financial services providers, rather than doing these things first party.
David, you know that consumers are going to be potentially worried about security and privacy. How do you convince them that Novi will be safe? And also, what are Facebook's plans with using data from payments?
So I want to be super clear on this. So no data that will be used in Novi can or will be used for ad targeting or for any purposes around, the ad model. And basically the way that we've designed this, and it actually took us a lot of effort to build it the right way, is that your financial data is not going to be commingled with your social data. And I feel that people really want that, and it's an important commitment that we need to make and uphold over a long period of time for people to actually trust us over time. And I think that when we look at the use case that we're solving right now, and we're focused on, the next best thing is so much worse than I think what we'll bring with Novi, that I think at least for people who need to send money abroad, they'll give us a shot, and then with that shot that we plan to honor really, really well, over time, we plan to earn people's trust, so they give us a shot for other things over time. But it'll take time, and I'm cognizant of that. And I think that we won't have two opportunities to actually earn people's trust and deserve it. And so we don't plan to miss that opportunity when we get it.
Yeah, I mean, you talked about a trust deficit. You mentioned that the other day. Is that connected to some of Facebook's previous problems, quite frankly, or is that just about this new incipient world of crypto and digital wallets?
I think it's a little bit of both. I think that it's our scale because we're big, and I think it's important to ensure that things that could scale rapidly, although I don't think Novi specifically will scale very rapidly. I think it'll take a long time, and we can dive into that more if you want. But it's our scale, and I think also a number of questions that emanate from whether Facebook should or should not enter the space of financial services, which is kind of an interesting question because we've been in payments since 2009, and in the last 12 months have more or less processed about $100 billion of payment volume for all of the various payments activities that we have, whether it's person-to-person payments in Messenger, in WhatsApp, in Brazil and India, or for donations, or for commerce-related activities across our platforms, or to buy ads on Facebook for smaller merchants and advertisers. So we've been in the payments business for a long time. And so we're already in that industry. And what we're trying to propose here, while it's more ambitious in terms of rewiring our underlying payments and aging payments infrastructure, I think is something that we can do very, very well, and really address the problems that frankly haven't been addressed in over 50 years. And I think it's time.
We're going to take a quick commercial break. We'll be back with more from David Marcus, head of Facebook Financial. Welcome back to Influencers. I'm Andy Sherwer, and I'm back with David Marcus, head of Facebook Financial.
Treasury Secretary Yellen said last month the U.S. needs more rules for stablecoins. SEC Chair Gensler said they may be securities. That's slightly different, but it's sort of a piece, I guess, if you will. So do we need more regulation? The answer is probably yes, but really then what kind of regulation?
Yeah, so I think we can break it down in several parts. The first thing is really consumer protection. Do consumers understand what they're buying and what guarantees they have to get their money out in an adverse event? And so that pertains to, if you're talking about stablecoins specifically, what are the reserves made of? Are they fully backed reserves or are they not fully backed? And if they are fully backed, what are they backed with? And in my view, very high quality stablecoins are only backed by cash and very short-term treasuries. That's it. And then you could add a capital buffer on top of that to basically cover unexpected operational losses or what have you, to add another layer of protection. But if you have that kind of protection, I would argue that this is much better than a current deposit with a traditional wallet here in the US, because it means that your dollars are fully backed at all times with high quality assets. So I think that's the consumer protection angle. Then it's the question of what do you use these stablecoins for? And when you look at the payments use case, which is, by the way, not what stablecoins are mainly used for right now. In our case, we're very motivated to solving the payments use case, but stablecoins are mainly used right now for exchanges when people are buying and selling other crypto assets. So if you look at payments regulation, there I think it's pretty clear cut what needs to happen. To your earlier question, there are provisions around anti-money laundering, the combating the financing of terrorism, sanctions enforcement. And I think the rules are pretty clear, and this actually offers an opportunity to get better at it than the current system is, which I think it will be. And I think there it's really, really clear what needs to happen.
David, let me just shift gears quickly and ask you a little bit about you. You were born in France, you grew up in Paris and Geneva. What is it like having an international background, and how does that inform you at a place like Facebook, which is an international platform, and with a product like Novi, which of course is also international?
Well, I think it gives me, although I feel very American by now, I think it just gives you a little bit of a broader aperture on how other people think, and how to actually move a product that is global in nature in ways that are going to be more accepted globally and better suited to consumers in other parts of the world. And when you come to think about it, the original idea of Libra was definitely more global. In the sense that it had this idea of a multi-currency stablecoin rather than only a dollar stablecoin. Because it was a multi-currency stablecoin, the idea was to place it in a neutral place. It was Switzerland, and since then that global approach to this project actually didn't pan out in the way that we had imagined. And since then, the DM team has brought this project back to the US and focused it on a dollar stablecoin, because it's really hard to actually get so many different constituents with different views, different agendas, different priorities around the table to agree on something that's so new, despite the fact that it can bring so much goodness to their constituents. And so it's hard. And so we're taking together collectively with the DM Association, its other members, and Novi, we're taking a more step-by-step approach, and it's okay because this is a long journey, and we ought to take the first steps to bring a better infrastructure, better payment rails for all people around the world.
And final question, David, where do you see Novi and F2 and yourself and Facebook in terms of financial services, say 5 years from now?
Well, I think that The best possible place would be a place where people trust Novi for payments. And again, I realize that this is not a given. This is something that we'll have to prove ourselves around and really earn people's trust. But I'd love for Novi to be a trusted brand for people when it comes to payments, and for people to use it for all kinds of different things, mainly for payments, interoperable with other wallets, so send and receive with other wallets. And I hope that the ecosystem that we've helped spur actually creates a lot of innovation that will bring many more people online on the financial system. I'm actually also pretty excited about the opportunity of assets collateralization on chain, so that people have more access to capital in places where it's hard for them to do so. And I hope that this innovation is actually not going to come from us, but from the developer community that will be built around this opportunity. So, trusted brand and payments, lots of people using it, and it's solving a lot of problems for a lot of people and small businesses around the world, and innovation that stems from the community that hopefully will rally around this when it goes live.
David Marcus, head of F2, also known as Facebook Financial, thanks very much for your time.